I just want to make,
What support?
I know. I just want to make sure that you guys got it, because you guys have
You
been,
got here some too earlier. And I was trying to check with that.
I see. Oh.
Good morning, members and guests. Let us convene the meeting of the Board of Equalization. Our first matter, we'll ask Mr. Connell to come forward and lead us in the Pledge of Allegiance.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Mr. Connell, welcome to the Board of Equalization.
Good morning,
3
everyone.
minutes to make your presentation, sir.
Thank you for the time. I appreciate it very much. Over the past few months, I've been working with Mr. David Gow's office. I want to commend him on taking very much the suggestions I made, having some very good ideas of his own, and going above board and going out and contacting 240 veterans organizations in this state.
Mr. Gow, thank you very much.
No, he should. I can be real tough to work with.
I know
You?
We haven't had a crossword, so. Second, what I want to speak about is an event I couldn't make because I was out of state. And kudos should go to the Pismo Beach Veterans Small Business Seminar, which I believe Ms. Ma's office helped quite along with Mr. Gilman, also there, and trying to explain out these veterans exemptions for taxes and fees and licensing. Kudos there. As I just notified that you're having some direct mail from Mr. Runner's office. He's going to give me a copy of that, I believe, after I get done speaking. There's a few little housekeeping matters that have to be taken care of as the veterans are now coming forward. In 2014, the letter I sent to you, Mr. Horton, it stated we knew those veteran vendors the State Board knew of, the veteran vendors who the state didn't know of from 2002 forward, and those veteran vendors prior to 2002. My concern is those group of veterans, which I find myself as one. This Assembly Bill 919 does not go back till 2000 or 1990. As I understand it, there are a very few number of these veteran vendors, whether they've passed away or it's going back to the 1990s. I was wondering how best are we going to get the money back and the money returned to those veteran vendors who have money coming. So that was the other question I had. The contact cover letter sent out for the last notification was quite helpful. There's another Attorney General's opinion that should be coming down. It was requested by the State Senate Veterans Affairs Committee Chairman. I'm not certain how long the Attorney General takes writing these, but I've been known it's quite some time. But all in all, I want to congratulate all of you. We have a pretty good feel on how we have to take care of these returning veterans. We're going to get a whole bunch more. This is just a tip. They're going to be coming back. We need to keep them. Unemployment rate's down from 19% to 14%. However, the percentage of veterans starting business is abysmally low. So if we can get these veterans in small businesses with a little bit of incentive and a little bit of help and coddling along, transitioning from military life to civilian life can be easier for them and their families. Never forget our veterans, ever. That's the only reason we're all in this room. Thanks for your time.
Thank you as well, Mr. Connell, for your continued leadership. I see that Mr. Tucker is here. Mr. Tucker, would you please meet with Mr. Connell at some point today and give him a response to his questions, and then report back to the board through some means of communications if you need our assistance. Thank you again for appearing before us.
I'll write you all a nice letter in a week or two. I just got back from vacationing with my 85-year-old mother, who made me take her to a Halloween party, so.
Good for you.
Thanks once again for all your time, all your help, and your guidance. Thank you.
Thank you. Ms. Richmond, what's our first matter for today?
Good morning, Chairman and Board members. Our first item on today's agenda is the Customer Service and Administrative Efficiency Committee. Mr. Runner is the chair of that committee. Mr. Runner.
Thank you. We'll call the committee to order. We have before us the question of adopting a policy restricting mass mailings on behalf of board members within a specified period prior to an election. I think Mr. Todd Gilman is prepared to make a presentation.
Yes, sir. Good morning, Committee Chair, Runner, and members. Todd Gilman, Taxpayers' Rights Advocate, BOE. For discussion by the committee this morning is whether the board should adopt a policy that restricts mass mailing on behalf of a board member within a specified time period prior to an election. For your consideration are two options. Option one, board members will continue to abide by all state laws and regulations regarding mass mailings without adopting additional policies. Or option two, adopt a policy that restricts mail sent by board members in advance of a primary or general election. This would ban board members and agency staff from mailing or personally delivering any document on behalf of any board member to a person's residence, place of employment, business, or post office box within 60 days of an election in which a board member is a candidate for elected office. However, there are exceptions as noted in the attached discussion paper.
Thank you. I'm going to call on Chairman Horton. This was a proposal that he prepared, and actually within the letter that he wrote about this issue, he articulated, I think, a pretty complete list of exceptions to that process. So I'll just see if there's some comments from Mr. Horton on this.
Thank you, Chairman. Members, just from an overview, I guess, the Board of Equalization is probably, or is, one of the largest state agencies in the world, and unique in a number of different ways. We administer over $60 billion in revenue. And so relative to our outreach efforts, I think they are nominal. The Board of Equalization has taken a position over the past that our best enforcement tool is actually education. The greater the education efforts, the greater the self-compliance with the law. And we're fortunate that 98% of California taxpayers actually comply with the law. That's not taken into account the $9 billion that goes uncollected as a result of the underground economy. So let me just set that as a premise that relative to from my perspective, the expenses involved in outreach, it is nominal. It's less than what a corporation will pay for a commercial or two. But yet still, it is extremely effective. The initiative before you, from a historical perspective, sort of the catalyst of it was the California State Legislature, as well as activity during the 2014, where candidates that opposed members, incumbent members, expressed concerns about our ability to do our jobs, basically, and that's to communicate with California taxpayers the law, the activities, and so forth. So the legislature called into question our outreach. And at the time, it required quite a bit of explaining on our part. And so from my perspective, I thought it just wise that we adopt policies that is adopted by the federal government and the state legislature, as well as many other legislative bodies, just to avoid the appearance. But let me reiterate, from my perspective, the Board of Equalization is quite different than the legislature. We are an administrative body that has administrative functions and duties and responsibilities to communicate to our constituents. It is how the communication is accomplished that I think may be somewhat of a concern of the legislatures, as well as others have expressed during that period of time. What this initiative or this measure does, it conforms with what the state legislature says, is that they have placed a restriction on themselves not to mail out any mail that is not relative to the legislature, the total responsibility during the election cycle. I think it's for 60 days, if I'm not mistaken. The federal government, Congress, and so forth limit themselves for 90 days or somewhere thereabouts. This does the same. It seeks to, at the same time, protect the responsibility or ensure that the board is living up to its fiduciary responsibility to educate and to communicate to its constituents, to say that when that occurred, the agency continues to mail, continues to inform and to educate. It's just the mailing by the individual members that would be restricted. Mr. Runner and I placed a restriction on ourselves during the period of time once it was brought to our attention that there was a concern, and the abundance of cautions from my perspective to avoid any perception that there might be any imbalance in the election process as a result of our mailing activity.
Okay. Other members' discussion questions? Member Ma.
Yes, thank you, Chairman Horton, for bringing this up. And the only thing that I would say is I would take out in which a BOE member is a candidate for elected office, because obviously it may not apply to the outgoing members. For example, you and Mr. Runner are not on the ballot next time, but then Ms. Harkey and I will be on the ballot. And so I think just to be fair and, adhere to what I think is the intent of your proposal is that just no member within 60 days, whether you're on the ballot or not, just nobody mails to anybody. And then I think that just keeps everything, clean and clear, and we all have the same rules whether we're on the ballot or not.
I agree. And I think Member Moore, I think that addresses another legal issue as well, is because it maintains a certain continuity in the message, that the message that would not want a situation where one member is communicating to a group of constituencies and the other constituencies don't have the benefit of that information. So I concur with that.
Thank you. Okay. Member Harkey.
Okay, this is my first year, and we've had a number of outreach activities. How would this affect our ability to communicate? Like, we just had a huge Connecting Women to Power, which went extremely well. People stayed all day. They were ecstatic with the information they received.
Mr. Runner?
Yeah. I was going to say, my review of the proposal indicates that this would, that at regularly scheduled educational communications would not be affected by this. Therefore, I was concerned about that too, that all of a sudden we'd end up with our intention to have this kind of blackout to communicate, we'd also be doing a blackout of communicating and educating. My understanding of this is that those would be exempt from this particular issue, and that we're really talking about unsolicited direct mail. Let the chairman respond.
I concur with what Mr. Runner has articulated, and want to reinforce that the administrative functions of the Board of Equalization and reaching out to their constituencies directly in an educational form should not be restrictive. Ours is a little unique from the legislature, and so that is exempt from the blackout, and believe that it's appropriately so.
Okay. Other questions? Yes.
Yes, so you're saying education is not exempt, so like a small business seminar would not be exempt from the blackout?
Would be exempt.
It would be, or
Would be.
it would be exempt?
Would be.
Yes.
And if the agency is sponsoring a small business seminar and it's within a member's district that's running for an office, his or her name would still be on that publication?
Yes.
Yes.
And will it include all other members' names as well because it's an agency-sponsored event?
Yes.
If it was an agency-sponsored event, that would be correct.
Have to.
Okay, thank you.
Okay. Any other questions?
Now, you cut yours off at 30 days, I recall.
In the
from
last
in
election
the
cycle, I
last-
chose, and I think that I did, and the chair said that he did also at 30 days prior to the election, yes.
And so our reason for 60 is because of, I just haven't seen this in full action, so I just want to be sure I'm not doing something, because one thing I found about transparency, usually people passing transparency are the least transparent, so I want to be sure I'm totally transparent here in what I'm trying to do. We want to restrict the campaign mailings, or campaign purpose mailings, which is what we were accused of. And we're trying to restrict it, or we're going to restrict it to strictly just board business, of which we would be able to send out anytime we had a meeting. And the member's name would still be on, because the member's
Yeah,
district,
right.
but the member's name would be on with all other members, the same way, the same how? I mean,
It basically
do?
does not change, as my understanding, it does not change anything that would be scheduled right now, as we schedule right now, a business education seminar would not be affected by this. Again, to me, I think the simplest way that I understand this, and I'll let Member Horton kind of respond to what, if it's broader than this, is there are some direct mail that we do that is unsolicited to inform taxpayers of issues, whether it's a veterans mail piece or other things that
Senior
are.
citizen or.
A senior citizen
Right,
mail
right.
piece that we do to educate them.
that
has
would not be allowed.
that would be that would be kind of the target mail that we would be referring to here, because that would be, in my opinion, not interrupting the important education responsibilities that we have as a board. It just puts on pause the direct mail discussion and the discussions that we often have with
Constituencies.
taxpayers and constituents. Is that a fair summary?
It
Mr. Chair?
is. Yeah,
Okay.
it is.
Okay.
Okay.
I just want to be sure I'm totally clear as to what we're doing here. And would this impact, like, next year, none of us are up for election, but we would not be able to mail during the primary period next year in 2016? Is that true? And then the general too? Does it apply even if we're not for election? How do we change this?
Actually, that's an interesting thing you brought up, because I think Member Ma brought up a good point, that when this applies, it should apply to everybody, but at the same time, there's an election cycle next year that none of us are on the ballot for.
Yeah, and I would prefer
mean,
not
to-
to be
Right, no,
restricted
every
unless
4
I'm on the
years.
ballot.
Right.
So
So-
I guess we need to think of a way to clarify that, because I think if we just,
Mr. Chair, if I may.
Yeah, go ahead.
I think the language in the initiative refers to when there is an election that we're involved with.
okay,
And it further restricts the candidates that are not, as a result of Member Ma's amendment, that are not involved in
Okay.
the election.
so to clarify it, it's really the election cycles to which there is a Board of Equalization election.
Election.
Okay,
And it's consistent with what Congress and what the legislature does. They don't, I mean, Senate, for example, which is, the Assembly is kind of the catch-22, as we all remember. We're up for election every election cycle in the Assembly, but in the Senate, they're only up every 4 years, and the same thing would hold to Congress, so.
Let me ask Mr.
Gilman.
Gilman there, do you understand the nuances to which we want to make clear in that?
I believe so. So if a board member is running for election, then they would be able to.
If not the board member, but if any member of the board is up for election.
then all
Okay.
members
All
would
members.
not be
And
able
this-
to, would the restriction
Okay.
would apply.
So
all
members.
Whether they're on the ballot or not on the ballot.
Okay.
Which begs the question, what about a special election? If one of us were to leave, decide we wanted to take off after a couple of years and pursue something else, and there were a special, are we included in that? You know, I mean, I think we need to think this out and be sure we've got it nailed down. I don't think it's solid yet. I want to go along with it. I just want to be sure there's no surprises in it. And those are my issues. So do we want to do special? I mean, we can talk about it up here.
Well, let's talk about it. I mean, the special election, I think, would fall in the same category.
Well, hold on, do we don't participate in special elections, do we?
Are they appointed?
Yeah, we don't have a special election
That's right, we
application.
wouldn't have a special election,
Right.
we'd have an
Right,
appointment.
Right, it's either the legislature and the governor act, or they don't act, and then the chief deputy fills the rest of the term.
Okay.
So I don't, there's no special
Special.
election activity that that deals with us, as with all constitutional officers.
Okay.
But
Then
the
that's-
generic term election will cover any election. So I think we're covered if we
Yep.
just
Okay.
do that.
Okay, so I'm looking for a motion.
Move adoption as amended by Member Maw
Okay.
and the,
Okay,
yeah.
is there a second?
Second.
Okay. Without objection? So be it, passed unanimous.
Thank you, sir. BOE staff and I will work with you, Committee Chair Runner, and the rest of the board members' staff to capture the direction of the board. So,
Thank you, Mr.
all right,
Gilman.
thank you.
And that ends our committee.
Thank you, Mr. Chair, much appreciated. Thank you, members, for your support of that initiative. Ms. Richmond, what's the next matter?
Our next matter is item B, corporate franchise and personal income tax appeals hearings. Item B1, Robert H. Lowe and Sheryl L. Berkoff, please come forward. Board Proceedings has received contribution disclosure forms for today's hearings from the parties, participants, and agents. All forms were properly completed and signed. All parties, participants, and agents are on the alpha listings provided to your office. Each person sitting at the table will be asked to introduce themselves and, if necessary, their affiliation with the taxpayer for the record. 10 minutes is allocated for the taxpayer's opening presentation, followed by 10 minutes for the franchise tax boards or department's presentation, and 5 minutes is allocated to the taxpayer for rebuttal. Mr. Chairman, this taxpayer was granted 30 minutes for their opening presentation and 15 minutes for their rebuttal.
Let me just reiterate, but first I'm going to have staff introduce the issue, please.
Good morning, Mr. Chair.
Morning.
Members of the board. This is the matter of the appeal of Robert H. Lowe and Sheryl L. Berkoff. The issues before the board today are whether appellants have shown that Respondent Franchise Tax Board erred in its determination of the basis of real property sold by appellants and the resulting taxable gain. And issue 2 is whether appellants have established reasonable cause for abatement of the penalty for the failure to furnish information.
Welcome to the Board of Equalization. Members, pursuant to the request of the parties, let me reiterate, just to make sure that it's clear, each side will has been granted 30 minutes to make their presentation, considering the complexity of the issue before us. The appellant has indicated that it would not take them 30 minutes, possibly 15, but you're certainly welcome to it. And we will grant the appellant 15 minutes on rebuttal. We're all good? Ms. Richmond? Okay. Well, welcome to the Board of Equalization. Please commence with your introduction for the record. Please be advised that you have 15 minutes on rebuttal, and we will return to you after the department has made their presentation.
Thank you, Mr. Chairman, members of the board. My name is Mark Burnsley. I'm counsel for the taxpayers Rob Lowe and Sheryl Berkoff, also known as Sheryl Lowe. The Lowes are seated to my right. Carl Williams, one of the experts, is to my left. Also present in the audience, because we weren't allowed enough seats up here, is Matt McAllister, another of the experts in this case. For the record, I would like to reserve any time not used during my opening presentation to add to my rebuttal time. Before I begin my part of the presentation, Rob would like to address your board, so I'll allow him to do that now.
Good morning. First of all, let me say how appreciative I am to have the opportunity to be before you. I'm aware California is I think, the only state in America that has a board like yours, who are the protectors of the taxpayer, to review these matters. So I'm very fortunate to appear before you. And Chairman Horton, I look forward to communicating the fair and good work that you do here.
Thank you.
As I said briefly before we were sent back last time, I love California. I came here as a little boy, and this state has given me everything. I've been paying my taxes here since I was 15 years old, and I take that responsibility very seriously. I believe it's a privilege to live here, and I'm happy to pay my fair share to do so. But I also believe in the principles of fairness and common sense. In the matter before you today, I happily paid my full share of taxes, and I paid them on time. I paid millions of dollars in taxes on this transaction before us today. I paid everything I owed, which is why the IRS has never had any problem with the exact same set of numbers that are being questioned by the board today. Unfortunately, we don't have all of the documentation going back 20 years. The State Franchise Tax Board has demanded to see these, and I apologize for that. I rely on my financial advisors for those things. They had a computer crash, and there's some other extenuating circumstances that I knew nothing about until long after the fact. But let me be clear. We spent every penny we said we spent. And we will show you and have shown you independent evidence to support this. Because, with respect, it is absolutely impossible to build a 10,000 square foot, 4-acre trophy property in the most prestigious location on the planet, one that broke sales records when it was sold, for anywhere near the amount the State Franchise Tax Board would have you believe. It simply couldn't happen. And I'm fairly sure that you understand that. My family and I are only asking that common sense be applied to this situation. We take this very seriously. We're not trying to avoid our responsibilities. If we were, we could have just said, oops, sorry about that mistake, and paid it. But we want to do what's right, and we want what's fair. We provided numerous evidence that substantiates the validity of this return, and respectfully, I am not a liar. So we ask for you to accept our return as filed. Thank you very much.
So as you know, and as Rob said, the issue is the amount of gain realized by Rob and Sheryl, Sheryl on their 2005 tax return. This was on the sale of their residence in Montecito, which was constructed and improved over several years. I'm going to refer to the property as Garden Lane after the street that it was on. The Lowe's reported a gain of more than $10 million and paid tax on more than $9.6 million after the allowed exclusion. That's not what you'd see if someone were looking to evade their taxes. As you know, and as Rob mentioned, the case is before you because the professionals, CPAs, and business managers retained by the Lowe's lost a number of records and documents. But as you understand, under Cohan versus Commissioner, known as the Cohan rule, the board is empowered to determine the basis based on the entire record, and you may conclude, and we ask that you conclude, that the amount used on the tax return represents that best, most reasonable estimate of that basis. Now, to even begin to understand this case, you have to understand Garden Lane. It wasn't just another house. The property on which it was built was purchased in 1997 for $2.8 million, and I'm going to use round numbers throughout my talk. Garden Lane was the embodiment of Sheryl's vision, and it was just as much an artistic expression as it was a construction project. A selection of color photographs from the record is set forth in the hearing exhibit binder under Exhibit 1, and also in the supplemental binder that you have. All of those photographs are from the record. If you look at Exhibit 1, you'll see some photographs that also have drawings on them, adjacent to a photograph of the property, whatever part of the property that is. And what that shows is that Every door, every accent, every finish was custom designed. This wasn't an off-the-shelf property. The best materials one could find were used. Many sought out for their hypoallergenic properties because of allergies of the children. Amenities included top-of-the-line appliances, antique baccarat lighting, stone reclaimed from the streets in England and France requiring special processes and artisans to install. The structures were set in a meticulously designed landscape of lawns, mature trees, orchards, streams, ponds, and lushly surrounded pathways, all carefully designed and choreographed for their unique contribution to an overall effect. I understand that the Lowes were also required to pay for repaving of the public street in order to get their permits. As a testament to how special this property was, it was featured in Architectural Digest and as the cover home, California Homes, Veranda, Santa Barbara Magazine, and on Oprah Winfrey's television show. Again, this was not just another house. But that wasn't the end. The home was in a continual state of improvement and modification well into 2003. Antique French paver decking was modified around the pool. An Amdega conservatory imported from England was purchased and installed, and other modifications were done as well. Keep in mind that the home was so impressive that it came to the attention of the buyer, a multi-billionaire, when it wasn't even on the market. Now, this was a buyer who could buy any property he wanted, and he could walk away from any deal that he didn't like. So he didn't have to buy this. This was a discerning buyer, and this guy didn't just plunk down $25 million sight unseen. The transaction was contingent on a series of inspections to make sure that this property lived up to his expectations, and obviously it did because the sale closed. And I invite you in Q&A to ask Sheryl more about this property and how it came to be, because there are so many features and stories worth note, including a tree house that ended up costing more than $10,000 in order to meet requirements to protect the tree. It's unbelievable. We can hardly scratch the surface here. Now, during this entire time, the Lowes employed a business manager, CPA, who was keeping track of all their financial dealings, including the Garden Lane construction and the numerous bank accounts that were used. Between the time of the Garden Lane sale and the time of preparing their 2005 income tax return, Rob and Sheryl changed business managers. Then later, during the exam, as you heard, it was revealed that the Szabo firm, the first CPA manager, suffered a computer crash, and information and other supporting documents were lost. What is important here is that there was nothing the Lowes did to cause the loss of records or reasonably could have done to prevent it. It was perfectly reasonable to hire CPA business managers to help them with their financial affairs and keep track of their documents, as the Lowes did, and there's absolutely nothing wrong. In fact, in today's world, it's almost a necessity for many people to have someone to prepare their tax returns. Now, as a result of the absence of records, the examination was initially set with delays in providing requested substantiation, as the managers were trying to find it. That resulted in the assertion of a penalty for failure to provide information. That was legally inappropriate and unfair, and some of the reasons why are: the examiner failed to heed the FTB's own regulations by immediately sending an IDR with the audit notice. He set unreasonably short deadlines instead of working with the Lowes representative to find a timeline that would work. There was no failure or refusal to furnish available information, so the statute didn't even technically apply on its face. Excuse me. And Rob and Sheryl and their accountant were not uncooperative taxpayers here. This is not the kind of situation where the penalty is or should be applied. The appeal, as you know, began in May 2011, 4.5 years ago. And as Rob said, what we're asking your board to do here today, after 4.5 years of wrangling with the FTB, is to recognize that it's more likely than not that the Lowes spent what they claim they did to construct and improve Garden Lane, and to accept their 2005 return as filed. Now, other elements of the gain, such as the actual sales price and expenses, are no longer disputed by the FTB. So let me talk about the evidence other than Garden Lane itself and why you should make the finding we request. I want to start by talking very briefly about the financial records. Like you, and I'm sure your staffs, when I started in this case, the first thing I did is went and looked at the financial records to see what the story was that they told. and the story was neither clear nor complete from those financial records. So I immediately sought records from the banks, but by then it was already too late. In Hearing Exhibit 4, which is in your book, you'll see what I was able to put together about the financial records, including what we know and can't know about the costs and the flow of funds based on those available documents. But the available financial documents don't address all of the costs of Garden Lane. Exhibits 4 and 5 show that the financial documentation we can add up does not and can't possibly be thought to cover all the costs. But there are also 2 additional declarations that bear on this point. Sheryl provided a detailed declaration that listed a number of features and projects done to Garden Lane, and for many of those she had a recollection of specific amounts that were involved. But much, if not all, of what she testified to is not reflected in the receipts and check registers. As an example, the only part of the Ondega Conservatory that's represented in receipts is, I think, a part of the installation and maybe something having to do with the blinds, but most of the costs just aren't there. In addition, we only recently learned that Kyle Irwin, whose declaration is at Exhibit 10 in your booklet, provided design services for Garden Lane, yet there's absolutely no inkling of that fact in any of the records that we had prior to, dealing with Matt and having to go out and find Mr. Irwin to fill in some blanks. So how many suppliers like Kyle Irwin are out there that we don't even know about? We don't know. And ultimately, we can't extrapolate from the financial documentation because we don't know how much of the project was actually completed that corresponds with the documents that we do have. If you don't understand that, I can go over it in Q&A. Interestingly, when the FTB finally submitted their own analysis of the financial documents on August 17th as a result of a board member inquiry, and this is 4 years into the audit, it became apparent that the difference between what the FTB saw and what we saw from the exact same documents was only $1.1 million difference. That accounts for the $7.1 million that the FTB is stuck on, as opposed to the 8.2 that you'll see in Exhibit 4, which was what I characterized as the absolute minimum. So if the FTB and the taxpayers are only $1 million apart on what the financial documents show, what's been going on for 4.5 years? The answer is that this case isn't about what the financial documents show. What this case is about, and what Cohan is about, is what the financial documents don't show. The FTB stopped where the financial documents end, precisely where Cohan begins. The FTB ignored Sheryl's testimony. Her declarations aren't mentioned at all in their August 17th memo, and the FTB claimed that Mr. Irwin's declaration didn't matter either. This case is, and always has been, about the gap between the incomplete financial documentation on the one hand and the $13.5 million claimed on the return on the other. It's about how your board should use the Cohan rule to do what's right and fair and just, which I know you want to do. Now, you don't need to reinvent the wheel here. If the tax return amount can indeed be shown to represent the best estimate under Cohan, there's no need to start all over and go through the weeds and, again, reinvent the wheel. So if we can't determine the total cost directly with the receipts and checks, we have to look qualitatively at other indirect evidence. So let me go through the indirect evidence that confirms the propriety of the original tax return basis and gain. HE2, Hearing Exhibit 2 in your packet, is a gain computation done cooperatively by the 2 business managers during the Lowe's transition from one to the other that was used to prepare the return. It shows 2 components of basis, $12.9 million, roughly almost 13, attributable to the first manager, and an additional $535,000 that was added by the second. That computation ties exactly to the $13.5 million basis shown on the federal return schedule shown in HE3. Based on a roughly $3 million acquisition cost, it implies a cost of construction improvements and other basis additions, if there were any, of approximately $10.5 million. Of all the various schedules and computations in the record, reason and logic tells us that this one is the most accurate. Here's why. First, the computation was the earliest one we have, and it therefore was the closest one in time and the most likely to be done by persons or people most knowledgeable about the events and the information that was available. Second, the analysis was done at a time when no one was under any pressure to make the number anything other than what the available information suggested it should be. Third, there was no apparent concern at the time about its accuracy or supportability. So even though we don't know now exactly how it was derived, there's no indication in the record or in any documents that they were concerned about its supportability. Fourth, the preparers were professionals with obligations imposed by state licensing laws, ethical obligations, and IRS rules to prepare and sign only proper and accurate returns, and because they had a fiduciary responsibility to the Lowes in advising them that they could honestly sign this return under penalty of perjury. Now, I know that by itself doesn't carry the day because that's true of all returns, but we can't go around assuming that all tax returns are false. So we can come back to that item, but I think it is significant. Fifth, there was no motivation for anybody to lie or embellish here. If you think about it, the first manager was losing a client. The Lowes were out the door. There was nobody for them to impress here. And the second manager could, and indeed had to, rely on the first for the number. So he wasn't really taking responsibility for the number other than the $535,000. And let's face it, the computation itself may well have been done by a junior accountant who couldn't have cared less what the number was. So there was no incentive here for anybody to stick their neck out for any number that they didn't think was solid. But there's more. The Lowes have now offered two detailed expert opinions, one from Mr. Williams on my left, who as a construction loan dispersing agent had acquired extensive knowledge of Montecito construction costs, and who also served as a dispersing agent on the construction loan on Garden Lane. So he had direct knowledge of this specific property. The second opinion was from Matt McAllister, who's also here, sitting behind me. He's a sought-after contractor in the Montecito market who provided his opinion of the current cost to build Garden Lane, and from which a total cost could be inferred and then discounted back to the current to the appropriate time frame. And those declarations are in HE 6 through 9. By the way, the discount factor that I used, that's shown in HE 11, was not, as the FTB argued, a broad-based CPI, but was specific to housing costs. If you look closely at HE 11, in the descriptive title, the numbers are the U.S. city average housing cost numbers. What's important here, though, is not the precise number of these experts' conclusions, but that both of them are familiar with the market and the type of construction that Garden Lane represented, and both of their conclusions are entirely consistent with the Lowe's basis being what they claimed it was. But there's more. The FTB and your board frequently turn to assessor records to determine basis. Essentially, that analysis assumes that the assessed value of improvements at or near the time of construction will approximate construction costs. Now, actually, the assessments are often less than actual construction costs, and that's borne out by Casey Kump, who provided a declaration also. So it's a very conservative approach that generally favors the FTB, but it's ballpark. And we know that Garden Lane wasn't assessed correctly at the time of construction, but the property was reassessed immediately after sale before anything was done to it. So we do have an assessor value of those improvements based on how the property was sold at a subsequent time frame. So in HE 12 shows an analysis where that later assessed value was discounted back to the appropriate time frame, and that too supports that the Lowe's basis as claimed is consistent with what the assessor thought the value should be. Again, it supports the legitimacy. Oh, what I was going to say, in HE 13 and 14, I have two additional properties sold at about the same time where I used the exact same method. And what that shows is that this methodology does not skew toward the improvements. And so that underscores the legitimacy and conservative nature of the approach. But there's still more. As Rob mentioned, the IRS accepted the Lowe's basis and gain as filed. Now, that by itself may not be significant, but the reason for that, I think, is IRS statistics, which are shown in HE 16, show that the basis claimed by the Lowe's as a percentage of the sales price is entirely consistent with what the IRS expects and sees on an average basis across the country. In fact, the Lowe's basis was a little lower, showing that they reported more gain than the IRS normally sees in these kinds of sales. There's yet more. The opinion of Casey Kump, an appraiser for the county tax assessor with no ties to this case, estimated the current construction cost today for Garden Lane would be close to $1,500 a foot. Again, this is in line with the expert opinions and the basis as claimed on the Lowe's return. And there's yet another point. The Garden Lane sale is shown in HE 17 in the context of contemporary sales under the MLS for the area. There's a map showing the properties, and the location of Garden Lane is shown in red. The only property that came anywhere near, drawing anywhere near the price of Garden Lane, was a two-parcel lot on the beach, and most of the value of that property was assigned to the land. What most of this evidence has in common is the needed perspective and familiarity with the nature of the construction of the quality of Garden Lane in the Montecito market. As Rob said, we wish we could have provided 100% of the records. This case would have long ago been over. We couldn't. We've given you a chorus of the next best things, and that chorus sings in harmony that the actual costs of Garden Lane are consistent with the basis they claimed on their return. The application of Cohan is not a precise science. Cohan concerns itself with the general size and shape of a forest rather than an account of the trees. And we're talking about costs that were incurred some 15 years ago. It's next to impossible to estimate such costs with precision. And there's never any certainty in a Cohan case. But if one looks at this case qualitatively, there are numerous pieces of evidence all showing that it is clearly more likely than not that the basis claimed by the Lowe's on their return was truthful and accurate. We ask your board to make such a determination. The administration of our tax system essentially comes down to trust. In our self-assessment system, taxpayers file returns, swearing under penalty of perjury that their returns are correct. Preparers make a similar certification. Rob and Sheryl and their accountants did that here. Our system trusts that most returns are indeed reasonably accurate and accepts them as filed. But to ensure that integrity, we have audits that promote compliance by looking to discover people that have either intentionally filed dishonest returns, in other words, cheated, or made material mistakes, whether honestly or negligently. The difference between the FTB position and the Lowe's return here is too large for a mistake, or it would have long ago become obvious and we could have addressed it. No one has suggested that the Lowe's return here was intentionally wrong, but that's the implication of the FTB position and why the Lowe's have fought so hard throughout this 4+ year battle. If there's no mistake and there's no intentional cheating, the only explanation left is what Rob and Sheryl have been saying all along, that they filed an accurate return, but that unfortunately, through no fault of their own, the evidence that would prove that unequivocally is now gone. In summary, everyone with demonstrable knowledge of the Montecito construction cost market, independent government records, statistics, and county employees familiar with Montecito construction costs all confirm that what they would expect as the cost of Garden Lane is entirely consistent with what Rob and Sheryl used as their basis for computing gain. I ask that you also see that and see that Rob and Cheryl's claimed basis is reasonable under Cohan. Be fair to these taxpayers. Tell them what they have waited 4.5 years and deserve to hear, that you know they haven't lied, and then please accept their return as filed. Mr. Chairman.
Thank you. Members will now go to the department. The department has 10 minutes to make, strike that. The department has 30 minutes to make their presentation. Please be advised, we will return and allow you 15 minutes on rebuttal.
Okay. Good morning, and thank you, Mr. Chairman Horton, and members of the board. My name is Sonia Woodruff, and with me today is Ron Hofstall. We represent the Franchise Tax Board on this matter. Also with us today is our expert witness, Corey Kruckenberg, and he's here to answer any questions that you might have of him. We would not be here today if appellants had spent the $10.6 million that they claim to have spent and they had the documents to support that amount. The difference between the basis that appellants claim and the and the basis that a respondent has allowed is over $6 million. Appellants allege that this $6 million exchanged hands without leaving a trace of those transactions. Now, while unfortunate events such as lost records do happen, the fact is that actually quite a lot of evidence has surfaced in this appeal, and there appears to be almost a complete record. Virtually none of that evidence supports appellants' claims of spending over $10 million to renovate their home. So this case is not about whether appellants built a beautiful, high-end home, because nobody disputes that. The question here is how much they may claim as their basis the amount that they actually spent to renovate that property. And of course, the law requires that all taxpayers maintain relevant records to support their expenses. And in this case, appellants have provided checks, invoices, and check registers reflecting around $4.2 million of expenses. Meanwhile, respondent has allowed slightly more than $4.2 million in construction expenses, $2.85 million for the initial purchase, and additional expenses for a total basis on appeal of $7.18 million. Now, this amount is actually more than the records support, but it appears reasonable in light of all of the evidence that's surfaced in this case, including homeowners' insurance records, appraisals, property tax assessment records, and appellants' own accounting records. After claiming during protest that they had lost documents, on appeal, appellants were able to provide thousands of pages of documents. And the main problem with this evidence is that much of it is duplicative. For example, if I incur a $100 expense, that expense could be reflected in many different ways. There would be a canceled check, a check register showing that the check was written, an invoice or receipt for the same expense, an accounting report noting the expense, and I could go out to that person who received the check and receive a signed statement stating that they received $100 from me. And if you added up all of those separate items as separate proof of my expense, you might think I spent $500, but in actuality, I spent $100. And that's the main problem that we've had with appellants' documentation. With the substantial volume of documents provided on appeal, it has been a significant task to review each and every check, each and every invoice, and line item in a check register, but we've done so, and after eliminating duplications, the record reflects $4.2 million of expenses. So prior to the last hearing, FTB was asked to provide a chart of evidence considered in this matter. And in so doing, we went through and found items that we inadvertently had double counted, and also some items that should have been included but weren't. Overall, however, the total amount that should have been allowed was still less than the construction costs already accepted by FTB. There are 5 main points I'd like to cover in today's presentation: the evolution of this case, the problem with Carl Williams' report, the problem with the attestations, the problem with using sales price to prove basis, and the substantial evidence that supports respondent's position. FTB began its audit in July of 2007, and after months of requesting information, appellants failed to supply any documents. Finally, after 15 months and several letters warning about the possibility of a penalty, FTB issued an assessment with a failure to furnish penalty. Because no documents had been provided at that point, respondent based the assessment on public records and mortgage loan documents. During protest, appellants changed their representative to their former accountant, Mr. Szabo, who was the person who originally maintained all of appellants' financial records. And he said that due to a computer crash in May of 2002, he could not locate source documents, but he was able to provide a 3-page accounting report of appellants' construction costs and a few other documents. Now, throughout the protest, appellants' position on their construction costs changed as Mr. Szabo revised their claimed basis amount. They initially represented they spent $8.4 million on construction costs, but they also attempted to capitalize over $2 million in mortgage and construction interest. And after apparently realizing that this interest could not be added to basis, they revised their figures several times, ranging from claimed construction costs of $8.4 million all the way down to $4.8 million. None of these amounts, however, were supported by Mr. Szabo's accounting report, which included total construction costs of $3.3 million. Mr. Szabo represented that this report was the total accounting for the construction performed on the Garden Lane property from May 1997 through June of 1999. And respondent's protest hearing officer used Mr. Szabo's accounting report to allow basis of $3.3 million And she also allowed additional invoices that appellants were able to produce and the initial purchase price for a total basis at protest of $6.7 million. Now, this amount was extremely favorable to appellants in light of the documents that had been provided by that point. FTB allowed basis of $3.3 million based solely on an accounting report with no supporting documents, in addition to some invoices. And it now appears that that accounting report may have come from the check registers that were provided at appeal, dated May 1997 through June of 1999. But on appeal, appellants have changed their approach. They now rely on the opinion of Carl Williams, who they allege has special knowledge of the construction costs. Mr. Williams originally estimated that appellants spent at least $9.9 million to construct the Garden Lane property. Now, please keep in mind that this amount is still over $600,000 shy of the position that they took on their tax return. But they argue that this estimate is essentially close enough. Now, after appeals briefs were filed, the board staff pointed out to both parties that the property tax assessment records reflected that appellants had reported construction work valued at only $2.859 million as of December 1998. And after closer review of that form and the building permits, FTB questioned whether appellants had ever built a guest house above the garage in 2002 or 2003, as claimed in Ms. Berkoff's declaration. And after obtaining the building department records for Garden Lane, it came to light that, in fact, while appellants had applied for the permit to construct the guest house, the work had never actually been completed. Furthermore, on review of those building department records, it does not look like appellants added a master bathroom to the home in 2002 or 2003, as claimed in the declaration. A master bath appears to have been part of the original plans and construction of the home. Mr. Harding, the appraiser who appraised the property at least 4 times, physically inspected the master bathroom along with the rest of the house and described it in his June of 1999 appraisal. So to date, appellants have not really responded to this question, but the master bath addition appears to be another item of work that was not added to the home later on as claimed. So after acknowledging that the guest house was not built as originally claimed, Mr. Williams revised his original report, but the overall number of basis only went down by about $200,000, bringing his estimate of the cost of work to $9.7 million. And this amount, again, is still over $800,000 shy of appellants' claimed construction costs, but again, appellants argue that this is close enough. Appellants argue that the Cohan rule should be applied to increase basis even over and above what their own experts is able to estimate. I'd like to focus on Mr. Williams' report. His report is the only piece of evidence that really gets appellants close to their claimed construction costs of $10.6 million, other than the newly submitted McAllister estimate, which is far too vague to be of any evidentiary use. Mr. Williams' estimate still falls far shy of appellants' total claimed construction costs, but it's the only piece of evidence that gets them close to that position. But the Williams report is seriously flawed when you take a closer look at the figures. The major flaw with the Williams report is that it's not an estimate of the actual costs incurred on appellant's home. His report is a theoretical estimate of what someone might spend to build a home in Montecito based on a database that, until very recently, we were not able to see. And because Mr. Williams was not basing his estimate on the specific expenses for this property, his estimate amounts to a patchwork quilt of expenses from different homes. So essentially, Mr. Williams' database could lead one to any desired amount of costs. At the last hearing date, Mr. Williams gave us 5 samples from his database. And 3 of those homes were built in 2011, 1 in 2007, and 1 in 2004. So they were built long after the relevant time period, as we know that appellant's home was substantially complete by 1999. But even though the properties were built much later than the Garden Lane property, they still do not support the price per square foot claimed by appellants. Appellants claim a price per square foot of approximately $900, actually more than $900, while the average price per square foot of the projects in Mr. Williams' database was about $600, or $436 per square foot when you take into account the appropriate discount factor. Now, the sample properties call into question Mr. Williams' entire method of estimating costs because they simply don't support his conclusions. There are many other clear errors in the Williams report. Aside from the guest house and the master bath addition, the Williams report valued concrete at $147,000. That amount is absurdly high when we know that the main home's existing foundation was used and only 300 square feet of concrete was added along with a new foundation for the pool house. According to appellant's records, they spent $39,000 on all foundation work, the main house, and the pool house. Furthermore, Mr. Williams allocated over $600,000 to framing the main home when we know that the remodel retained a significant amount of framing from the original house, and appellant's accounting records reflect that they spent about $106,000 to frame the main house. Mr. Williams allocated nearly $500,000 to framing the pool house, when appellant's records indicate they spent about $19,000 for this aspect of the construction. Mr. Williams allocated $1.2 million to rebuilds, changes, and upgrades when the only claimed rebuild in the record was some repairs to the pool house after a septic flood. Mr. Williams estimated the contractor's fee, overhead, and profit at nearly $1 million and another $325,000 for general supervision when the general contractor, Bruce Sweet, only received about $100,000 as reflected in appellant's accounting report and check registers. Another notable fact is that Mr. Williams listed a little over $350,000 for architect's fees, who is Mr. Don Nolte. Now, appellants in their most recent filing argue that respondent cannot rely on Mr. Nolte's attestation in which he claims to have received $350,000 for his architect services. But this point ignores the fact that Mr. Williams also estimated the architect's fees at about $350,000. And this is one amount that appears appropriate because appellant's contract with Mr. Nolte is in the record. And that contract states that Mr. Nolte is to be paid on both an hourly basis and as a percentage fee of the total claimed construction total construction costs. So when you take into account his hourly services, which are clearly detailed in the invoices provided at appeal, and you factor in Mr. Nolte's 7% fee of the total construction costs, you can determine that the total cost for the project was $3.39 million, or at least that was the amount of construction costs that Mr. Nolte's fee was based on. And that amount accords with the accounting report. So because we have Mr. Nolte's contract and know that he was supposed to receive a fee of 7% of the construction costs, excluding certain interior design items, we can see that if the total costs were $9.8 million, as Mr. Williams claims, Mr. Nolte should have received a fee of well over $600,000. And that amount is significantly more than the amount shown on Mr. Nolte's attestation and in the Williams report. So Mr. Nolte's fee is just one example of many. All of the available evidence other than the Williams report reflects construction costs of less than half of what appellants claim. So I'd like to touch briefly on the attestations because they've gotten a lot of attention in this appeal. During the protest, appellants submitted several statements from various people claiming to have received a total of $2.6 million from appellants for construction costs. And respondent did not allow additional amounts of basis for these attestations because the overall problem we have with these statements is that they are redundant. So that is, most of the costs were paid from the original construction loan, and respondent has already allowed basis for those amounts. So allowing additional basis for the attestations, for the most part, would be double counting. For example, the records reflect clear overlap of $1.3 million, and those are amounts claimed in the attestations that you can see were paid from the main construction accounts. FTB has already accepted those amounts, and the details for those amounts are in Table B1, which was provided prior to the last hearing. And we believe that there's even more overlap between the attestations and the already allowed construction costs, but it's impossible to prove because many of the attestations cover things like supplies and materials, and we know that those items were also paid for through the construction accounts, but it's very difficult to match up amounts. There are too many other problems with the attestations to cover today, but the concerns that we have with them are detailed in Table B1, and to name just a few, it's unclear where the numbers came from, the attestants or Mr. Szabo. And if the numbers came from source documents, why weren't those source documents provided? Many of the attestations directly conflict with other items in the record, especially Mr. Williams' report. So the issue of sales price and what it might indicate about basis has come up quite a bit in this appeal. But sales price does not tell us anything about basis, which is the cost of the property in the hands of the taxpayer. Sales price could be affected by so many different variables that it's not really useful to extrapolate the cost of a property from its sales price. For example, if an exact replica of this property was sold in a less desirable area, it would have sold for much less. The value of the land, the neighborhood, appreciation in the market, any number of factors could have gone into the sales price of Garden Lane. What we do know is that a little over 1 year before the sale, the property appraised for a total of $13.5 million. Mr. Harding stated in one of his appraisals that the quality and finishing of the property was on par with the quality of other Montecito homes. So in other words, while it was a beautiful and high-end home, for the area, it was not extraordinary. The sales price of this home or comparable homes does not help to ascertain the cost to appellants to construct Garden Lane. So if this property sold for $150,000 or $150 million, the analysis as to basis would be exactly the same. So rather than speculating on something as variable as a sales price, let's look at the firm evidence in this case. The documents appellants have provided on the appeal are extremely detailed and very telling. As mentioned earlier, they provided 2 check registers, which appear to support the accounting report provided at protest. And these registers reflect expenses of $3.2 million occurring between May of 1997 and June of 99, the period of time when substantially all of the construction work occurred. They also provided very detailed invoices, often with check stubs attached, for work performed in the same time period and after. So if you look at the costs detailed in those items together, you can see that they cover substantially all of the claimed work in Ms. Berkoff's declaration, with the exception of the guest house and the master bath addition. So from the documents provided by appellants, you can see that about $4.2 million was spent on all the construction costs from 1997 through 2004, and we have a fairly complete record of the work that was performed and how much it cost. Appellants claim that they have lost documents that would prove over $6 million of expenses, but it's difficult to understand lost documents of this magnitude when you review the check registers, checks, and invoices and see the expenses that were covered by those documents. And this point is important because appellants want us to apply the Cohan rule. But the Cohan rule only tells us that if you incur an expense and can prove that you did so, but you cannot prove the exact amount, it's appropriate to estimate a reasonable amount for that expense. But the documents provided cover so many of the claimed expenses, so exactly which parts of the construction do appellants claim were not covered by the existing documents? While Cohan allows for estimation, it still requires certainty of the missing work and some basis on which to estimate a reasonable amount. For example, if appellants had said, "We built a pool, but we have no documents to prove how much we spent," but clearly looking at building permits and photographs, we can see that you built a pool and generally the materials used. This would be a perfect time to apply Cohan. We could determine the average cost for a pool of that caliber in the area and how much it might cost at that time. And that's not what we have here. In this case, we see payments for the check register for the pool, so we can't estimate based on Cohan when we have the actual cost data from the check registers. So instead of specifying which expenses have not been included in basis but should have been, appellants argue that they must have spent this missing $6 million because Mr. Williams thinks it's likely. They argue that the Cohan rule should be used to allow expenses based on their expert's report, but even that report only gets them to $9.78 million. So after using Cohan to estimate cost basis, appellants want this board to allow an additional $869,000 just because it's close enough. But this is not how the Cohan rule is supposed to work. Cohan is not a blank check. The Ninth Circuit Court of Appeals tells us that Cohan does not obviate the need for proof of entitlement to an expense, and that a trier of fact may not be compelled to guess expenses based on Cohan. In the appeal of Albert Hakim, this board found that the Cohan rule did not allow for mere speculation, unsupported allegation, or inference. Finally, Cohen does not allow us to ignore the available evidence and allow extra amounts just because the taxpayers think that they spent much more. Even though the records appear to be complete regarding the work performed and their costs, respondent accepted appellant's statement of lost records, and in order to apply the Cohen rule properly on appeal, FTB looked to the available contemporaneous evidence to try and find support for that missing $6 million. But the more we looked at that contemporaneous evidence, the more support we found for construction costs of around $4.2 million. Cohen could not be used to allow any more expenses because all of the available evidence confirmed that the basis already accepted was correct. So let's take a look at some of that evidence. In 1999, appellants insured their home for $3.3 million. They adjusted this amount every 2 years until 2003 when they insured it for $4.7 million. So it's unlikely that anyone would spend $10.6 million on construction and then insure their home for less than half of that amount. And in fact, the language of appellant's policy specifically required them to insure the dwelling to its full replacement cost at the time the policy was issued, with periodic increases for inflation. The property was appraised at least 4 different times between 1998 and 2003. The appraiser, John Harding, visited the property and physically inspected it each time he appraised it. His appraisals estimated that the cost to reproduce an exact replica of this property ranged from $2.6 million to $5.3 million. Now that reproduction cost is for an entirely new home built from scratch, which we do not have here. But Mr. Harding's appraisals were performed close in time to the actual work. He walked the property, he reviewed permits, and spoke to appellants and the contractor about the work that was done. He made detailed notes on the finishes, the appliances, and the quality of the workmanship. He relied on both his extensive experience in the Montecito area and his knowledge of appraisal methods to conclude that this exact property could have been built from the ground up for less than half of what appellants claim to have spent. Mr. Harding's method of estimating reproduction cost is an established method defined by standard appraisal methods and backed up by his years of experience and his knowledge of local workmen. FTB's expert witness, Corey Kruckenberg, reviewed the evidence and concluded that this property could have been built for approximately $4 million. Mr. Kruckenberg based his opinion on Mr. Harding's 2003 appraisal because at that time, that evidence was the most credible and reliable piece of evidence in the record. We've subsequently obtained additional appraisals performed closer in time to the actual construction. Mr. Szabo reported to the property tax assessor that the total cost of construction was $2.859 million as of December 15, 1998. And appellants can claim that this statement was a mistake, but if you look at the check registers as of that date, $2.9 million was actually pretty accurate, suggesting that the one person who had access to all of appellant's financial records believed the cost of the project to be less than $3 million as of December 1998. There are also Mr. Williams' documents from the time of the construction reflecting hard cost disbursements of approximately $2 million for construction-related expenses. And finally, the original contractor's estimate of costs came in at about $1.75 million. Now, appellants have explained each one of these items of evidence and explained everything in the record that contradicts their claim of spending $10.6 million. They claim that they chose to only partially insure the home. They claim that the appraiser was wrong. They claim that the property tax assessor information was a mistake. They claim that they never said they built a guest house, but that their attorney misunderstood them. So there's an explanation for every piece of evidence in the record. But when you step back and look at the totality of the evidence regarding this property, you see that all of the contemporaneous evidence points in one direction, and that's to construction costs of around $4.2 million. I also want to note that they claim their accountant's position on the tax return must be given great deference, but we must somehow ignore all of that same accountant's contradictory positions during protest. And by the way, we must also ignore his accounting records and his statement on the property tax assessment form. So the $6 million difference between what appellants can show that they spent and what they claim to have spent is a substantial gap. It's not close enough, and it cannot be allowed based on guesses and speculation. If it could be, there would be no reason for the rule that taxpayers must retain records to claim their expenses. There'd be no incentive to retain actual records when you can always just estimate them later with a little help from an expert witness. From a tax administration standpoint, FTB cannot apply the tax code fairly for all taxpayers if we allow unsubstantiated expenses of this magnitude. I also want to note that in light of all of the evidence provided in this case, and especially, being able to see samples from Mr. Williams' database, the FTB has determined to withdraw the failure to furnish penalty. And if this board determines to make additional estimates, the 2003 appraisal is really the most appropriate place to start. Mr. Harding physically inspected the property and arrived at his estimated reproduction cost long before this tax controversy. Without discounts and with additions for landscaping, such an estimate would come to about $8.8 million for a total basis amount. And that appears to be the best and highest estimate in the record, made closest in time to the actual work. So that amount of basis appears to be supported by the average price per square foot, as noted in Mr. Williams' samples that he provided at the last hearing. So I'm happy to answer any questions. Thank you.
Thank you very much. On rebuttal, please.
Thank you, Mr. Chairman. I think the main problem with the FTB position is...
Can you pull your microphone closer?
Yeah, the main problem with the FTB position is that there's no credible set of facts into which it fits. If the real basis here was $4 or $5 million, how could $13 million get on the return? How could the accountants been so confident that they had a good supportable number and bid so far off? Again, we get back to, life has to make sense. There's a story here someplace. And it's hard for me to imagine how these accountants and business managers who had been around so long and seen all of this as it went by, whatever happened, how could they be that far off? So it doesn't make a lot of sense to me. The comment regarding there being no trace of records, there were records, and I think the evidence shows that records were indeed being kept. And unfortunately, there are also a bunch of records that are missing. The exhibits 4 and 5 that I mentioned showed that we can trace the funds through certain accounts, but clearly there are other bank accounts where all we have are 1 or 2 checks. And the FTB keeps referring to this as a fairly complete record. It's not. It's not a fairly complete record. We have a fairly complete set of 2 bank accounts, knowing that there are 3 or 4 or 5 other bank accounts where we only have bits and pieces. And there's no way to tie the records that we do have into the construction project and see, okay, this is how much got completed for that amount of expenditure. There are too many gaps. If you look at this on a line item basis, there's, as Mr. Williams did and Mr. McAllister did, the difficulty is if you were going to make, if you were omniscient and you knew exactly what happened and you were going to make a spreadsheet showing the real costs and compare that to the expert opinions, if you know that you've paid, $10,000 to a carpenter, you have a line item, $10,000, but you don't know from that whether he was the only carpenter, whether that was the only $10,000 he got, whether there were 6 other carpenters, and how many other line items. So when we see a line item on a spreadsheet, there's no way to know what's missing and how much of the project was completed by that. We understand that with the attestations and comparing those to the documents that there's some overlap. The schedule that I did with my very first brief was very, very cautious in not double counting any of those expenditures. So yes, there was overlap. The attestations were done during the audit, and I think you did them, right? Rob did those himself. And so there was no order or scientific basis for collecting those attestations. You know, they're obviously less than I wish they were, you know, but it is what it is. And back during the audit, instead of just dismissing them completely, the FTB, again, could have worked with the taxpayers' rep and said, you know, let's go back to these people, let's see what they know. Mr. Szabo's records, it was clear that during the audit, Mr. Szabo was trying to substantiate the basis that was claimed and putting together schedules. None of the schedules that he put together ever matched what was claimed on the tax return. So by that point in time, he clearly didn't know. The people in his office who were originally taking care of the Lowe's account were long gone. So he was left going back to an incomplete record and trying to put together the pieces. What was there and what wasn't, we don't know. My colleague mentioned the issue over interest. I have no idea whether interest was capitalized as part of this basis or not, but I see absolutely nothing wrong with capitalizing interest if it was. First of all, construction cost interest, I think, has to be capitalized. The tension in the tax code goes way back. The idea of capitalizing interest is not a new concept. That's been around for a long time. The tension comes from, at least prior to 1976, when all interest was deductible. The tension came between what gets deducted and what gets capitalized. So 266 was there to provide some guidance that indicated that you couldn't get a current deduction for interest if you were capitalizing interest. The Uniform Capitalization Rules, Section 189, all of those sections were designed to limit the current deductibility of interest that was capitalized. There isn't a single section that is devoted to disallowing the capitalization of interest. So whether interest was capitalized or not, I don't know, but I don't see it as particularly problematic. We have talked ad nauseum about the property tax assessment and what happened at the time. The FTB never disagreed during the briefing process when we explained what happened, and the same is true with the house over the garage. I looked, and Mr. Williams looked at the plans and at the permits, both of which showed that a house was built over the garage. We thought it was. All of the evidence was there. I think in one of the meetings I had with one of your members suggested, well, if you have plans, you can get an estimate. We did exactly that when Mr. Williams was doing his report. So that was an honest, mistaken belief that based on the plans and the permits, that was built. The master bath, Sheryl, maybe you'd like to address the master bath that they think was.
Of course, there was a master bath. When we stated we built a master bath after that, when I think that she had mentioned that is, I mean, every master has a bathroom and we had one. What we did was we renovated ours and we added on to Rob's closet. We added a vanity in mine, we redid all the cabinets. It was pretty substantial, and that's what the difference is here. And also, by the way, we did have a guest house. It was the pool house. And then we were going to build a guest apartment for family members, which we didn't do, but we pulled permits for it. So, but we had an extensive guest house that, you know, when you're building, you call it a pool house, but it did have a bedroom, a living room, a kitchen, and a bathroom. So we could have guests stay in it, hence why we called it the guest house. Anything more?
So the FTB conveniently ignores Mr. McAllister's declaration. He's here, and I may in a minute call him up and ask him to speak a little bit. Carl Williams' methodology has been challenged. Carl has been around a long time. Carl is not a professional witness.
Also, can I say one thing really quick, too?
Sure.
When she was calling it a renovation, it just struck a chord with me because it wasn't a renovation. We did build it from scratch, but in order to expedite permits, we kept an original foundation and a couple walls, and a lot of people do that. In the long run, it ended up costing us more to do that, so in hindsight, we should have waited, but I wanted to address that, too.
And it's also my understanding that it's saved for the permit, but it's then torn down and replaced anyway. And this was a revelation to me, quite honestly, because when the FTB was questioning Mr. Williams and he first said that the framing and the concrete that was initially allowed was then torn down and replaced, I didn't know what to think because I didn't have a clue about that being done. I had the misconception that the FTB council had that part of that was remaining. And when Mr. McAllister did his declaration and essentially did the same thing, including zero foundation and zero framing, as I understood, I asked him about it, and he said, we wouldn't leave that up. And it finally dawned on me that there's an incredible difference of perception here between the FTB expert and experts like Mr. Williams and Mr. McAllister, who were dealing with, 10, 15, 20, $30 million homes, as opposed to a tract home. If you're building a small tract home and you can save some money on the foundation or the framing, you save the foundation and the framing and save some money. But if you're building a $15 million home, you don't want old wood and old foundation there. You rip it out and you replace it. You're not building a gorgeous mansion around leftover pieces from some old construction. That's my interpretation of it. The Nolte contract was done in a couple of parts. The attestation is confusing. There is part of the Nolte contract that was based on the initial plans. Another part of the Nolte contract was for basically supervising the construction, and he got paid in different ways.
And I also want to say that Don Nolte was a good friend of mine, and he took a pay cut to do this job, knowing it would be a trophy piece and probably be in multiple publications. He became extremely busy during the job and had asked, because I was a bit controlling on the job and doing sketches myself and saying, well, let's make the hallway like this and drawing. And Don was like, just, I'm crazy busy, you can micromanage it. So he did take a pay cut, and it was done in stages, which I've worked with him a couple times, and that's how we
The
did
point
it.
being that any contract that says, what John's fees are going to be, or in any way representative of anything, is just not valid. It's sort of the same thing if I'm doing a film and they run behind and things, and I'll say, yeah, I'll give you those days for free. It's the same concept with Don.
Insurance, I don't know the bottom line about insurance, but what we know from this record is that there was a substantial amount of non-recurring costs that one would not insure. And as I see it, there was also a certain amount of, in my lay opinion, or my lay words, inefficiency by doing a construction project piecemeal as opposed to straight all the way through. You add costs. So when you look at it like that, the potential gap between the insured amount and the actual costs is much, much smaller, and probably within range of how different things get allocated. The FTB seems to rely a lot on Harding and his appraisals, but I'd like to read you a couple of comments from from John Harding's declarations, particularly as used by, including as used by Mr. Kruckenberg. Mr. Harding says, I would not expect my estimate of reproduction costs to match or predict what the Lowe's actually spent. Determining actual costs was not the purpose of my appraisal. The cost data estimates from local sources were not obtained specifically for Garden Lane. My estimates of construction costs cannot be presumed to predict or to have predicted actual costs for any given project. Mr. Kruckenberg's use of my appraisal makes invalid assumptions about the meaning of parts of my appraisal and takes portions of my appraisal out of context. I am not an expert in construction costs or the determination of what construction costs for any given project were or would be. I have never been involved in the construction of a home.
I have to say, when I read that, I was flabbergasted. This is the witness that the board is basing much of this on. And, you know, from where I come from as a longtime taxpayer, it speaks to a certain mindset that is looking for a preordained outcome as opposed to what is actually likely, logical, and fair.
And if you look at Mr. Harding's appraisal, his last appraisal was at $13 million. The house sold about a year later for $25 million. So he was wrong. He also stated that the house was on par with other houses in the community. Yet if you look at, did I say it was HE 13? It's one of the exhibits there toward the end. No, it's 17. It's the last exhibit. If you go back, you can see the comparable sales, not comparable, but the contemporary sales. And the Garden Lane house was head and shoulders above anything else selling in the area. So, you know, this isn't about bashing Mr. Harding, but he had a job to do. He was appraising the property, and when you appraise the property for a bank loan, really the bottom line is, does it appraise high enough for the loan to be issued or not? And to suggest that you can determine what the house really costs based on what a real estate appraiser comes up with is pretty far-fetched. Maybe.
Time has expired.
What's that?
Your time has expired.
I think we have about 5 minutes left from my initial presentation.
We
if
will
I may.
allow it. Go ahead.
Okay. Okay, Matt? Oh, there you go.
How you doing?
Maybe Matt can talk to what this house would cost.
Just let me,
Pardon me, sir. Please introduce yourself for the record.
Matt McAllister, I'm a builder in Montecito. You know, I built the Lowe's home, their home they live in now. I'm familiar with building. I've lived in Montecito, raised my kids there. I went to school there. I've been there 30 years. There's no way. Just hearing some of these numbers, like $119,000 to frame the house. That's laughable. I couldn't even frame a 4-car garage for that. I mean, the house no doubt was gutted down to the studs were all gone. I'm sure they had to redo quite a bit of the foundation in order to just upgrade it to get it to the earthquake standards at that time, which they get seriously difficult every year. But I couldn't even, when Rob said 10,000 square feet, if you really look at the plans and you look at the outbuildings and everything there, and they don't include the covered porches in their gross square footage, the house is really around 14,000. And it's just simple math with a house like this. It's, even if you conservatively put it at 1,000 a square foot, and it's 14,000 square feet, you can do the math there. There's obviously a big hole here between, what they're saying and it doesn't make sense. I couldn't get the house built, finished like this. I mean, there's real plaster moldings around the whole house. There's probably 1,000 linear feet of it, and it's not foam. And that's $80 or $90 a linear foot just to put it up there. A real, artisans to do all that work. This is not foam. So you probably got 80,000, 100,000 just in the molds on the house. So, I mean, that's just probably one of 500 items. It's just not, it's not doable. The plaster, the exterior plaster, they don't just put the stucco on. It's, you know, it's a 3-coat process. This would have been done in expanded metal. It wouldn't have been done in chicken wire or, it takes a special person to put the type of troweling that would have been done on this house. And then after you complete all that, you've got, you know, this English Manor look that, you know, with the paint that was, there's 3 or 4 coats in that process right there. It's just, it's, it's just, you know, you've got Vermont slate on the roof. You know, that in itself weighs a lot. So they would have had to figure something in the foundation for that, because it's like, you know, putting boulders on the roof. So they would have had to re-engineer everything down to the foundation.
And again, I just want to say, I'm just struck with Mr. McAllister's testimony being described by the FTB as general. Doesn't sound very general to me.
There's nothing, you know, everything in the house, it's just no way you can do it for $4 million. Not in that time. It's just, it would have been, they would have left the project and you know, they wouldn't have had a house. The other thing is with this is, you know, the reason they probably went through this process is it's a lot easier to get moved in if you don't scrape the house, because you probably won't get back what you had there. The county's going to go, well, you can't have this, you can't have that. They're always trying to scale things back, and the architects are always trying to shrink it and say it's less square footage than it is, because they're trying to get the owner what he wants for square footage. So there's always this numbers business that they play down there, and you know, who physically comes out and measures it. You know, 9 out of 10 times nobody measures anything from the county or, but it's simple math there. It's, you know, it's 14,000 square feet of buildings. You know, we've got an 800 square foot pool house. You've got a 500 square foot garage, 550 garage. You got a 500% guest house. You've got a carport. You've got, you know, there's also the underground, the infrastructure. It called out a 400 amp panel. I know that the 400 amps wouldn't have ran this house. It's not possible, but I know I'm getting into a lot of minutia, and really the minutia, it just boils down to the big picture of what's doable here. And quite frankly, I couldn't build it for $4.5 million, and I just got done with a house that is very similar square footage, which I won't go into the finances of that. But even if you know, say it was 14 today, and you drop 30% off of that, you're probably down at 9 or 10, and then you throw back in all the soft costs, you know, architectural fees, designer fees, you're right back up there. I just wanted to keep it short, and as for, you know, my budget being vague, I mean, you know.
If I may, I'd like to briefly address Mr. Kruckenberg and his expert report. And I've addressed part of this on brief, but briefly, he didn't use a recognized methodology consistent even with his own statements of how contractors would estimate the cost of a home. He said time and materials and subcontractor bids. He didn't use any of those. He relied on for his starting point on numbers from Mr. Harding's appraisal, and as I explained, Mr. Harding himself said you can't do that. I don't really know much about costs. I get them from somewhere else. Alone, that should be enough to ignore Mr. Kruckenberg. His process was then to make adjustments to Mr. Harding's number using Mr. Williams' numbers, which were the very numbers he was trying to discredit. That makes absolutely no sense. And as distasteful as it is to challenge somebody on this basis, it is my duty to my client to point out that Mr. Kruckenberg was telling the California State License Board that he had no employees and therefore needed no workers' compensation insurance at the same time that he was suffering tax liens for employment taxes. So clearly he had employees, and he was clearly willing to lie for whatever was expedient at the time. And it's my duty to point that out, as distasteful as it is. So again, I think Rob's point is well taken, that the focus of the FTB has been to support their bottom line number, the number that they've had since the beginning. And as I said, it really doesn't make a lot of sense here. It doesn't fit into a viable statement of fact. And what we have supporting the taxpayers' position and supporting their basis is Garden Lane itself and the majestic property that it was. Some limited financial information, but clearly inadequate. Proof that that financial information was incomplete. Early, reliable computations by professionals with no reason to fabricate and every reason to get it right, and no concerns over accuracy. Returns signed under penalty of perjury and certified by the CPA. 2 expert opinions that support the validity of the return. Property tax assessments post-sale that can be discounted back, and they support the numbers on the return. IRS records and statistics showing that they support the basis on the return. Opinions of the tax assessor employee who had no ties to this case and was really sort of serendipitous that I even found him, and he was willing to provide a letter. And he supports the idea that the actual cost of this property had to be consistent with what the Lowe's put on their return, and multiple listing service data showing that this house really did stand out from the others in the market. So there's really a plethora of information that in totality shows that this was unique. And unfortunately, we don't have the records that prove that beyond a reasonable doubt, but the standard here isn't a reasonable doubt. It's more likely than not, and I think we've shown that.
One last thing I just wanted to mention, which Sheryl and Rob, they paid their bills. You know, that there was never any problems on the site, and you know, Sheryl directed everything, and Rob wrote the checks. So usually when people are paying their bills, they pay their bills. I mean, especially on a scale of that, why would you not pay your bills somewhere else? I know them, but I just wanted to mention that.
Okay. Thank you. Does that
Lesson today is pay your bills.
Okay.
Just in case everybody's wondering.
All right. Members, there's an issue for clarification on this non-capitalized interest. I'm going to go to the appeals just to clarify the legality of that. I believe that, at least to me, that it's somewhat new. Appeals.
Yes, Mr. Chair. Under IRC Section 266, a taxpayer may elect to capitalize rather than deduct otherwise deductible interest and taxes on property. Under 163, debt incurred by a taxpayer to acquire property can be expensed. However, there is a limitation of $1 million for qualified residence interest. So, in other words, you can expense acquisition indebtedness to $1 million. Therefore, that's going to be deductible, and that they can elect to capitalize that. Anything over that would be considered not deductible, therefore not able to be capitalized and added to basis.
Okay.
Can I respond to that?
To the, yes, and then we'll.
Mr. Ambrose is correct with respect to what 266 says in terms of capitalizing otherwise deductible interest. However, that is not the exclusive way to capitalize interest. Not everything that gets capitalized has to go through 266. 266 by itself just talks about carrying charges. It doesn't even specifically mention in the statute interest, although it's understood that it applies to interest. But particularly as an example, construction period interest is actually it was precluded from deduction under Section 189, or no, it was required to be capitalized under 189. You couldn't get the deduction. But construction period interest has always been capitalizable and is capitalized regardless, even though it is not currently deductible because, for example, the Lowe's didn't live in Garden Lane when it was being constructed. So the interest had to be capitalized, it couldn't be deducted during that period because it wouldn't qualify as residence interest because it wasn't their residence yet. So interest can be capitalized apart from Section 266.
Department.
Well, I agree that mortgage interest certainly cannot be capitalized over $1 million, as Mr. Ambrose stated. There's also a couple of tax court opinions on the matter. There are a few citations here, 21 Tax Court 197 in Isaiah Medjabau. The taxpayer attempted to capitalize mortgage interest and property taxes to increase his basis, and the court rejected this argument because those expenses are not carrying charges, and sound accounting principles do not permit the capitalizing of such expenses. So it's possible that some amount of carrying charges, as Mr. Bernsley pointed out, might be deductible, but certainly not up to $2 million, which is what they attempted to capitalize at protest.
All right, thank you very much. Lawyers can disagree, huh?
That's what it's about.
Yes, they did.
Discussion members, member
I'll go first.
Harkey.
But I'm stepping up because nobody else is, but I reserve the right to come back when I have one.
Always.
Okay. Just like you guys. I have reviewed Kruckenberg's analysis, and it, in my mind, is not credible, and I base this on my past experience. What I would have looked to, I did some background research just to see what he'd worked on. It basically was pretty much homes around $500,000. Nice, some of them are nice and whatnot, but they're not custom. So I had a real problem really relying on that. We heard the difference between the guest house versus the pool house. I believe that was even discussed previously, and the master bath. One of the areas I think where I believe there's a big discrepancy is I believe, and you can correct me if I'm wrong, FTB, but that you're saying that most everything was done by 1999.
Right.
Okay. And I believe that the Lowe's are saying, no, that's not true. I think, was 1999 when you had the construction loan, were those the documents you were looking at?
No. As of 1999 is when we have the final sign-off for the building permit for the completion of the main house. I'm really talking about the completion of the main house in 1999. They did continue to do some work after 1999 and all the way until they sold the house. However, the substantial amount of work was really completed as of 1999. So, and you see that when you look at Mr. Harding, some of the narrative descriptions in his appraisals. He talks about the house being complete as of 1999 and occupied, and only the pool house finishing remained to be done. The actual construction of the pool house was done, but just the interior needed to be finished. And also a couple of other items, such as mostly outdoor items, so the landscaping, addition of decks and that sort of thing.
Right. We have documentation on the extensive amount of landscaping, and I believe that was that was a huge expense, also some of the further improvements. So what you're saying is that the main house was substantially complete, but the landscaping may not have been, the pool house wasn't done, a variety of other things, and they could have conceivably renovated, as they said, redone their master bathroom.
Right.
And added a few extras in the main house after 1999, and which I believe they are saying they did do. So
I
you
could
don't-
name those if you need me to.
I'll be with you. I'll be with you. Okay, so I think that's one of the main fault lines here is 1999 versus when the house was actually completed. The concrete estimate. Now, I happen to know, I spent 30 years in banking and corporate finance. A majority of my time was done in, helping contractors build homes, in essence. I mean, I did from large builders to small guys, depending on what level of my banking career. And it's much easier when you're doing an existing property, much easier to get pull permits if you claim that you're doing a remodel. And the only thing that needs to be up for a remodel is maybe a piece of a frame and maybe some of the concrete. But generally speaking, that's the only reason you do that. If you go for new construction, you have to, it's a whole process. It's years long. It's all the neighbors deciding what you can build again. It's, changing the footprint. It's everything. Even if you had a house that was on a footprint, if you have a lot of protests or complaints, then you may have to decrease that. So you try to keep with what you got just for the permitting process. Now, on a house like this, even though you may have left up a little wall, you probably would end up having to redo all of the foundation, if only because of the current building codes. So I think the foundation expense for something like this that also had the slate roof, they make a lot of sense. It really probably had to be totally redone. So I think the concrete estimates may be off, or maybe you're only getting piece of information from that. We heard about the Nolte renovation, at least the explanation about Nolte. Okay, again, when when the FTB mentions the Szabo report to the assessor, that was 1998, so that was his estimate at that point. The insurance seemed to be a big point of contention. What is your understanding about insurance coverage?
Mm-hmm. My understanding, and this is just, that's from speaking to people knowledgeable about insurance, is that you need to insure the property to the full replacement cost in order for your homeowner's insurance to accept, or for the bank to accept your homeowner's insurance.
And we reviewed the policy as well
Right.
in this case, and this policy called specifically for that.
Okay. Now, Ms. Lowe,
Hi,
how are you?
doing well.
Explain your insurance.
I pay car insurance. I'm no explain my
The insurance pertinent to
I
this
mean,
house.
I would defer to Mark on that because my expertise is design and overspending. So, if anything, I mean, I would imagine that what we did was insure partially. I mean, that's what makes sense. I mean, I could tell you that it wasn't based on the value of our property.
Right.
We that's clear to everybody, not to sound condescending, but, we made a decision probably based on our finances at the time, which we tend to do.
That's understandable, and as long as it was insured for the value of the mortgage,
Exactly, which
you
is
probably
what we
wouldn't-
based it on.
Wouldn't have any problem. I don't think my house is insured for the total value of the house right now,
I mean,
but that's.
you could the insurance conversation is weekly in the Lowe household, so I mean, about.
Okay,
but-
thank you.
On many things.
I won't ask this question because FTB has removed the failure to file penalty. What happened in 1999, between 1999 and when you say that you were complete with construction? Yes, you're still on, I'm sorry.
That's okay. So the question to me is what went on in
Right,
interior of
the-
the main
the-
house after we got our occupancy?
Yeah, because the big schism here seems to be
Oh, yeah.
that the FTB seems to think you were through in 1999 and you don't.
Now we're in my area. Well, to begin with, when we moved in, we didn't have the money to complete. So we left the guest house, pool house, by the pool, as a shell. Literally studs and plaster on the outside. So we did that. We redid all stone around the pool. It was grass going up to the coping. We did all antique French pavers. We did what almost made Rob very mad at me at many times was the conservatory flown in from England, the Amdega. That was built. We did the blinds in there, came through Amdega. We did the sink in there, the floor. I mean, I wanted it like a room that you could sort of eat breakfast and hang out, not just do potting of plants. Or we built an outdoor kitchen next to it. Like, you know, one thing led into another with that. And we put in custom French doors from the kitchen to the family room, which were ginormous. We redid the master, added my vanity. We redid Rob's closet completely. We actually redid my closet as well in that mix. We added built-ins in the boys' rooms. We, I mean, it goes on and on and on. We added and renovated in the screening room, modified it for new projection systems compared to when we first moved in. Oh, that's right. We did in the basement, we were having severe problems with leak, and we started to get like early stage mold. So we added a new state-of-the-art system at the time called Atmox, where they put fans in all the ducts. And I mean, it was really like state-of-the-art back then. And that was a substantial amount of money. But that was, I have a son with asthma. So a lot of the stuff that we did, HEPA filters, the organic paints, like I was saying, is that adds 10% to your cost when you take in mind that the paint was flown from here and there, and we didn't use glue in our wood floors. It was all nailed into a special kind of wood, pesticide free. And I'll look through my notes, but I mean that's just right there. That's some of it. We redid the gym. That's right. We put mirrors up on the wall in the gym. Should I go on more and more about all this decadence? But starting to get embarrassed. Oh, the tree house. Well, Rob's brother was originally going to build that, and he started, and it compromised the tree, so we had an actual professional framer come in and do it. So it started off to be a labor of love and turned into, like a house the boys could have moved
A residence.
in. Real nightmare.
Okay.
Anyway.
Okay, thank you. One last question before I cede my time. FTB, have you looked at this book? Have you noticed the finishes? Have you looked at the improvements?
I have.
Okay, there is no way this is $4 million. It just doesn't compute. So it's something other than that. I had sincerely hoped you would settle this out and not bring it back, but since you didn't, we're probably going to have to make a decision. But there is no way this is $4 million. So with that, we also received an appraisal, a letter from the appraiser, which maybe Ms. Ma can go over since it was addressed to her. So with that, I'll...
Member Ma.
Thank you. So, Ms. Harkey, I was going to address that letter later, but I might as well do it now. Joe Holland is the assessor in Santa Barbara. He has been working, he started working started working in the assessor's office starting in 1984 in the real property appraisers section, and he got elected assessor in 2002, so he's been an appraiser and assessor for 31 years. So I do value his opinion. I called him to verify the letter by Casey Crump one more time because the letter had a very big range from $800 to $1,500 for costs in the Montecito area. So I wanted him to review his appraiser's letter one more time and give me whatever last-minute opinion that he had. And yesterday he sent over the letter showing the roll during the sale in 1995, which showed that they allocated the $25 million sale price, $12 million to the land, and $12,984,684 to the improvements for the sale of the land. So that's about $13 million, and based on Zillow We looked up Zillow as well as Trulia, I think, is the two companies out there, and they showed that this Garden Lane property had 11,000 square foot. So I started doing the calculation, and based on the assessor's allocation at 11,000 square foot, it came out to about $1,100 per square foot in terms of the construction costs for the home. And that verified Mr. Casey Crump's letter that said that homes, comparable homes in the area constructed between 1997 and 2003 would go anywhere between $800 and $1,500 or more per square foot. And given that this was an estate of the highest quality, it was his opinion that the comparable construction cost would be at the upper range of that amount, which is the $1,500 range. So that's why I had reached out to the assessor just to get his second opinion on his real property appraiser, just to make sure that, you know, the numbers are in the range that the Lowe's reported. But before I kind of make my statements, I actually would like to hear from Mr. Williams. I saw your report. It is very extensive, and I'd just like to know a little bit more about your background and you know, how long you've been doing this and how you came to the numbers that you came to.
Well, first of all, I'm 73 years old, okay? And I was born in 1942. And in 1978, I moved to Santa Barbara from Kansas City, Missouri. And I've been working with banks, lenders, savings and loans as the Senior Vice President and Manager of Construction Loans. I have extensive knowledge as far as costs to complete a property, simply because I ran or controlled a fund control within the banks. We disperse funds on a line item basis throughout the construction process, from grading through landscaping. And we also did the cost analysis prior to recordation of a first trust deed as far as construction is concerned. And I did that for 11 years, opened my business in 1990, never looked back, and started my own company in fund control and cost analysis, cost estimating for any type of projects, all types of projects, whether industrial, hotels, recreation, educational projects, and also single families. My staff pride themselves in the local market, which included Hope Ranch, which is a high-end community, and Montecito. Some of the banks I work for is First Republic Bank, who is an extensive lender in that particular areas, and in those particular areas, and also 5 or 6 other banks who pride themselves in lending in a high-end market. Okay, that ranges, I say high-end market, anything over above $4 million or $5 million, they will make the construction loan. And prior to recordation of the construction loan, they would submit all the pertinent documentation to me to make sure that we have adequate funds to complete the project on a turnkey basis. We also do the final audit, okay, at the end of the project to determine the final funds, if it goes to the general contractor or the owners. And the permanent loan is then invoked as far as the owners are concerned. They pay interest only during the construction loan. I found out during my experience that the cost to complete when the loan is funded, monies are paid out of pocket by the owners, and we don't have an accounting of that. Then also during construction, if there's a change order the owners would pay out of pocket over and above the loan amount. So it was impossible to track the exact cost of any construction project, especially in a high-end market, because the owners come in and say, we want this wall changed. We want additional cabinets. We want additional built-ins and the whole bit, okay? We want additional landscaping. We want the rocks that come from China or France or whatever, okay? And so those costs are not filtered through the construction loans. And when the Franchise Tax Board indicated that this property could be built for $4 million is impossible, okay, especially in this particular market. In the Montecito area, the owners require high-end expertise for an installation of materials, okay? They pay a ton of money for the materials, and you shouldn't waste just any small iota of those materials. Therefore, you need someone on the job that knows exactly what they're doing as far as installation is concerned, especially after drywall, nailed, and tape. You're talking about crown molding. You're talking about door trim, window trim, floor tile, wall tile, and this type of thing. All require expertise as far as workmanship and as far as your subcontractors are concerned. Okay. What I did on this particular project, I went to the archives of Santa Barbara County and obtained the plans. Okay, that was my first start. Secondly, I went to the building department and obtained all of the appropriate building permits, okay? And that included the main house, the guest house, and everything that the Lowe's applied for as far as construction is concerned. Then I went to my database, okay, and I used my database only as far as references as far as location is concerned, okay? I did not use the line items or the cost, okay, for my determination. My determination was based on my expertise, okay, of similar homes that were built in Montecito and the Hope Ranch areas, okay? I've been doing this for 32 years, okay? And the banks rely on me to look at projects prior to recordation of the first trust deed, as I said before, to assure them that there are adequate funds to complete the project. I put together a cost that would be relevant to the plans, specifications, and my interviews with appraisers and the contractors in the area that build in Hope Ranch and Montecito. Okay, the problem with the appraisers' assessment is that they have a disclaimer within their report that indicate they know nothing about construction cost. Okay, and that was clear in the appraisal that were done on this, completed on this project. Okay, that's why we have experts on the cost to complete. Okay, I have appraisers calling me every week, okay, and to have conversations with me based on projects that we have in our portfolio, okay, and as far as cost to complete. They use a manual called Marshall Swift, okay, and they have adapters and adjustments that they use for certain areas, okay, and so this shows clearly that the appraisal is invalid as far as cost to complete is concerned. You can rely on market approach, okay? That is something that you appraiser is good at, okay? As far as cost to complete, they're not good at it. And I have personal friends who are appraisers, okay, and they do not rely on the cost to complete. They don't have the expertise or knowledge. They use the Marshall Swift manual, okay? The $4.2 million that was the original loan funds for the Lowe's, we don't know exactly how much money was spent. My report clearly indicates that it's the lowest amount of money that would be required to build that type of a property. Okay, and that's exactly what I did.
So were you the trustee for this loan? Because we have a document showing the project cost analysis, and the principal dispersed for the loan was 4.75.
Yes.
So were you the one that kind of helped track these
Yes,
project costs? Okay.
absolutely.
So, I think the minimum was 4.75, right?
Right.
They got a loan for,
That's the minimum.
which is higher than the franchise tax board's 4.2.
Right.
So when you start with this bank disbursement form,
That was my basis.
right, that's your basis, and it doesn't include things for the conservatory, the landscape, the pool house, architects and engineers, interior design, obviously contingency costs, closing costs, miscellaneous costs. So,
And that's why I built it in my report.
right. So
Okay.
we start with 4.75.
Okay.
And then, based on your report, your expert report, I know you concluded that your opinion that the minimum cost to construct the subject property was what the Lowe's reported, the 9.783.
Well,
That was the minimum.
I'm not aware of what they reported.
Right, but
I mean,
that's,
what did they report? I don't know.
that's what they reported on their tax return.
Okay, all right. Because I'm not. I wasn't trying to meet their request.
Oh, no, I
Yeah,
understand.
yeah.
I understand.
My report is
But
based
in
on.
your expert opinion,
Okay.
is it reasonable that the cost to build this house, right, a unique property from ground up, was 9.783, so $9.7 million divided by, I'm using 11,000 square feet, which is $889 per square foot to build this house. Is that, in your expert opinion, high, low?
That's a minimum amount.
Right.
A minimum amount to build this property. Okay, and I calculated the supervision, the profit and overhead, and a few other items within the project, within my budget. Okay, and what I did was spend a lot of time to give a accurate report. Okay, to my best knowledge and expertise on building homes, monitoring homes within the Hope Ranch and Montecito areas.
Thank you, Mr. Williams.
Just to clarify, the amount that was reported on the return was about 10.5, which was a little bit higher, so.
Okay.
So, but he testified that it was in the range.
Right. Okay, so, I mean, you do the same math. I mean, 10.5 divided by 11,000, is still
I just
on
wanted
the
to
low
be,
end
just wanted to be clear. on
of the
record.
assessor's value.
Mr. Renner.
Yeah, just a couple of follow-up. I think, I'm interested in terms of the conversations and the question have gone on before, but let me just see if I can clarify. In regards to FTB's estimates and after the construction from FTB's perspective was completed, which was the 1999 year, did you add any additional money to basis after that?
Yes.
And how much was that?
So about 3.3 million was the amount as of 1999. So the additional amount, almost $1 million, accounts for that work post 1999. And just quickly, if I might add.
Okay, go ahead.
Just very quickly, as to the $4.75 million figure for the loan amount, a significant amount of that loan went to the refinancing of the original existing loan. So only about $2 million of that loan, total loan amount, went to construction costs. The rest of it went to refinancing the existing loan that was on the purchase of the property.
Let me just, in terms of the comments that were included in the appraisal,
Right.
in regards to expertise, in regards to appraisal.
Sure.
How did, I guess I'm questioning as to how it is that your contractor reflected those adjustments in their estimates.
Right. I think it might be best if Mr. Kruckenberg respond to that, if that is all right.
That would be fine.
I'm not completely clear on the question.
The question is that my understanding is that you used a lot of the basis for your numbers on the Harding appraisals. And within the Harding appraisals, he comments in regards to his inability to accurately create value for some of the finishes and the construction of the home. So my question is, how did you then adjust when that, based upon what the appraiser said he was inadequate to be able to do?
What I relied on from that report was more so square footages, scope of works, the finishes that he mentioned, things like that. I didn't necessarily rely on numbers that he had come up with. I relied on what he...
But he said he wasn't capable of doing the finishes.
But he was capable of explaining what they were. At the time we were doing our bids, we had very few pictures, and I was basing my numbers off of the plan set. The plan set shows a remodel of an existing structure.
You never went into the property?
No, I've never seen the property.
Nobody, none of the experts.
Okay, I just check.
So I based everything off the plans. What I used Mr. Harding's report for was descriptions of rooms, descriptions of finishes, things like that.
I guess I'm confused because in his report, he said he wasn't capable of commenting value on some of the finishes.
Again, I'm not saying I relied on him for values. I relied on him for description of finishes because I hadn't seen the home.
But isn't his values based upon? He came up with some values, but then he was undermining his own statement of values based upon the fact that he said he wasn't capable of adequately assessing, valuing them. So my question is, did you do any adjustment to yours based upon the fact that he said he was not capable?
I did all of my own numbers based on his descriptions of certain things in the home. I didn't use anything that he put a value to. I put my value to his descriptions. Basically looking at the plans, which again are called out as a remodel and a less than 10% addition to an existing structure. The permits validate that as well. His report basically described things for me, things that I didn't see because I was unable to see the house. So that's what I used his report for.
Okay. Let me ask you in regards to Mr. McAllister. FTB has kind of, I guess, generally referred to the home as, I forgot the phrase, but basically it was, I don't mean this demeaning, but in terms of an ordinary upscale construction in the Montecito area. Is that close? I can't remember exactly your words.
Yeah, I mean, I think what I was trying to convey is that it was on par with the other estate quality homes in Montecito.
Let me just ask, you're a contractor, have built apparently many homes in that area. Where was this home in terms of its uniqueness?
It was on a different level, for sure.
Can you speak up to the mic there?
It's on a different level. It's everything about the home. There's, plans are 70% complete when you get them, and there's another 30% that go into that house that's not even on the plans. And if you build those homes, you're already going to know when you bid it. Like, for instance, the floors. They don't want to hear anything in the house, so everything's cast iron. The water, you don't want to, the floors are 1.5 inch concrete upstairs everywhere. Then there's probably 2 or 3 layers of cork. Then in between the floors, you might have wool insulation because they don't want and then there might be quiet rock underneath at $50 a sheet. So there's a lot of things that you see a set of plans, and there's
And
just,
I guess in reference to this particular home, though.
Yes,
This would not be what you would think of, again, there's a whole lot of high-end construction in Montecito, obviously.
yes.
And
This would be on the other end.
this would be on the high end of
Yes.
the upper end.
Absolutely. I mean, the picture says 1,000 worlds. You can tell just by looking at the detail on it that it doesn't look like a McMansion. You can see, you could
A
come down to.
McMansion, that's.
You can see
I got that.
McMansions when you look, and you can see the foam molds, but just when you look at that, and if you have an eye, you know just looking at this home, just in that picture, which says 1,000 words right there, but it's a stunning home.
Okay.
It's beautiful.
So let me go back to Mr. Kreckenberg then in regards to that. Given the basis of that description in regards to the difference between that home and what we would think of as the ordinary extravagant homes that we would find there, how did you value that?
I actually see the house as what I would call museum quality.
Mhm.
And I have built these homes. Unfortunately, I don't know where you didn't find those. Built homes up to
Go ahead,
21,000
just
square
keep talking
feet.
to me.
I've built homes up to 21,000 square feet in Rancho Santa Fe, Napa Valley, Santa Rosa, currently building in Pacific Palisades. I'm in plan check actually in Montecito on a house.
And as
I
a
don't-
contractor, you believe you could have built that home on that museum quality for the $400 and some odd a square foot?
No, one thing that I want to make clear.
Well, hold
is-
on, let me ask you, that's
Yeah.
what my question is.
Right, I want to make clear that I never said $400 a square foot. There's a different standard when you're doing remodel construction as opposed to new construction.
Right.
And to put a square foot value on remodel construction is hard to do because there's certain components, i.e. foundations and lower level framing, that are not part of that plan.
Right.
And on the plans that I was looking at when I was putting my costs together, the foundation system says existing.
Yeah, right.
The lower level exterior walls say existing.
Right.
So there's a room addition section in the middle on the second floor. There's a 300 square foot pop out to one side.
Right.
You can't put a full square foot value on that because it's two different types of construction.
But
It's
you end
not
up, but
new
you do end
construction.
up, you end up with the total value, and then you can divide it by the square footage.
You do.
And then that ended up being around $400 and some odd a square foot.
Right, but there's two different things we're talking about here. One, we're talking about building the house.
Yeah.
Two, we're talking about what the plans say. And that's what I put my number to.
You,
Is a remodel and renovation.
So you did your plans based upon the plans, not necessarily the construction of the house?
That's what Mr. McAllister said. He did his.
Okay, I'm
numbers
just
on as
checking,
well,
I'm just checking.
Based on the plans.
Based on the plans, not on the real values of the house.
Well, if this house was actually taken down the sticks and there's a new foundation,
Right.
there would be another set of plans. There would be a different set of permits. There would be structural engineering involved.
Right.
None of that stuff is produced. I don't see any permits outside of a remodel room addition permit. So
Okay.
to assume that that was done, maybe it was. I don't know. It certainly doesn't indicate that on the
So let me
plans.
go back to the question. Given the quality that you see in this house, and I assume you've seen some of the materials and you know the house then by
Seen some,
description, not by the plan, but by description,
Correct.
would you have been able to build that house for $400 a square foot?
No, but I never said that.
Okay, you couldn't, I'm hearing you say you couldn't
Build that
do
house, no, I could not.
Okay. Okay, thank you very much.
Sure.
Let me, I guess the bottom line for me, I guess I'll summarize where I'm at, and that is I find the FTB's numbers to not be very believable. I somehow I feel like they were trying to target a number and trying to get there in whatever way they could. And so that troubles me in this particular issue. And the frustration for me is that it brings us to this idea of us determining value. And quite frankly, I don't know how to do that. I don't know what this stuff is. I don't know how much some of the finish is. And so it really seems to me that, I guess as I look at my role here, if the government can't bring its argument in a credible way, to which at least I'm having struggles with right now, then it seems to me I have trouble figuring out what I would believe the number would be, and would lead me have to then believe what the taxpayer said. Because I must tell you, I find the taxpayers' witnesses much more compelling in regards to both experience and what it is that they were there, and then actually their involvement during the construction process. So I guess that's where I find myself right now.
Member Stower.
Thank you. I have questions for both parties, but before I start, to appeals, I believe the appellant's representative cited RSC Section 189.
Yeah, that's
I'm
been
unable to
repealed.
retrieve it. Can
I looked it up. It was repealed in 1986.
1986?
86.
Replaced with 2 263A.
Okay, I'll look that one
Would you
up.
look that up too, and let me know what it says and how it applies to the tax years that the appellants constructed their property? And
Let's-
then we'll come back to you in a minute.
Do you want me to address that?
No, I want the appeals to address it.
Okay.
Thank you. Okay, where do I start? It's 12 o'clock. Franchise tax board first. I believe in your October 29th, 15 supplemental briefing, you indicated that you were willing to consider a construction cost per square footage of $488, adjusted, and then reduce it to $436 based on the appropriate index. What do you view as the appropriate index, and how did you get to the $488?
Okay. First, I just want to note that the 488 was a calculation error. So what that was supposed to indicate was the average price per square foot of the 5 sample properties that Mr. Williams provided to us at the last hearing. I went back and looked at that and had an FTB auditor look at it with me, and we concluded that the average square foot price was $600. And yes, we are willing to consider that. Now, the appropriate discount factor, we determined after consulting with an FTB economist, would be either the building cost index or the construction cost index. And those indexes reflect the changes in construction costs over time in the Los Angeles area. So we believe that that index is a little bit more appropriate here rather than just national housing cost index, as appellants have used. And I'm sorry, what was the second part of that question?
So you're telling me that it's actually 488, the average from those 5 comparables that we did receive, and using one of these indexes, are you at 436? Or are you at a different number?
I'm sorry, we're at 436.
You're at 436 when you
Using one of the
index it,
indexes.
and you're using your index, and you're using a 1999
Right.
fancy dancy number.
That's right.
And there's a dispute on whether or not we're at 1999 or we're at 2001. Okay. Just wanted to get clear on where we were at, if we index it all, if we use a square footage. So we have 5 comparable properties. Well, Mr. Williams, I'm a little confused now because I thought the 8 comparables that was referenced in your Exhibit D of your report, which is Appellant Exhibit 7, in our handouts today. If you go to Exhibit 7 and then go to Exhibit D, you list those 8 properties, excuse me. I thought you used those 8 properties to get to your most likely cost of $9 million. But did I understand you today that you did not use those 8 properties?
Yeah, I didn't use all 8 simply because 2 out of the 8 was not available. I couldn't find the data, within my database.
So you didn't use them, but did you use them in 2011
But
when you did your estimate?
Yeah, when I did my estimate, I used the comparables as far as location is concerned, not so much as cost per square foot. I made adjustments on the 6 that I submitted to you, and I did those on a basis of adjustments for swimming pools. Some of them had swimming pools, some of them did not. Some had extensive landscaping, some did and some did not. Some were spec properties where they were the owners were speculators. They bought the land and built the property on a speculation basis. Some were owner builders and the whole bit. So that is the difference between the overall per square foot. Some of the adjustments I made was concerning the high end versus the I would say the average home in Montecito.
So when you say you made adjustments, do we see the adjustments in your actual report, or is that someplace else? Because when I read the report, I just get to the bottom number. And then when I received the 5 comparables that you were able to obtain, I'm still having a hard time how you got to your estimate number. I mean, I had asked for, show me where in the record you made the adjustments, and to this date, I'm looking for some kind of a schedule showing that property one was X amount, and then you adjusted it up and down based on what you think were the differences in the properties, and I'm not seeing that. Am I not going to see that? Is that, am I misunderstanding how you did your report?
No, that is something that you can have. I mean, but the thing is that the bottom line is that the cost per square foot that I gave in my report, okay, was based on my expertise, on the square footage, the plans and permits that were obtained, and my review and conversations with the appraisers and the local contractors.
Okay, I understand.
Okay,
So-
so the bulk of my report was based on those items I just mentioned, not the comparables.
Not the comparables. So, I understand that. Maybe I misunderstood what that report represented, but I would take that into consideration. But I do want to focus on the comparables that we did receive. And I don't want to disclose anybody's address, so I'm going to try to, if you go to Mr. Williams' Exhibit D, and you go to the comparable, which I believe is number 4, street address starting with 700. It has a total project cost of $17.8 million and a total building cost of $8.3.
Okay.
My first question with respect to that, and I guess with all of those, and we know, at least on the report, we have a long analysis dated 2007. So for that particular property, do you know if it was built in 2007 or if it was built at some time thereafter?
Well, if the documents show 2007, that means the loan was in progress. It was in progress. Okay.
Okay.
In 2007. Okay.
So the loan was in-
And you're talking about the,
Yeah, I was trying not to do an address, but
Well,
yes, that's
yeah.
exactly what I'm talking
Okay.
about. So the loan was in progress in July 2007.
Yeah.
And construction was, I'm going to make the assumption, had started. But is it reasonable to conclude that construction was not completed at the end of 2007?
well, the documentation that I gave you, that indicated exactly what stage the construction was in.
Well, the documentation that you gave me, I have a long analysis package with a lot of redacted dates, although I asked for my dates not to be redacted on the August board member inquiry.
Okay.
And then I have a disbursement request from the contractor where the dates are, again, redacted when he submitted his application. So,
But it also indicates the dollar amount that's requested.
yeah, but
Okay.
my question is, I'm more trying to get to when was this project completed?
Okay.
Not the dollar amount. So, and are you in a position to say when it was completed?
Well, no, I'm not.
Okay. Okay, that's fair.
Yeah, I couldn't tell you.
When I go back to the actual calls, let me go back to my
Okay,
notes.
if you go back to that document, okay?
Uh-huh.
Okay, the disbursement request by the general contractor or owner, okay? Does it give a date?
No, it's redacted.
Okay. Does it give a percent complete?
It says, original project is 69% complete.
Pardon me. Ms. Stovall.
Okay, I mean, I don't know. I mean, I asked, but everything was redacted twice. But
okay.
that's okay, I'm okay with that. I
Yeah.
respect that you may not know, and for
Right,
privacy
sure.
reasons, you redacted it, and I respect that you wanted to
69%.
redact, we wanted to protect the property owners, and that's perfectly fine.
Okay.
Okay, so I'm good with that. I just want to understand the numbers that I'm looking at.
Mm-hmm.
And so when I look at the numbers, if I on that one particular project, it's 7.8 million in project cost. So, am I correct to assume that this is what we're the cost for this particular owner to construct their property, whether it was new or remodeled?
Yeah, the
Okay.
$7.8 million represent the loan and any soft costs related to that particular project.
Okay.
Okay, it does not include monies that were paid prior to recordation of the first trust deed or monies that's spent after. Okay, so the $700,000, $7 million is a cost based on loan amount.
Gotcha. So
Not
it's
cost.
Not actual, wherever the owner is actually put into.
Spent.
Okay,
Okay.
perfect. FTBD, did you use that 17.8 million when you got to your average cost per square foot?
Yes, I believe we did so.
Okay.
Did.
I'm just trying to make sure that everybody's on the same page on if this board was to look at square footage, we got some numbers here. But I do want to stay on that property because Mr. McAllister, on the disbursement of that, you're actually, I think it's your corporation is listed as the construction company.
Yes.
And then I guess, do you have any experience with this property? Do you have any idea when it was completed?
2009 and a half.
2009. 2009 and a half.
Exactly, in June.
Okay.
Pretty accurate.
And so for that particular property, it's about 1,300 per square foot
Yes.
to complete.
And that's for a property that, the landscaping, it looks like, a a golf course.
Do you think it's comparable to the property, the Garden Lane property?
Yes, extremely similar.
Great, thank you. And then to the appellants, and let me know if my research is wrong, but I did a public research check, and it indicates that you guys were the owner of that property. Is that accurate?
That's correct.
Okay.
That's where we're living.
That's where you guys are currently living. Okay. Reproduction costs. I'm looking at, and this is to the Franchise Tax Board. I'm looking at the Harding's 2003 appraisal, and I realize that Mr. Harding did a declaration saying that he's not a construction expert. But he did come up with a reproduction cost of $5.2 million. Did you guys consider that, is that the same reproduction cost that Mr. Kugenberg looked at and made adjustments to?
That's correct.
And he made downward adjustments?
He made downward adjustments based on the date of the appraisal, so it was a couple years after the work was completed, and also based on the fact that the reproduction cost considered a brand-new build, kind of from the ground up, which is not what we had here.
Okay. Did you guys consider the site improvements of $760,000?
We did consider that, and that was one of the items that I stated in my presentation, that if this board were inclined to allow additional amounts, that would be something to consider. So, including that plus the 5.3 would get you to something like 8.8 per total basis.
And I know you, maybe, just tell me where in the documents you have verified the architectural fees and the design fees?
Sure. Well, one was the attestation, Mr. Nolte's attestation, and the next place that I saw it was in Mr. Williams' report, and I believe it was page 10.
What's the amount? I guess you could just help me out a little bit more.
Sure. Under other costs, professional fees, architectural and engineering, it says $358,638.75.
And design fees, is that a combined number?
It's a combined number, architectural and engineering.
Mr. Burnsley, you provided an estimate starting with Mr. McAllister's number.
Yes.
Give me the exhibit number.
My analysis is Exhibit 9.
Okay, where are you getting the interior design fees of $870,000? How are you getting to that number?
That was from Kyle Irwin's declaration, which is Exhibit 10.
So that's based on his declaration where he said, had he been the main designer for the project, he would have charged about $960 to $720 at one phase, and then gone to an hourly rate for the second phase.
That's correct, because that's the basis of this analysis is to take what the estimate is of what it would cost to build today, using all of today's numbers and today's people, and then discount that back. Now, it's interesting that we didn't know prior to this, or I didn't know prior to this, but Mr. Irwin also indicated that he had done work on Garden Lane. And the significance of that, again, is that when you look at the line items for the documentation that was available, the only designer that was revealed in the documentation was Lafayette Arvin. So the conclusion was that whatever was paid for Lafayette Arvin, assuming we could peg that number, that was the design fee. But clearly that's not the case, because we now know that Mr. Irwin was another designer that provided services and design services, and we didn't even know about that. And so that's one of the difficulties with this case, is that when you have a number, there's no way to know how much that number represents of even that category. So, but more specifically to your question, that's where the number came from.
That's where it came from. Okay, I had a hard time following it, but I think I understand, because I did do a quick math, and it looks like it's the numbers that he provided, or what his range, the average of those two numbers, plus 30,000 for what he indicated he actually charged the Lowe's for his designing service during the time.
Something
frame.
along
Yeah.
those lines. I don't recall exactly, but
you
that's
were
where it
just-
came
you were
from.
just where it's coming from.
Right.
I was just
Mhm.
struggling with that number.
Right.
But I understand you're not saying that's a verifiable design fee number, that's just one of your ways of.
Oh, that was actually spent on Garden Lane?
Yeah, you're not saying that at all.
No, we have no idea.
We have
and
no
that-
idea of how much was spent, because we have.
That's right.
missing records.
And one of the things about a construction project is when you make a budget, you have however many line items. It could be, I don't know, 50, 60, these guys, the experts can tell you how many line items could possibly be there. So you have a budget of what you think is going to be spent. But the reality is that when it's all said and done, this number might be higher, this number might be lower, money's moved from here to there. So what is actually spent at the end of the day can look entirely different from what's budgeted at the beginning of the project. So when you look at any given line item and say, oh, in reality, this number was actually lower, that may be true, but a different number could be higher. So to reduce the bottom line total based on a single line item is to assume that every other line item on the list is absolutely accurate, which is an absurd and unrealistic assumption. So, you can't really look at it on a line item basis.
I understand that. To our experts, Mr. McAllister, help me out in your business. When you do a budget and you're seeing that it's going to cost more, do you go back to your client and say, we budget $5 million, it's now looking like whatever the number may be? And do they have to sign off, or is it?
Yes.
That's what I thought.
Yeah, you just don't keep running along like you're the bank and, the builder's the bank and we'll just figure it out at the end. Every step is, we talk about it and, of course, we talk about price and keeping budgets under control, but invariably they always run high. It just, they do. Some of it's unexpected and some of it is homeowner one, and it's usually about 50-50 there with, why things increase. But it's usually what the homeowner wants.
Yeah. So then, Mrs. Lowe, I have a couple of documents, and this is probably why FTB is struggling with the numbers. We have the budget report from your actual contractor, Mr. Sweet, and he initially budgeted like 1.7, which was, and he even said in that budget, it's going to be, the budget is low. So I think he recognized in 1997 that what he was estimating was not going to be true. And then I have a letter from the bank dated June of 1998, when they are telling Mr. Harding to go back out and appraise the property, and basically says that there has been substantial changes, and let me make sure I quote him right. The cost to complete the project is underestimated, but at that time it was 85%. And on this letter, they're saying 4.2 from various loans, mainly from the bank, and then 1.2 coming from you guys to complete, for a total construction cost at 5.5. But the argument is that's really more like 10. So did you
And
get
you
any?
see the amount of years in difference from when they said that to
Right.
when we actually sold the house.
Right,
I
so-
mean, when you live in a house, things come up that you want to do, or I would say, me, when I lived in that house, I knew when I moved in, I still had a lot of work to do. And then as I lived there, certain things I wanted and desired, I did. And some of it I did without my contractor, and some of it I did with him.
So that's what I was going to ask you. Did your contractor say you are exceeding what we budget? But what you're telling me is that you knew what you wanted, and you
My
said-
contractor knew definitely probably not to say that to
Okay.
me. He would be like,
Okay.
big trouble.
I'm still there 5 years later on the house that she's in now.
I was going to make a joke about that, and I thought I probably
So,
shouldn't. But
It's, there's things all the time.
I just called Matt and said, I want to build onto the closet. And he was like, I'm hanging up on you. So.
Okay. Must. Appeals? Any luck on those statutes for me?
Yeah, I don't think it applies here. 263A, the title is Capitalization and Inclusion in Inventory Costs of Certain Expenses. And it says that it applies to property produced by the taxpayer or acquired for resale. Real or tangible personal property produced by the taxpayer. However, there is an exception. For personal use property, it says the section shall not apply to any property produced by the taxpayer for use by the taxpayer other than in a trade or business or an activity conducted for profit. So I don't think that has any application here.
Right, and that is a deduction disallowance section. It is not a capitalization disallowance section.
Okay. Okay. Oh, 30 minutes. Not bad. Where I'm at, I mean, I agree. We have a lot of data here.
You guys can have another.
It's a very difficult case. Unfortunately, I know FTB won't speak to settlement. That's not within these attorneys' previews. But unfortunately, an agreement that the parties could not come to an agreement. Before I go there, Cohen rule. What does the Cohen rule tell us appeals as far as applying estimates?
Well, Cohen just basically says that if there's evidence that there were expenses incurred, then and there is no original documentation, you make an estimate based on the best available evidence. And if there's any doubt, if it's questionable, then that question is basically against the taxpayer. You don't give them the benefit of the doubt. In other words, the taxpayer, that is.
Weigh heavily against the taxpayer, I believe the court.
Weigh heavily against the taxpayer, correct.
Can I speak to that? Because I think the cases say, excuse me, it's weighed heavily against the party that caused the loss, which in many cases is in fact the taxpayer, but it doesn't have to be. And in this case, The Lowes did not cause the loss. They were a victim of this, just like the system was. And their actions fell below no standard of duty, no standard of care. They didn't lose the documents. There was nothing they did to cause the loss of the documents, and there is nothing they could have done to prevent the loss of documents. In fact, they did everything that was entirely reasonable that they could do under these circumstances. So,
Okay, I understand. My final question to appeals. The letter that was provided to Ms. Ma regarding the assessed value of the land and assessed value of the improvements for the 2005 sale. How does that relate to cost to construct in 1999 through 2003?
I don't think it does relate to it. It's the fair market. I'm sure that's the sale price, and that's based on fair market value, which is, as you know, we heard today many times, it's an entirely different number than the adjusted basis, which is based on cost of construction and associated costs. So, I mean, it might be some kind of a guide, but for purposes of this appeal, I don't think that it's really a very reliable indicator.
May I weigh in on that?
Member Harkey.
I'd like to weigh in on that. Usually, when you've got this much of a discrepancy, it is the value of the land that has increased, and especially in Southern California. The fair market value of the land usually goes up. The cost of construction is pretty much fixed, It's, so I would beg to differ there.
I agree.
Okay.
Okay, I think I finished. I think we're at the point where we're just going to have to apply a reasonable estimate.
Okay. First to the appeals, thank you very much for the clarification of the law as it relates to non-capital expenses. The board is placed at a serious disadvantage here of having to use our past experiences to come up with values, and but it is where we are and we find ourselves. The reality is experts will always agree. Since you guys didn't bust out into laughter, so you didn't really get the joke there. All of these experts sort of disagree for various different reasons, and I get that. I mean, part of me kind of wants to go through these different estimates and so forth and speak to what I find the credibility of it. Let me just say from the beginning, I think all of the appraisers here and those who have done the appraisals are credible people. What I find that is different here is the source of their information and how they're making their calculation. In the Williams estimate, the calculation was based on the actual plans, and much of what wasn't finalized by the time he saw the property and made his estimate. Therefore, his estimate would be flawed. The estimate provided by the FTB is just unreasonable relative to just the plain sight of what happened here. And so that in itself says to me that the Cohen rule is applicable and is the only direction that one of the directions that we can go in trying to determine what the actual cost was. To the appraisal that we received, it is informative to me, but it's not directive to me, in that the land value has increased almost 500%. I agree with Member Harkey that the actual cost doesn't change, but the appreciated value will change relative to the time that the cost occurred. And so having a $13 million allocation to the ultimate market price, if you recalculated that would take you down to even a lower number as far as the cost relative to what the FTB is claiming or the Lowe's claiming. So I don't find that useful. in making this assessment. And so, so we're somewhat in the catch-22. The Harding appraisal, his disclaimer, I think is normal. I mean, the estimated amount that he provided was actually somewhere between $2 million and $5 million because of that disclaimer when they go in and they basically say, listen, I didn't build this thing. I'm just an appraiser. I'm just out here on behalf of the lender to tell you what I think the value is at the point in time that I'm here. The other challenge that I think we're faced with here is it appears that the FTB's number of $4 million is just too low. And so we're in a catch-22 in that regard. And for a number of reasons, the value seems to be established in 1999. I think the Lowe's testimony is creditable in that they continue to do improvements to this property, and therein is where we have the challenge. The other challenge that we're faced with is $6 million worth of source documents missing and not being able to recreate those documents. It seems to me that the accountant, Mr. Zobo, I believe, had his challenge even at the time of recreating these documents, and just threw his hands up and said, I can't justify this number and I can't recreate it. This is the individual that I presume prepared the return. So he can't justify the returns himself, and he prepared the returns. So again, putting us at a even more of a disadvantage. The other direction that I'm mindful of is taking a look at the actual evidence that was provided that we could see. Clearly, the accountant had made a number of errors in their calculations. They had actually claimed expenses that were not, that you couldn't claim, that you couldn't capitalize. So there were a number of expenses in there that should not have been capitalized, which is indicative that the accountant made an error in capitalizing expenses. So the number on the return is wrong based on the fact that he made mistakes in capitalizing expenses, which takes us to the discussion about whether non-capitalized interest can be included and deducted. I don't think it can. I mean, I don't. Based on my read of the law, that it shouldn't be deducted. I mean, I agree with Appeals, our lawyer, that it's not deductible, and therefore, if I was just simply to take the $13 million claimed and subtract the land value of $2 million, then subtract the $2 million non-capitalized expenses, and then adjust for the error in just reporting errors of claiming expenses, which no fault of anyone here today, certainly not the Lowe's, adjusting for the expenses, it still takes me down in my calculation to somewhere around $7 million is where we would, I would have a real problem in allowing the full amount on the tax returns, because there's clear evidence, not speculation, not estimates, not appraised values. There's just clear evidence that it was an error. There was an error in computing. It included draperies, it included security monitoring expenses, and so forth. But I don't want to sit here and kind of go over the errors that the accountant made. You know what I mean? I don't want to go through all of that. And unless there is, I'm going to.
May I be heard?
I had a meeting. Excuse me. I had a meeting, but I'm going to go back and review this law as it relates to the non-capitalized expenses. But I've been researching it, and I just can't find any body of law that would allow you to have deducted those non-capitalized expenses to the tune of $2 million. So that gets me in the ballpark of somewhere around $7 million, just on the actual evidence that we have. Forgetting about these estimates, but saved by the bell. But you wanted to share some thoughts. Please
Yes,
do.
you made a couple of statements that I don't think are accurate. There were documents that were provided to the FTB that had items disclosed, but there was, that would not be capitalizable, but there's no evidence that those were included in basis. In addition, I agree that certain interest is not deductible. That's a very different issue of whether interest should be capitalized. The current deduction of interest, there are several sections in the Internal Revenue Code that restrict the current deduction of interest. None of those sections address the capitalization of interest. The only section that's been around a long time is 266, that goes back to at least to the beginning of the 1954 code, that addressed the tension between deducting interest and capitalizing interest, and essentially said you can't deduct interest if you capitalize it. It, as well as Regulation 1016-2A, coordinate with each other. One says if you deduct it, you can't capitalize it. The other says if you're deducting it. One says if you deduct it, you can't capitalize it, and the other says if you capitalize it, you can't deduct it. But the sections we've all been talking about are deduction limitation sections, not capitalization limitation sections.
Okay, so I'd like to give the board's lawyers a chance to kind of review that and figure it out and come back and tell us what their conclusion is in that regard. The challenge is that you're disagreeing with what your accountant is. The accountant that provided these, or someone provided these schedules.
Well, he did,
indicating that. My apologies. Indicating that these are the schedules of the items that we took in consideration, and they're not reflected as expenses. They're reflected as capitalization. But so we've got these conflicting arguments within the experts. The accountant, you're in conflict with them, now in conflict with the appeals.
If I
Appeals
might,
look like they're
Mr.
itching
Chair.
to say something.
I don't know that I disagree with Mr. Burnsley. I was just, stating the law. He brought up 189, and, we looked it up, and it didn't, or it's repealed.
That's right.
We don't know the numbers. I believe it's in the protest hearing officer's report, but I don't have at my disposal right now the numbers that they were, the interest amounts that they were claiming, and whether they had already deducted those. I just don't have that information.
Well, let's see if
But
we
I'd
can,
certainly be able, if we can get that.
yeah, let's see if we can get it so you can take a look at it. That would be, I think, helpful to all parties here. Member Harkey.
I think more to the point is that we've got a lot of estimates. We have a lot of estimates, and we know that the FTBs is not accurate. So I'm tending to go along with the taxpayer in this case, because Szabo, even though he submitted documents, he did not have all the documents. These were the best he could contrive. So you can't really say that everything on there was actually factual. You can't say that everything that was submitted by this gentleman was actually factual. They all are trying to extrapolate something that they didn't have, which is why we're here on Cohen. And as for the land and improvements value on the assessor, even if you discount back the 13 because the assessor increased everything by 2% per year from whenever this was completed, and if I discount it back by 5 years, I'm still only deducting $1 million from a $13 million cost, and they were paying taxes on $13 million. They were paying the taxes. So I guess I'm having a real hard time going back to $7 million because we all know, just looking at this book, that's more than $7 million. And so we're stuck with all these estimates, and there's really, in my mind, no estimate better than what the taxpayer originally had, because time has gone by. We can't resurrect all of it. It's been through years of examination, years of producing records, years of trying to, and books and and everybody's testimony, and I feel like they made a reasonable, or they followed the law, they paid the tax, and I would really have a hard time going back and slamming them for more after all of this time and all of these records were produced, because I think they made a reasonable effort to try to get the data that we're looking for. And I think the capitalized interest is one thing we'll have to look at, but they were paying taxes, they were paying property taxes on the 13 million when they sold it, on 13 million of improvements. So discounting that back to whenever, even if you go back to 1999, you're going to come up with more than a $7 million improvement cost. And I know that you're not supposed to be using sales price and whatnot, but if in fact you're taxing improvements, that's improvements. The rest of it's attributable to the land. So that's cost of improvements.
This
So-
is the, as I do these calculations in my head, I don't know that we're all that far apart, but the appraised value is allocation of the selling price. And adjusting the selling price back 2% would get you to what the selling price theoretically would have been at that point that you make the adjustment, which one would presume would be a relative markup on that. And so what I was basically saying is that the markup on the land was almost 500%. And so to calculate that, you would presume that there's an increased value from the cost. I mean, even if you built it today and turned around and sold it tomorrow, you're going to sell it for, there's going to be a markup on the cost. And so the $1 million adjustment in the selling price using the 2% ratio would take us back to the selling price, but not necessarily the cost. My apologies, sir. It was just a statement. Member Ma.
So I would, is my mic on? My mic on? Yeah. So I would just like to piggyback on Ms. Harkey. I'm looking at your 2005 tax returns. You had an extension granted to October 16th of 2006. Your CPA signed the tax return on 10/12/06 within the extension time. I'm looking at all the numbers. There's no like estimate or just number thrown in. And so I assume when he did the sale of your home calculation, that the basis that he put down was based on some number that your business manager gave to your CPA to put on the tax return, to file your tax return. So I'm just, echoing Ms. Harkey's statement that, given, it's hard to recreate documents 10 years later, your tax return was filed on time. The numbers do seem credible. The IRS did not audit your tax return, and based on, the consultants that we have, the people who have been building in the area, the assessor's letter, in my opinion, just leads me to a comfort level that you did provide the right numbers to your accountants. You signed your return under penalties of perjury, and that you have been good, upstanding citizens, paying taxes since you were 15 years old, not being late. We did check in with the Franchise Tax Board to see if you had any, other issues over the years. And so, I'm actually comfortable with the numbers that were on your tax return.
Okay, just point of clarification, if I may, members. The $7 million that I came up by adjusting the non-capitalized interest plus the presumed errors, if you add back the land value, the number's at somewhere around 10.8 million as far as the deductible amounts. This is what I meant by, if you take these various different calculations that we're making here, we all seem to come in right around those numbers. But I certainly appreciate my colleagues' view in that regard. Further, and would request an opportunity just to research this on this non-capitalized interest, just to come to some resolution in my own mind. I'm going to go to the department on non-capitalized interest. I've heard from everyone else. Your thoughts?
Yeah, my thoughts are that, well, certainly we know that mortgage interest may not be capitalized. It's only deductible because of a special provision. And all we know was that at protest, Mr. Szabo claimed that about $2 million was mortgage and construction loan interest. So he didn't separate it out by construction loan or mortgage loan interest. So we don't even know what part of that represents construction loan interest, that apparently it's possible it may be deductible. I disagree that it is deductible. I think that it would only be deductible if it were associated with a trade or business, which it's clearly not. It was personal construction loan interest here. But I'd be happy to research the issue and provide some additional information on that.
I don't think we're afforded that time.
Oh,
So,
okay.
all right. Further discussion, members?
Move to take the matter into submission.
Member Stowar moved to take the matter on submission, second by Member Runner. Without objection, members, such would be the order. Thank you very much for appearing before us. We truly appreciate your patience with this process. It's been a long, laborious process. We certainly appreciate your honesty as well in bringing forth the information as you saw it. Members, let's take a 10-minute break. Okay, members. Okay, all right. Both ears are hearing different things. Members, let's come back at 2 o'clock.
I'm good for 1:30.
Oh, I'm just. What are you good with? Come back at 1:45, and everybody ought to be able to get everything done within that time.
All right, come back.
You know, it is. You're right. I much prefer a cup over drinking out of a bottle. Which makes me feel like it.
Welcome,
It's like
welcome
your
back,
house.
members.
It's like your house, isn't it, girl?
No. Maybe the guest house is. Members, let us reconvene the meeting of the Board of Equalization. Ms. Richmond, what is our next matter?
Our next matter on today's agenda is item F, public hearing. F1, proposed amendments to sales and use tax regulation 1525.4, manufacturing and research and development equipment. And we do have someone that wishes to make a public comment.
Thank you. Members, we have Ms. Teresa Tomei with the Fiscal Policy Director for the California Taxpayers Association. Would ask that she come forward after Mr. Tucker makes his opening remarks.
Yes, I'm Bob Tucker with the board's legal department. We're here for the public hearing for proposed amendments to sales and use tax regulation 1525.4, manufacturing and research and development equipment. This is the public hearing regarding the proposed amendments clarifying that taxpayers may substantiate the useful life of property using a warranty, service contract, or industry practice. This is the opportunity for the board to adopt these amendments. However, there's been a recent development. A letter was received from Department of Finance, and Department of Finance has some objections to these amendments. Ms. Kirsten Shelton, the program budget manager for Department of Finance, issued in her letter, expressed some concern over these amendments. One, objecting to her statement that she believes the board has overstepped its delegated authority. And the second objection relates to the economic impact statements that were provided for these amendments. As in regards to the first statement about overstepping an authority, the staff recognized that Revenue and Taxation Code Section 6377.1 may be interpreted by some as ambiguous and potentially inconsistent with its drafting. It was understood that the perceived ambiguities, that with these ambiguities, reasonable minds could differ. Staff indicated that if the board agreed, in the light of the entire statutory scheme, that the legislature intended to make the partial exemption available for these items with a useful life of 1 year or more, subject to approval by the Office of Administrative Law, the proposed amendments would address the issues raised by Caltax and effectuate such a legislative intent. However, DOF believes that, DOF meaning Department of Finance, means that has said that the board is required to prepare a standard Form 399, which the board did prepare. However, we prepared it as having no fiscal impact because we believe the fiscal impact is covered by the enacting statute. They have stated that they think that, in their opinion, that there is a significant fiscal impact, and we would be required to amend such standard 399 and required to obtain their concurrence in the assessment of some impact, or the impact before the publishing of the notice. They have also said that based on their interpretation, they believe this would result in a major regulation, which means it would have an impact exceeding $50 million in a 12-month period. We did not believe it was a major regulation, and accordingly, we submitted the standard 399. As a result, OAL may not approve, and this is the possible consequence, OAL may not approve the agency's proposed regulatory action if it determines that the agency failed to substantially comply with the requirements to determine the fiscal impact of the proposed regulatory action or prepare an economic impact statement for the proposed non-major regulation or the SRIA, which is the major regulation. In general, and I don't mean anything to demean OAL, but OAL doesn't have the experience that Department of Finance has. So we would expect that OAL would, in all likelihood, take and look at DOF's expertise at assessing the economic and fiscal impact, and weigh that heavily when they make their decision. If the board chooses to adopt the proposed amendments during this hearing, then it is it appears that OAL may not approve such amendments. And as a result, this is based on their reliance on Department of Finance. At this stage in the rulemaking process, if the board has concerns about the Department of Finance letter, the board can decide not to proceed with the proposed amendments and publish a notice to that effect in the California Notice Register. And that would end the current proposal to amend Regulation 1525.4, but without affecting the board's authority to amend the regulation in the future. The board cannot withdraw the regulation at this time from OAL's consideration, which was discussed in the Department of Finance letter, simply because it hasn't been submitted to OAL yet. Unless the board actually adopts the proposed amendments and submits the completed package to OAL, at that time, if they were to change their mind, then they could withdraw. But it's simply not feasible to withdraw at this time. Accordingly, if the board chooses to adopt the proposed amendments and submit the rulemaking file to OAL, there are a couple options that would exist. If it's submitted to OAL and OAL disapproves the proposed amendments based on any grounds, then, and most likely we would anticipate it would be based on the DOF letter, OAL must provide the board a written opinion regarding the disapproval. The board would have 10 days to file a written request for review of OAL's opinion with the governor's legal affairs secretary and have OAL's opinion reviewed by the governor. And OAL's decision would become final if not appealed within that 10-day period. However, in this case, if they do actually disapprove the proposed amendments, it's our opinion that, in all likelihood, we do not think that an appeal would be fruitful or that it would result in the governor's office overturning OAL at this point. That's simply our interpretation. However, ultimately, it's for the board to decide how they want to proceed at this point. And at this point, I will hand off to Ms. Tomei.
Thank you. Thank you very much.
Good afternoon, members. Good afternoon, members. Thank you for the privilege to provide testimony on this issue, and thank you again for your ongoing continued leadership on this issue, as well as the dedication and hard work on your staff since the legislation was passed in 2013. There are a couple important points I'd like to address. The first has to do with the board's authority. The board is fully within its vested authority to make regulatory changes to provide taxpayer guidance on this issue. And that's simply what the proposed amendments that your board has looked at, has drafted with our cooperation. This is a matter in which taxpayers are asking for an interpretation on an ambiguity that is apparent in the statute itself. If you interpret the statute the way that is currently being interpreted, then it provides an inherent conflict of two provisions in the statute itself. The way that the amendments specify the interpretation would be to allow taxpayers and the Board of Equalization to administer the statute the way it was intended by the legislature. So within those parameters, to provide guidance to taxpayers, to provide guidance in the administration both to the Board of Equalization staff and to taxpayers, that is fully within the power and the authority and the responsibility of the Board of Equalization. The second point that I'd like to address is the economic impact. When this legislation was moving forward in the legislature, this was part of a three-part plan. The governor's plan was to eliminate the enterprise zones, and with the elimination of the enterprise zones, to replace it with three incentives. The biggest incentive is this manufacturer's exemption. Excuse me. The other two incentives have to do with the hiring credit as well as the California Go Biz Competes. The intent was to have these three new incentives be revenue neutral to the elimination of the enterprise zones. Finance's own estimate of all three to become revenue neutral was a minus of $750 million for the enterprise zones and a plus of $750 million for all three components. By Finance's own estimate, as indicated in the floor analysis when this bill went through the legislature for final vote, Finance's estimate was that taxpayers would be allowed to use $486 million of this exemption. To date, the utilization based on the interpretation of that statute is 25%. Our petition is to ask for simple, clarifying, interpretive language to provide taxpayers with the guidance necessary in order to give them comfort to use this exemption. That is what the board did in August when we heard this issue. We ask currently now that the board transmit the regulations to the Office of Administrative Law. That is because we disagree with the Department of Finance assessment that the economic impact is a cost increase. When Finance's own numbers were $486 million, we're now using, or taxpayers are being able to utilize a little bit over 25% of that. It's unclear how that can be, quote unquote, a cost increase. Therefore, we're asking for additional time to work with the administration towards resolution, and by doing so, we request respectfully that the board transmit the regulations on the proposed amendments to the Office of Administrative Law to allow us that time. We've also requested a meeting with the governor's office to work with him on how to ensure that this proposal is revenue neutral, consistent with his economic plan. We're trying to improve the manufacturer's exemption in California and make California more competitive. With that, I thank you for your consideration and for your time.
Thank you very much. Discussion members? Member Runner?
Yeah, just a quick question on when do we, what would be the timetable that we'd assume, I'm sure it's probably in statute, that OAL has to review this?
Off the top of my head,
Okay.
I have to check back. I apologize.
Okay, I
It's-
just wondered if, again,
Perhaps 30 days.
Okay. I mean, I guess my view here is that I think what we clearly have some interesting discussions going on in regards to our authority, in regards to definition of economic impact. I do believe, and again, if people recall back when this was a debated issue in the legislature, this whole idea of that number was a very hotly contested issue because they were trading one economic stimulus for another one, and it needed to be in the total dollars were part of that package. And so it seems to me that I don't think there's anything wrong with us looking at that as the number in regards to the economic impact, in regards to the fact that this is below that and this is not a new additional $50 million that all of a sudden we're going to impact. The other side is I would be concerned that we fully, unless the board would decide that we are actually not moving in our authority, I would assume that it would be best for us to truly move out and continue in this direction and let OAL and finance make their statements. And if at the end of the day we do our due diligence and we thought we were okay, and they choose to somehow determine that we were that these are needed, well then that's fine. But I'm concerned about us kind of stopping our process when it is that we have an opinion letter that's been kind of, not an official opinion letter, but a letter with an opinion in it from finance telling us to go ahead and withdraw or hold on that issue. I also think it's important, it seems to me, that as this is a debated issue, that by moving forward with it, we do give Caltax a chance to go ahead and have conversations with the governor's office, which is not necessarily equivalent to finance, and help them go ahead and determine if there's a path that they can then find and as this regulation move forward. So I'm supportive of us moving forward with it, and I think it's within our authority, and then let's just see what the next part of the process holds.
Ms. Stowell.
Oh, no, sorry. I do have a comment. Just for the record, I still object. That's all. It's moving forward. Right.
Member Harkey.
This is a question for Therese. If we get the same response back and you need to run this statutorily, are you going to be fighting a steeper uphill battle by carrying this forward now?
I don't believe so. I think that having the proposal move forward signals from the BOE that on a policy basis, not on the procedural or, what finance thinks, that on a policy basis, the Board of Equalization supports being able to implement this piece of law the way the legislature intended it to. And I think that would add to and help our legislative process as opposed to being a detriment.
Okay, so you feel it's additive and that, we thought it was within our purview, so.
And we agree.
Thank you.
Members, at no point do we want to minimize our authority, which was pretty much what Department of Finance would be asking relative to their inquiry about our authority from my perspective. The Board of Equalization has the authority to make recommendations. We recommend legislation, and the legislation goes to the Office of Administrative Law, and if they sign off on it, say we're not doing anything we shouldn't be doing, then it goes into play. The challenge that I have here is that the Department of Finances has raised a technicality, and I'm just interested in either one of you responding to that technicality, that this may be a major regulation, that there may be Ms. Tomei has already shared her thoughts, but the department, there may be a cost factor, economic cost factor, where you're able to at least inquiry of our economists to see. I think the concern, if I just may sort of put my 2 cents in, is that not that it increases the projected costs relative, because only 25% has been consumed. We are, to some degree, expanding expanding the definition to some degree to allow more people to actually utilize this, which is a wise thing, I think, on our part. But in doing so, it may actually increase the usage, hopefully, and increasing the usage may result in this additional cost factor that the Department of Finance has put forth. So there's a question there and a statement. Mr. Tucker?
I'll do the best I can to answer. Initially, we determined that this was not a major regulation simply because we looked to the enabling and enacting, statute. And so we looked at the costs being associated with the statute, not with the regulation. So that's why we determined that there was, at the point, zero impact. We did not look at it from the perspective, as the DOF letter points out, that it would be a major regulation, because we didn't attribute any cost to anything other than the underlying statute. However, if we were to do such a review, it's something, it would be new for us. We have not done so historically. We've simply looked to whatever the enacting statute was and attributed the cost there.
Yeah, members, it sort of seems to me that the Department of Finance has put a poison pill in there with that major regulation language. And so the Office of Administrative Law, relying on the Department of Finance, believing that it is there, with that poison pill in there, is just going to deny it. And so even if we go forward, we're going forth knowing that the odds are pretty good that Office of Administrative Law is going to follow the Department of Finance, and not assess whether or not we are right that this is not a major regulation, because we have not put forth any economic numbers saying that we believe is not. So at a minimum, we ought to say that based on something, we believe that this is not a major, that the cost estimate by the Department of Finance is high, or doesn't exist, or is non-existing, or something to that effect, so that, that, I think, positions us to at least call into question this technicality. We don't call it into question, it stands as the Office of Administrative Law's reality, and it gets denied, and basically we're poking the bear in the face for, and I can't find a reason to do that at this point.
We would also be working with the Department of Finance and the Governor's Office primarily to address that issue as well.
From the timelines, is there a way that we could put this over to give them time to talk to the governor's office, or?
We put in a request as soon as we found that the issue has been that we were not informed of Finance's objection until very late last week. So as soon as we found out, we put in a request to meet with the governor's office. The governor was out of state yesterday and has just returned to the state today. And it's a matter of getting folks who are out of town to come into town as well. So we are awaiting the scheduling of that.
Now,
But we think moving forward would be to have the OAL, because they do have, to transmit it to OAL because they do have 30 days. And we think that within that 30 days, we can work towards a resolution.
And you would be having this conversation with the governor's chief of staff, Ms. McFadden?
Yes.
She's in town. I think I spoke to her maybe last week. So she's in town. And you never had this conversation with the governor before on these particulars?
No, because frankly, this was a surprise to us that finance would come in, number one, a budget agency to question the legal rulemaking process, which is primarily the jurisdiction of the Office of Administrative Law. To our understanding, this hasn't happened very often. I don't know if it's ever happened in the past, and so it's a surprise to us. We weren't informed about it until recently, and so as soon as we found out, we put a call in and made a request for a meeting with Ms. McFadden.
Now, based on your experience, do you think it's a surprise to the governor's office?
I don't know that the governor has knowledge of this, or even the front office of the Department of Finance. Based on my reading, the letter is pretty technical. It's signed by a PBM, which is somebody who's not in the Capitol office, in the Capitol itself. It's Finance's budget staff, although a manager level. So I don't know that it's risen to that level.
Okay, thank you. Member Runner?
I was just going to ask, typically, this can't be the first time that we've had to move forward with a regulation that had a amount of money that was budgeted, or a piece of legislation that had an amount of money attached to it, over $50 million. In the past, when we'd have similar dollars like that, a piece of legislation that had dollars attached to it, did we ever have to do the economic impact in the past?
For example, when
Yes.
we implemented the regulation itself, 1525.4,
right,
we put it forth as zero impact.
Okay, so that to me is the point. To me, that's a key point, because again, we moved forward with that without having triggered any economic impact. The dollar amount in that legislation was
$486 million.
So again, it seems to me that this is a different kind of a call, and that we're being asked to make here, and inconsistent with what we've done in the past.
Well,
go ahead. I mean, let me ask.
I would agree. It's, as I said, when the initial regulation went through, it was with zero economic impact.
And then we weren't required at that point. Obviously, we weren't
it may
required.
not have been required at that point, but it's consistent with our view that the economic impact falls back.
And our
on the
regulation that
statute.
we're doing now is basically still
it's an amendment
creating
to that
amendment to that particular item. I guess the thing that would make sense to me is if indeed our amendment to the regulation was going to go over the $450 million, then it would seem to me that's an interesting discussion. But right now, we still believe that we're within the amount of dollars within the statute. Okay.
It's consistent with how we've done it in the past.
Okay, thank you.
Just to, my view from a historical perspective is that historically, none of our regulations have an economic impact greater than what was conceived in the original legislation. So it's always been zero. And it would only be more than that if, in fact, our actions is causing a greater liability on the state. And whenever that occurs, 50,000 or not, the legislature is going to say you're acting outside of your authority, because that's a budgetary thing. And that's what the Department of Finance is saying, is that you've got an excess. We don't know how much, but we believe you have an excess of 50 million in which the governor and the legislature has allocated by virtue of this regulation. And so,
I don't think they're saying that. I don't think they're saying that they believe that this $50 million is over the $400 million.
what does the experts think?
I don't know what finance is actually saying, except that they believe there's a cost impact to it.
Right.
But they
And-
can't. I mean, not to create a colloquy, my apologies. If the Department of Finance is saying that 50 million is within the 490, they can't object. It's not a major regulation. It's just an amendment to an existing
I
regulation.
think the chair has hit the core of the
Yeah.
discussion.
Yes, and that's why we would like the opportunity to discuss further with, the governor's office on what it is, because the first year, based on finance's own number, in the bill analysis for the floor statement, they estimate 486. But in the second year, which we are now in, they estimate $521 million of utilization. And the
Wow.
utilization will increase in year 2 and 3. But we won't reach those targeted numbers that finance put together unless there are some clarifying of the ambiguities. And when we're a quarter below, or excuse me, 75% below that target, it's unclear how that is a cost increase.
Well, let me ask, can I just follow
Yeah,
up on
sure.
that? I mean, again, in the opinion of Caltax, do you believe that, that moving forward with this amended regulation is going to put us over the amount that was in the original legislation?
Absolutely not. This is one small fix. There are other barriers. I believe that when the legislature looked at the numbers, it was based on numbers that we had to get on the data that was available, and the data that was available was based on the MIC. When California had aerospace industry, we had a much larger tech industry. We're not sure that the factors that were discounted in order to derive these estimates took into account that many of those aerospace industries are no longer in California because the federal government's cut back on its defense budget. Many of those tech companies have relocated and expanded outside the state. So we think those numbers are overestimated.
Thank you.
Okay. Further discussion, members? Is there a motion? Remember,
Oh, well, I was just going to say, I
Well-
agree. I mean, when we pass legislation in the legislature, sometimes it is not clear, and this is under our purview. And I think to assist taxpayers in trying to figure out if they qualify or not, I think that is within our purview. I also agree with my colleagues that this does not increase costs. This is just clarifying who can and can't file within the guidelines of taking this credit. So I'm also a little bit confused on why this would increase costs when 25% of the fund is being used right now because there's so much confusion out there.
yeah, I agree with you guys. The challenge I'm having is that they've created this technicality, and if we don't, maybe Mr. Tucker, is there a way that we could at least challenge that by indicating that we believe based on maybe during this time period, we could have our economists take a look at it, or have some authoritative body within the Board of Equalization so we can expedite it, that we believe that this clarification will only allow, is consistent with what the legislature prescribed relative to the overall cost.
My understanding is that a challenge would come after it's been disproved by OAL, and that's when we'd have the 10-day period. I'm not aware of any means to do so during this process.
I would move adoption of the proposed amendments.
It's been moved by Member Runner, second by Member Ma. Objection noted. Ms. Richmond Calderon.
Mr. Horton?
No.
Ms. Harkey? Aye. Mr. Renner?
Aye.
Ms. Ma?
Aye.
Ms. Dowers?
No.
Motion carries. Thank you very much. Appreciate you, Mrs. Tomei. Mr. Tucker, thank you. Ms. Richmond, what's our next matter?
Our next matter is item B2, Maria Phillips, Santamaria-Del Campo, and Michael Del Campo. Please come forward. Ms. Phillips is not here today, so Mr. Del Campo is.
Okay. Mr. Thompson, would you please introduce the issues in this case?
Yes, good afternoon. There's only one issue in this case, and that's whether respondent erred in denying innocent spouse relief to Ms. Phillips.
Thank you, Mr. Phillips. Welcome to the Board of Equalization. You have 10 minutes to make your presentation. Upon completion, we will go to the department and allow them 10 minutes as well. I believe there is no need for rebuttal in this case. And so please commence with introductions.
Thank you very much. My name is Mike Del Campo, actually.
Okay. Mr. Del Campo, could you pull the mic a little closer? My
How's that?
apologies.
Is that better?
Yes, sir.
Okay. Me and my ex-wife made a mistake using the CPA that we did. We had no idea he was going to commit fraud, but we both made that mistake together. She was right by my side for every decision that was made, from our first meeting with him to writing all the checks over to Mr. Strawn. She handled everything with our finances, from paying rent, car payment, and credit card payments, all the way to gifts during the holidays, as you can see by the cash checks that I provided during the process. When we finally separated in 2008, she had left me with about $1,100 in debt, as you can see on Exhibit 4A, although she claimed in her statement to you that I actually incurred debt in her name and ruined her credit. I went back to my old bank when I first got the information that said she claimed that I was in charge of our finances, to request as many checks cashed as I could, knowing that they would all be signed by her. I have included those checks, only one of which was signed by me. That's labeled 2A, which was for rent. In the whole year of those checks, that is the only one that I signed. They were all signed by my ex-wife. There's also the check right below it, 3A, that was actually made out to the CPA in question here, Ron Strawn, when she said she had no idea how it was handled and that I handled everything. You can see in the email correspondence that I provided on 1A and 1B, which were Maria's instructions to me during the time we were having our taxes amended. You can see she's pretty detailed. Taxes are in the mail to the Franchise Tax Board. You need to type a hardship letter so we can discuss the payment plan once he gets the taxes, so let's get working on that. There's a bill for $500 for the amended tax returns. 2008 is only for you, so our portion together is $400. I'll mail him $100 this Friday for a payment. Basically what I was trying to show here is that she's in control. Unfortunately, that part of the reason our marriage isn't working or isn't together anymore is part of that. But you can see she was well aware of everything that was going on during the process. I provided the signed check from her to Summit, which was Mr. Strawn's company, as well as an email from her explaining what we need to do to get them amended with her CPA in 2010, which we were separated at that time. I was a little bit unsure of using him, as she had met with him prior to meeting with me, or prior with me meeting to him, so it was her CPA that did our amended taxes. You can see on the instructions that she wasn't really the type of person, or she's not the type of person to really just sit by and let me make the decisions. She also included in her letter that she was never told that we owed any money. As you can clearly see in that email titled Taxes in Court, she clearly starts with taxes are in the mail to the Franchise Tax Board. You need to type a hardship letter so we can discuss a payment plan. She knew all along there was going to be money owed, and she's trying to do whatever she can to get out of that payment. If what my ex-wife is saying is true, I'd accept responsibility on my own, wouldn't drive all the way down here and listen to how rich Rob Lowe is, to go through all of this. I would take care of it. I would make my payments. As you guys can see that I'm making my payments right now, and I have been for quite some years on this. I just believe if you granted her equitable relief, it places the entire debt on my shoulders, and we both should be held equally responsible. Thank you very much.
Members, let us go to the department. The department has 10 minutes to make their presentation. We ask that you commence with your introduction for the record.
Thank you. Good afternoon, Chair Horton, members of the board. Marguerite Meunier for Respondent, Franchise Tax Board. Diane Ewing is my co-counsel today. The tax years at issue are 2004 through 2007. The taxpayers, Mr. Del Campo and his former spouse, Ms. Phillips, filed timely original returns with California that were accepted as filed. And in May of 2010, FTB notified them by letter that they had claimed deductions related to an investment that FTB had determined was a tax shelter, and the letter advised Mr. Del Campo and Ms. Phillips that to avoid tax shelter penalties, they could file amended returns to report the additional tax, interest, and any accuracy-related penalty that might be owed. And if they did that, they could avoid tax shelter penalty. So they did. They got their amended returns on file in early 2011, and in late 2012, Ms. Phillips requested innocent spouse relief. Since the liabilities reported on those amended returns were not paid when those returns were filed, she requested innocent spouse relief, and only equitable innocent spouse relief could be considered because the debt was based on a self-assessed liability. She was not qualified for innocent spouse relief. FTB properly denied it. The equitable innocent spouse statute is patterned after a corresponding federal statute, and FTB then looks to federal guidance, and there's a specific revenue procedure to tell us how we should evaluate an equitable innocent spouse request. There are 3 components to this guidance, and the first one is what are called the threshold requirements. You might think of them as prerequisites. You must, as the requesting spouse, show that you meet certain conditions or prerequisites, or your request cannot even be considered by FTB. One of those requirements is that the tax that you want relief from has to be attributable to the other spouse. In this case, she would have to show that the tax is attributable to income earned by or attributable to Mr. Del Campo. We know from federal wage and income transcripts that are in the record that for these tax years, anywhere between 30% and 60% of the federal adjusted gross income they reported on the returns was earned by Ms. Phillips. So at least with respect to that portion of each year's debt, she's not even entitled to be considered for innocent spouse relief. And for the remaining portion of each year's debt, it is her obligation as the requesting spouse to establish that the tax is all attributable to income earned by Mr. Del Campo. Now, he has indicated in briefing that he has filed that he was employed during those years, so certainly a portion of each year's tax liability would be attributable to his income, but we don't know what that number is. So FTB's position is she has not met that threshold requirement and therefore is not entitled even to be considered for equitable innocent spouse relief. However, if your board were to find that she meets that threshold condition, at least with respect to a portion of each year's tax debt, the next component of that federal guidance asks us to determine whether she has met 3 conditions that would afford her streamlined relief with respect to that portion of the liability. She's met one of them, but not the other 2. The one she has met is that she and Mr. Del Campo were divorced when she requested relief. The other 2, which she has not met, has not established, are that she would suffer economic hardship if relief were denied, and that she didn't know or have a reason to know that these liabilities would not be paid when she signed those amended returns. The documentary evidence that Mr. Del Campo has supplied, the emails from June and July 2010, which was about a half a year before these amended returns were filed, show certainly that she understood they couldn't pay those additional liabilities. And so she emailed him and she said, hey, I can pay X dollars per month. I need you to write a hardship letter to FTB. We will include it when we send these amended returns in. And hey, how's it going with the hardship letter? And he writes back, do you have some samples for me? So the evidence, the only evidence on the issue of knowledge is that she did know that the liabilities would not be paid when she signed those amended returns. So she's not qualified for streamlined relief. The third component of the federal guidance tells us to consider 7 enumerated factors and tells us, based on the facts of each one of our cases, how to weigh them. Of these 7 factors, only one weighs in favor of relief, and that is the marital status factor. There are 4 that are neutral, and 2 factors weigh against relief. One is the knowledge issue. There's a knowledge factor. We have to consider whether she knew or should have known that the liabilities would be paid when she signed the amended returns. And as I've discussed, the documentary evidence establishes she knew, and that, the revenue guidance tells us, weighs against relief. The other component, and our view on it, is different from what it was when we filed our opening brief because of information that we've received since that time, has to do with the compliance with tax law factors. The revenue guidance asks us to consider whether the requesting spouse has been compliant with tax filing and payment obligations. Since the time we filed our opening brief, Franchise Tax Board had to issue a filing enforcement notice of proposed assessment against Ms. Phillips. It became final. She never filed a return for that tax year, 2012, although she did pay the liability referenced on the notice of proposed assessment. And both at the federal and state levels, she filed her 2013 returns late and paid late, and therefore incurred late payment penalties, both from the Internal Revenue Service and from the Franchise Tax Board. As of yesterday, both those liabilities for the late payment penalties remain outstanding. In sum, she hasn't established it would be inequitable to relieve her from responsibility for these joint debts. There are two other potential avenues for relief I want to touch on briefly, and one I know, Mr. Runner, is near and dear to your heart, a court-ordered relief in a dissolution. It is possible that in a marital dissolution, a court may order partial or full relief to a spouse, even though a joint return was filed. And an order must contain certain information and be based on an agreement or a court determination that the liability is to be divided. In this case, the marital settlement agreement that was filed with their dissolution, in their dissolution action, a couple months before they filed the amended returns, is silent as to the issue of taxes. There's no evidence that they intended to allocate any responsibility just to one or the other in part or in whole. So she wouldn't qualify for court-ordered relief. And the final avenue for her is a state statute that would allow relief from payment for joint debt, tax debt, and that has two requirements. The first is that the tax she wants relief from be attributable to income earned by the other spouse, and I've addressed that earlier in the context of equitable innocent spouse relief. The other component is she has to show she didn't know or have a reason to know that the debt would not be paid when those amended returns were filed. And as I've said, the evidence is clear on that point. She knew and had tried to address it ahead of the time those returns were filed. So, for the reasons I've discussed, FTB's denial of relief was proper on all counts. I'd be happy to address any questions. Thank you.
Thank you very much. Discussion, members? Hearing none, is there a motion? Member Storer moves to take the matter under submission, second by Member Harkey. Without objection, members, such will be the order. Thank you again for appearing before us. The board will take your matter under consideration later on this evening and send you a written report of our decision. Ms. Richmond, what's our next matter?
Our next matter is item B5A, William R. Dobkin and Donya Dobkin, and B5B, Deborah M. Dobkin. Please come forward.
Mr. Eppolite, would you please introduce the issues in this case?
Good afternoon, Chairman Horton, members. This is the continuation of the oral hearing which began back in February. The issue before the board, rather unique for today's calendar, is determining the adjusted basis of a personal residence. I would have the board pay attention to the hearing exhibits submitted by both parties today. Appellant's exhibits, the declarations, and then the Franchise Tax Board's calculation that I think will be rather useful today for the members to look at. I would note that since the last oral hearing of this matter, appellants have submitted declarations from Mr. Muirhead, Mr. Woodbury, and Mr. Treffery. And as a result of that, in a memorandum dated November 6th, the Franchise Tax Board has agreed with appellants for the basis of the land of $1.8 million. So the amount of the land is no longer in dispute. What we are here down to is determining the adjusted basis of the improvements. The Franchise Tax Board based its calculation on the 1993 Dwyer appraisal, which was a replacement cost new, $2 million for land and $2 million for the improvements. The Franchise Tax Board applied a construction cost index adjustment to arrive at $1.7 million. And in addition to that, added pursuant to the declarations from Woodbury and Treffry, $158,000 for windows, and then the $38,000 for the installation of those windows, such that at this time, the Franchise Tax Board's adjusted basis for the improvements totals approximately $1.9 million. I would also note that from those declarations and earlier declarations as well, we are looking at a property with 8,000 square feet and an estimated cost of construction, I believe, of $350 per square feet, which pencils out to 8,000 times the 350, which would be $2.8 million.
All right. Thank you very much.
Good afternoon.
Please be advised you have 10 minutes to make your presentation. We would ask that you commence with your introduction for the record.
Good afternoon. My name's Joseph Budd. I'm the attorney for the Dobkins. Seated next to me is Dr. William Dobkin, one of the appellants. This case has some of the similarities of the Lowe case earlier, but not really. This happened in 1988. This house was built in '88. And Mrs. Dobkin retained boxes of all the documents and receipts and everything until the house was sold. She then jotted down what the figures were and discarded all the trash from the house, including those documents, which she had held at that time for well over 20 years. She was here last time and testified about that. When I was hired to represent the Dobkins to try to come up with what they said the value of the house was and to find support, I tried several things. I looked for the builder, Mr. William Merrill. I couldn't find him. I hired an investigator. The investigator couldn't find him. I then hired, then I went to an architect and asked an architect to try to find valuation. They said they couldn't possibly do that for me as far back as '88. The architect who had actually done the drawings on this house was deceased, and his records were nowhere to be located. The second investigator I hired finally found Mr. William Merrill, who was residing in Florida, doing some building but semi-retired. I contacted him by telephone and asked if he remembered this house, and he said yes, he did. I asked him if he still kept any records or had any indications of what he built on this house or knew anything else about it. And his statement was that was over 25 years ago. Of course, no, I don't have any of that. And I said, I at that time thought I probably struck out. And I said, then I suppose you can't really help me very much on what it cost to build this house. Oh, he says, I know exactly what it cost to build the house. And what's that? He says it was $350 a square foot, which was outrageous for that point in time. But I kept a running track of it, and that's what it was. He then signed a declaration. The copy of that declaration is attached to the documents you have, and I attached that just so they'd all be in front of you. You wouldn't have to look at them in a brief. But William Merrill, at that point, I prepared the declaration for him, sent it to him, and when I sent it to him, if you look on the second page, on paragraph 10, I originally worded it for him that these $350 per square foot charges did not include deck improvements, expensive cabinets, etc. He called back and said, I can't sign that because there were several things that I did include in that figure, at which time I put him in touch with my secretary and I said, you work it out with her, what you sign and what you won't sign, have her change it however you need it to be changed and send it back to me, or send it back to you, and he signed it. He indicated that the $350 per square foot charges included the decks, the deck improvements, the custom cabinets in the kitchen and other areas, including garage, wine cellar, darkroom, electrical window coverings, built-in sound system, oversized water heaters, built-in bookshelves, chandeliers, carpeting, and finishing. That was
a major difference, but he remembered that 350 exactly. I thought I was out of luck when I contacted him. He says, no, I know what it cost. It was 350 a foot. After our last hearing, I made further attempts to locate other people who might be able to help us with the valuations. I used your suggestions as well. I was able to locate the broker who introduced the properties to Dr. Dobkin, who was able to say that he recalled that the purchase price was $1.8 million and the state has conceded. Secondly, I attempted to contact the insurance broker that the Dobkins had at that time and did locate the broker, but the broker said he would have no records at that time and no clear recollection whatsoever on what kind of insurance coverage there was on the property. I then was able to also find, based on a name that I got from William Merrill and from Dr. Dobkin, was able to find Royce Woodbury, who was a constructor of windows and doors out of Pasadena. I contacted him. He said, gee, you know what? I did buy a program that can get me into things from my old computer. And he found a bill back from May of 1994 of what he actually charged for windows and doors. Through him, I actually came up with the subcontractor who was able to tell me that he worked on the property. His name is Dennis Treffery. He charged $38,000 to install those windows and doors, but when I questioned him about whether he knew what it cost to build the house, he said it was real expensive. I asked him if he remembered the square foot charge. He said no, but he knows it was more than $2.5 million. His declaration is signed. The third person that I talked to was Kevin Muirhead, who is a real estate broker. And the real estate broker, interestingly enough, said, I'd rather write you a letter on my own letterhead, and which he did. And he told me, and he put that in here to some degree, that he remembered how expensive the house was. He lived 2 doors down from it. He walked through it almost daily. He saw all the expensive things that were being put in the property, and he recalls clearly it was the talk of the island that this place was costing $350 a foot. Finally, that cost does not include the items that Mr. Merrill listed in his document. That doesn't include the cost of an architect, and William Dobkin will briefly talk about that. It doesn't include the cost of the television or kitchen remodel or outside lighting or landscaping. And Dr. Dobkin will testify about all those. It looks like it does include everything else. If you look at William Merrill's declaration, it includes things that I would not have otherwise expected to be included. You heard testimony from an architect a short time ago or from an appraiser who said that an appraiser's determination of the replacement cost of property really isn't based on much. That's kind of an estimate, and I would say that's true. Number one. Number two, however, at the last hearing, you heard testimony from Dr. Dobkin about the excessive cost that he incurred to put in 3-car garage and some rooms subterranean, and that I believe he testified, if he didn't, he'll testify now, that cost him $500,000. Well, that would not be part of replacement anyway. That's after a fire, your foundation in your basement remains. However, that appraisal was an appraisal done for Dr. Dobkin's loan. Dr. Dobkin at that time was attempting to get a loan to pay off the loan on the properties. The owners carried back the loan on the properties. He paid $300,000 down. They carried back $1.5 million and agreed that they would be repaid after he borrowed money on a finished house, and that was the purpose of this appraisal. It wasn't to do anything other than to support the small loan, relatively, that Dr. Dobkins was looking at that point in time. In William Merrill's declaration, his telephone number was listed there. It was listed there specifically so that the Franchise Tax Board that had that declaration could call him and discuss it with him and find out exactly what he told me. He had no question about what it cost. The telephone number for the real estate broker is listed on his letter, and it's listed there, and I told him he may very well get called by the Franchise Tax Board, and if he did, I certainly couldn't tell him what to say or have any objection. I don't believe either of those people were called, and I think William Merrill's declaration is not refutable. We would have him here as a witness if he didn't live in Florida. With that, I would call Dr. Dobson just briefly to testify regarding those few items that I asked. Number one, can you talk about architect?
The architect, I think, took us somewhere 6 to 9 months. I think typically, I don't remember their charges, they were typically like 10% or so the construction costs plus miscellaneous costs. So I think they were probably in the neighborhood of $200,000 to $300,000. Similarly, landscaping for the house, again, I wasn't involved with it much. My ex-wife was. She listed it at $250,000, which seemed reasonable. I didn't know the cost either when we were here last time, but it was fortuitous that we actually found the builder. So unlike the case earlier today, where they were guessing what things were, we actually found the guy who built the house. And just similar, just as an aside, just my current house in Newport Beach is appraised at $15 million. The structure's appraised at $1 million, even though it cost $7 million to build. So just to show you what variation there is in appraisals, not only of independent people, but for the state. So like I said, I came here last time just to show you what we thought the price of the house was. We didn't know exactly. I think we discovered a lot more since last time. The Franchise Tax Board wanted you to believe last time the lot was $100,000, which I said it was what it was, which is verified at this point. So we were just trying to show what seemed like a reasonable value. And I think based on the data that my attorney was able to discover and the builder was able to provide you, it seems like a reasonable assessment of what it cost to build the house based on the actual numbers.
In addition, if I could, as I said, he bought the lots for $1.8 million. He paid $300,000 down, and the owners carried back $1.5 million, which was paid in '92 when he borrowed the money. I believe, and I didn't do the research on this, I didn't realize it was an issue, but I believe that it's proper on the land itself. That's not mortgage interest. The interest on the land itself is proper to be capitalized into the cost of the land, and that's what he did with the $225,000 interest only that he paid until the sellers of the real property were repaid. Is that correct, Dr. Dow?
I believe so. Thank you very much for your testimony. We'll now go to the department. The department has 10 minutes to make their presentation. We'd ask that you commence with your introduction for the record, please.
Good afternoon, board members. I'm David Gemigan, representing the Franchise Tax Board, and with me is Ron Hofstall, also with the FTB. As the board's aware, appellants in these appeals sold the Long Beach home at the height of the real estate market in 2006 for $6,300,000. The issue in these appeals is what was the taxpayer's adjusted basis in their home at the time it was sold. That's to say, the cost spent in acquiring and constructing it, so the gain, which is the sales price, less adjusted basis, can be calculated. Appellants in these appeals filed their income tax returns separately from one another. Just to recount some of the primary facts in this case, Deborah Dobkin had failed to include the sales price in the home's adjusted basis on her tax return, although she reported those items with respect to 6 different sales of Microsoft stock for an aggregate amount of almost $1 million of sales, with information pertaining to those stock purchases occurring in 1993 and 1994. Moreover, Dr. Dobkin did not report the sale of the home at all on his return and reported $0 of taxable income in that year. Appellants continue to maintain, at the hearing appeal, they built a home in the 1980s at a cost that exceeded the $6,300,000 sales price that appellants obtained for their home at the top of the real estate bubble in 2006, and they sold the property at a loss, notwithstanding Ms. Dobkin's earlier tax returns that provides just enough information to discern the property was sold for at least $1 million profit. Furthermore, there's a question as to why only a $300,000 purchase price was assigned to the land. Appellant's original representative, Scott Myers, a CPA, in a letter to the FTB during audit, specifically stated that Ms. Dobkin and her ex-husband, William Dobkin, purchased the land and built the home without any mortgage in 1988. This prior statement, asserting a lack of a mortgage for acquisition or construction, is very different than the testimony that Dr. Dobkin gave here in February. In addition, the Los Angeles County Assessor's Records Office stated in its 1987 sale sheet information at the heading of sales price, the property's sales price was $300,000 of full value. These representations by appellant's representative, coupled with appellant's earlier failure to provide documents, underlie respondent's prior position. As you know, Ms. Dobkins also destroyed the home cost records in 2005, 2 years after she agreed in writing in her divorce agreement that she and Dr. Dobkin would each be responsible for reporting 1/2 of the gain on the sale of their home. And also I'd like to address the representation of, first of all, that they were mentioned many times in his opening statement, starting with his first sentence, that they were looking to come up with the value of the home and also looked at the architect for valuation. We're not looking for value here, we're looking here for cost. What was cost to build, not the value. And in addition, as far as Mr. Merrill did not just pop up and exactly say, I remember $350 per square foot. Mr. Merrill was first introduced to us in 2013 in a brief by the appellants, where he said that Ms. Dobkin's estimate of the home's construction cost of $2,500,000 was not unrealistic. That's what he first said. It was not unrealistic. It's not an endorsement of that amount or in any way an affirmation or a recollection of his. Rather, his later figure, a year later, $350 came after being told what the Dobkins were looking for. And so given that background, some additional information regarding window replacement in 1994, respondent has reevaluated appellant's basis in their Lido Lane home and distributed an exhibit that provides a recalculation of basis and gain. This recalculation provides a basis increase of over $1 million than before, and at least one of your board in a pre-hearing briefing questions utilized other factors to suggest a $3,500,000 basis amount. The respondent's revised basis submission today is actually $200,000 greater than the $3,500,000 previously suggested. Your board at the initial appeal hearing in this matter last February indicated that Dr. Dobkin's recollection of paying $1,800,000 for both lots was persuasive in conformity with the 1993 Dwyer Appraisal's land cost estimate. Consequently, respondent is now taking that $1,800,000 amount in its revised adjusted basis determination of approximately $3,700,000 as opposed to the $2,655,000 amount originally used. This difference results in an increased basis allowance of over $1,013,000. The revised basis amount is composed of the 1994 window replacement and installation costs of approximately $200,000, the $1,800,000 land purchase amount, and a revised construction cost estimate provided earlier to your board. The construction cost estimate was based on a relatively contemporaneous document with respect to the 1988 construction time frame, which is the Dwyer's 1993 aggregate construction cost estimate of $2 million, reduced by the Engineering News Record's Los Angeles Region's Construction Building Cost Index. This building cost index takes into account skilled labor and provides an inflation and cost adjusted figure to reconcile 1993 costs to similar 1988 costs. The index provides that the 1988 construction costs reflect 86% of the costs to rebuild and landscape a similar structure in 1993. In other words, based on the Los Angeles Construction Cost Index, it would cost $2 million to build in 1993, would cost roughly 86% of that, or $1,710,000 to build in 1988. Thus reducing the sales price of $6,300,000 by the revised basis of $3,700,000, and then taking into account escrow and selling costs of $345,000, provides a revised gain of approximately $2,250,000. This gain amount is then reduced by Section 121 gain exclusion allowance of $250,000 for each appellant. The result that each appellant should recognize approximately $874,000 of gain. And also with respect to the capitalization of interest, appellants are very mistaken in that and have never provided any statutory authority for these suggestions. Rather, the temporary regulations under Section 163 provides that construction, interest incurred during construction is actually deductible under temporary regulation 163-10T. And so this is actually deductible back in the year that the construction was ongoing, not to be added to basis. Moreover, Section 263 capital A small c also prohibits the capitalization of interest with respect to personal property. This is personal interest and is only allowable as a deduction under 163, and appellants have provided absolutely no support for their misguided suggestion that this interest should be capitalized. So I've spoken with the appellant's representative several times over the past month with respect to these calculations, including the resulting reduction of approximately 1/3 of the appellant's tax liabilities, and hope that your board finds that this revision properly reflects appellant's gain in tax. Thank you.
Thank you very much. On rebuttal, please.
I don't recall ever talking to Mr. Merrill and having him say that the $2.5 million was not unreasonable. The only calculation he gave me was his declaration that's before you there. It's also included in my attached brief. If I made that argument, that's fine, but I don't think Mr. Merrill ever said anything different. You've got pictures of the house, three-story house, subterranean basement, on 2 lots overlooking the water. It's got the best of everything. The pictures that were attached, I didn't bring along with the new brief, but they were attached to the old documents. This is a luxury house. We aren't talking about a builder who says he estimates or that he thinks it was about that or about that. Here he looked at this house and with the quality of materials, it was this. He says it was $350 a square foot. And 2 other people, one other person supports the $350. That's the real estate broker who said he was there every day. And a subcontractor says he doesn't know about the $350, but he knows it was over $2.5 million. This is what it cost Dr. Dobkin to build a house. The unfortunate fact that his wife threw away documents that she didn't realize that she was going to have to keep to support the figures that she put on her tax return is unfortunate. She figured she only needed to keep records for 7 years. I think her declaration says that. And she was moving and she thought, well, we don't need this anymore, but I know what the figures are. Those are attached to her tax return, and they're also attached to respondent supplemental brief as an exhibit as well. Those figures are reasonable. Those are the actual facts. Other than having Mr. Merrill here subject to cross-examination, I don't know what else we could have done. I think it might have been helpful if the board had given him a call. I would have been more than happy to have, not the board, I mean the franchise tax board, to give him a call. That would have been fine with me.
Does that conclude your?
That concludes.
All right. Thank you very much. Members, discussion, please. Member Harkey?
Okay, I'm just a little confused. I want to be sure I know exactly where we were and where we are now. And as I understand it, when I was hearing the introduction for this case, I heard that we were using $350 per square foot. This is maybe for appeals, so what did you say about that? I missed it.
No, I was just mentioning that in appellants, the declarations that appellants submitted, a couple of their declarations stated that it was $350 per square foot for the construction. But the Franchise Tax Board's computation of improvements was based on the 1993 Dwyer appraisal. That was a reproduction cost new calculation, and they applied a cost index adjustment to that to arrive at their improvements total.
And what was the improvements total per square foot that you arrived at? This is for the department.
David?
It's 1,710,000 divided by approximately 8,000, so I haven't done that computation, but I was just looking at.
How much was it, 213?
213 per square.
Okay, so the department agreed to the land.
Yes.
That was good, because that's, yeah, I mean, in my mind, that's kind of indisputable, but I appreciate that you took that. Now, you're also accepting the windows and other things, so you're getting at, I need a rundown. What was the original capital gain? I like to see numbers. I don't like to read words. The original capital gain was what?
It might be on the back of your exhibit.
I have a lot of stuff here, and I probably don't have the exhibit you're referring to. I want the dollar amount. What was the original capital gain?
Ms. Harkey?
Yes.
I believe the original capital gain for the property was approximately $3.3 million. That as computed by the Franchise Tax Board.
Okay, so now we're getting to 2.248 minus $500,000 for $250 each.
Yes.
And what's that? So now we're at 1.7. Can somebody crank this out? You don't have to answer me right now. Just give me some accurate figures, if you could. Just numbers. And so we've got a couple of these letters that indicate 350, and we've got some adjustments here. But Mr. Dobkin or your representative, you are saying that there are architectural costs, landscaping costs that are not included in here?
I think the declaration of my builder specifically states what he covered and what he didn't cover. So it didn't cover the docks in front of the house. It didn't cover the architectural fees. It didn't cover the landscaping.
Okay.
And I do think I read that thing for the first time today myself. If you look at the actual house, including the subterranean portion, which was probably by far and away the most expensive part, it's really 11,000 square feet, not 8,000 square feet. It's not like you're building a garage next to your house.
Next person, please.
No, appeals.
Appeals.
Ms.
yeah.
Harkey, if I can complete answering your question.
Sure.
The revised capital gain by FTB was approximately $2,248,000, and then if you subtract $500,000 for that, $250,000 for each of the sets of the appellants, would arrive at a capital gain total of $1,748,000.
Okay, thank you.
Member Runner.
I just have a question. The docks, I just heard the docks were not included. Can you validate the docks were included or not included? Do you have?
Well,
any-
there's been no showing of when those docks were constructed. And so they're probably, as far as looking at the appraisal, I don't believe that the appraisal referred to the docks. So I don't believe the docks were included in the appraisal.
Okay, the docks go with the property, though. And were the docks reconstructed?
Yes.
I'm sure there were some old ones there, and you probably...
No, it was the area I lived was a strip, which was a community strip, the homeowners association. And at some point after we moved in, they mandated we replace all the docks because they were, same thing you were saying, they were rotten. So they left the pylons and replaced all the decks, rebuilt them all, replaced all the docks.
When was that, please?
Excuse me, I don't know.
I can ask. When was that? Do you have any guesstimate? Your best guess?
A number of years after we had moved in.
And when did you move in exactly? What was the...
It's kind of analogous to Rob Lowe. We moved in, I think, in 1989. Got a final inspection, 1992 maybe.
Okay.
Had construction for several years after that.
Okay. This was on Naples. This was...
Yes.
On the Bay part. Okay, thank you.
To the department, any further clarification?
Well, on that item, I'm not sure whether or not that we're considered or by the, because we're talking about replacement cost of the entire part that would operate as security. So one might expect that to be also incorporated into the appraisal because it did take into account factors outside the home as well. And if I may, I would like to just briefly address the Mr. Merrill item, and I did find appellant September 3rd, 2013 brief signed by their representative, Mr. Mudd here. And it says here that Mr. Merrill has no specific records concerning the real property contract, but he does recall the costs due to quality, demands, subterranean basement, and size were very high. He indicated that the claim of Deborah Dobkins of $2,500,000 in construction costs is not unrealistic. So this was over a year before the declaration that they're relying on now, and he was unwilling at that point in time to provide a dollar amount, much less the $350 now proposed.
Member Harkey?
I'm through for now. Let somebody else.
Member Runner?
Well, let me just ask one more question. What is your best guesstimate of what the docks would have cost to reconstruct?
I think it's included in there. As I said, they were there when we moved in. We had to rebuild them.
Can anybody tell me what that is? I've got a lot of paper
I
here.
believe it's somewhere in there with $25,000 to $50,000, or $25,000 per dock. I don't remember.
Thank you.
Chairman?
Excuse me, Miss, may I address that?
Sure, certainly.
In the Ms. Dobkins' prior list, she had put a $25,000 amount for replace 2 docks.
Okay. Thank you.
Member Stowar?
Thank you. Okay, I was going to talk about the docks as well, so I was looking at the list, and I have $25,000 for the 2. To the Franchise Tax Board, for your replacement costs, like everyone else, I have a lot of papers. Is that just the improvements, or is that site improvement as well?
It includes site improvements as well, patio, landscaping, driveway.
And can you break it down for me again between the building and the site?
Well, the aggregate amount, the building, I believe, was approximately $1,510,000 roughly as far as the replacement cost that was assigned in 1993 by the Mr. Dwyer, who inspected the inside and outside of the property. And then he assigned $250,000 to the exterior. And then he had some other items that he assigned the remainder amount to come up with $2 million.
Okay. And to the appellants, in your ex-wife's testimony, she did indicate landscaping of about $250,000.
Yes.
Did you just tell me site was $250,000?
Beg your pardon?
Did you just indicate the site improvements was $250,000?
He stated the exterior, including landscaping and like the driveway, that was $250,000 that was assigned in 1993.
Okay. And I think I'm clear on what you franchise tax, but you're now agreeing to the cost of the land of 1.8, and then you're using the reproduction replacement costs plus additional items that you have verified to get to the revised basis of 3.7.
Yes.
Correct?
Yes, that is.
Okay. And when you exclude, or at least when I exclude the cost of the land, I'm getting a cost to construct of $238. And to the appellants, your testimony there is more like $350.
My current home cost me $600 a square foot to build.
Okay.
It's very comparable to that house. And as you stated in your conversation earlier today, prices haven't changed too much for building things. I think they have. But $350 a square foot probably underestimates how much I spent on that house.
Okay.
The proof, just like earlier today, all you got to do is look at the house. To think you built that for $1 million is beyond.
Okay. Thank you, sir. No further questions.
Discussion, members?
Let me just real quickly ask about
Member Runner.
the appraisal. FTB is keying off an appraisal for some valuation, correct?
Not for valuation, for construction costs.
For construction costs, excuse me, for construction cost. What was the appraisal? What was the purpose of the appraisal?
It's for refinancing of a loan, I believe.
Okay, let me go to taxpayer or taxpayer representative. Why would the appraisal not be a good starting point? I have an opinion.
Well,
I wanna
there's
hear
two
what yours
things, and I
is.
didn't happen to bring in an expert, but the appraiser here earlier very clearly said that most appraisers don't have any idea of what the actual building cost of a piece of property is. They pick that up from somewhere, they estimate it. It's just one of the elements that they put in. If you look at the appraisal, they have some comparable properties, none of which are close because they're all about half the size of this one. And then they used those and came up with a valuation on their appraisal. And then they used a replacement cost to verify that what they said by comparable sales was fairly accurate. I think their purpose was that they knew what the value of the property was, or they knew it was more than enough to cover the comparatively small
I guess
loan.
actually my point. I guess I'd go back to FTB. Why would I not? Because typically, even in a typical area, you'll find, when somebody sells their house, they're just hoping the appraisal comes in right in order for their financing, and that's because that's what drives the concern. Why wouldn't we want to look at the appraisal not as a real cost of construction, but as just making sure that the value was covered, the value would cover the loan? I mean,
Well, we're looking at trying to find the most contemporaneous documents to determine cost.
Right.
Because
is that what do you think the purpose of an appraisal is to reflect costs?
The purpose of this appraisal was obviously for refinancing.
Right. So the purpose of an appraisal is to ensure that the bank has protection on the loan.
And also to ensure that if the house burns down, that there's adequate insurance to reconstruct the home. And so
Is that what the appraisal is for?
It's part of what the bank's going to be looking for to determine whether there's adequate security in its loan. And so that's certainly a factor that a bank would consider is, would the security be there in the event of a fire? That's why when you get a home loan, they want to have fire insurance as part of the funding.
Right, but aren't those two different issues in terms of the valuation for insurance versus an appraisal? The bank is doing an appraisal over here. Yeah, they're going to want an insurance policy over here to cover the cost. But I've never heard. I guess I'm trying to think through where an appraiser is engaged in creating value in order to deal with the insurance aspect.
Can I comment on that?
No, just a minute. I mean, I guess I'm struggling with that as a norm. I mean, basically, they're just trying to, and then that's a next step that the bank's going to look at in regards to making sure that there's enough insurance to cover them.
When you look at the appraisals, they usually have a value appraisal based on value. They have another appraisal based on reconstruction costs.
Right.
They have a number of different parameters they use in the appraisal itself.
Right.
And then based on the actual environment itself, then the appraiser makes a recommendation as to which one is more in line with what the value of the property is or isn't.
Right.
And
the purpose of that is to ensure that the bank's covered for their loan, right?
Well, the purpose of it is to look at the different types of potential costs and exposure possibly down the road, and then for them to look at the recommendation based on the appraiser to determine which one is more in line with the value of the property.
To protect the bank for their loan.
Yeah, exactly. And then I'm not 100% sure, but from what I understand, then there's somebody back at the finance company, the bank itself, who essentially looks to make sure that, okay, we have a reconstruction cost, we also have fire insurance costs, and they make sure so they're protected, that they're one and the same, that they overlap to a certain degree, to protect themselves as part of their due diligence in giving a loan out.
Mm-hmm. Let me ask, you're going to make a comment in regards to stuff.
I adamantly disagree with his assessment. I mean, me getting fire insurance and homeowners insurance has nothing whatsoever to do with me borrowing a small amount of money to pay off the people I bought the land from. Trying to tie those two together doesn't make any sense. A bank loans me money because of who I am, because I did neurosurgery for 30 years. They don't loan me money because I happen to want to go borrow $1.5 million. It's more than just a piece of paper. For them, their whole postulation that they're basing their whole argument on the fact somebody made an appraisal of a house for a loan. And I have the guy who actually built the house gave you a declaration of what he thought it cost. I don't know how you can compare the two. They're just making things up based on an appraisal which was a completely different purpose to have the appraisal.
Let me ask you this, I guess in this follow-up, the appraisal that came in, it seems oftentimes, I mean, when I've seen appraisals for houses, particularly a hot brand appraisal, they don't consider a lot of the unique aspects of the house itself. They're just trying to make sure that their loan's covered.
For sure.
So you would submit that the appraisal that was done was a basic appraisal to ensure that the bank was covered for their loan, but not necessarily the value to which was the value of the home itself.
For sure. Had I wanted to go buy a home and borrow 90% of the money, sure.
Mhm.
But if I had to put several $1 million of my own money in, it's a whole different situation.
Okay, thank you.
One comment.
Further discussion, Member Ma.
So, as compared to the Lowe case, where, they had their CPAs prepare their taxes and filed their taxes, and, it wasn't them that destroyed the property or got rid of the property. I think we have a little different situation here because the sale, as I understand, your ex-wife reported her half or her share of the sale, and you did not report yours on your 2006 tax return. So there's a discrepancy in terms of what the real amount was, in terms of if your one CPA prepared it and, it was kind of consistent. So also, your wife got rid of the boxes. Obviously people don't keep sometimes their box of documents for years and years. And so I think it's a little bit different. We also heard that, and we know that the appraisers are not experts. They're not contractors. They perform their appraisals for, maybe the bank loan purposes or, refinancing purposes, and not actually based on the actual cost of what it costs to create a house. So in this case, I'm sympathetic or a little more comfortable with the Franchise Tax Board's numbers in that they're reasonably closer to what his contractor, Mr. Merrill, recalled. He built the property for $350 a square foot. The Franchise Tax Board came up with $213 a square foot. I think is a little more reasonable than the initial calculation that the Franchise Tax Board came up with, which was $783,000, which amounted to $98 per square foot. And clearly you can't build a house for $98 per square foot in the initial calculation. So I appreciate that Franchise Tax Board did, relook at this issue again and try to come up with a number that is a little more fair or reasonable calculation based versus last time, which clearly it was way too low in the Lowe's case. And I think that's why we all had issues, with the calculations that the Franchise Tax Board came up with. So, I mean, I don't know what the cost is. I mean, the builder says $350. Franchise Tax Board per square foot. Franchise Tax Board said $213 per square foot. And, that's where I am at this point. I'm a little more comfortable with the Franchise Tax Board's numbers in this case.
No comment.
Further discussion, members? Hearing none, is there a motion? Member
Move to take
Ma.
under submission.
Member Stowers moves to take it under submission, second by Member Ma. Without objection, members, such should be the order. Thank you very much for appearing before us today. The board will take your matter under consideration later on this evening and send your written report of our decision. Ms. Richmond?
Our next matter is item C, Sales and Use Tax Appeals Hearing. Item C1, Ronald J. Bloomquist, please come forward.
As the taxpayer settles in, I would ask that Mr. Anjija please introduce the issues in this case.
Good afternoon, Mr. Chairman and members. I'm Jeff Angija on behalf of the Appeals Division. The appeal before you presents 3 unresolved issues, which are whether taxpayer is personally liable as a responsible person for the unpaid liabilities of Blomquist Enterprises under Section 6829. Second is whether the amounts due were discharged in bankruptcy. Third, whether taxpayer has established reasonable cause for relieving penalties for late payment of returns and late prepayments. And I'd like to add that we have a revised recommendation. The department's further review indicates that the taxpayer is not liable for the first quarter of '05 and for the last quarter of fourth quarter of 2005. Those 2 periods drop off, as well as the prepayment for the second quarter of 2005. That's a reduction of tax and penalties of approximately $127,060. Interest would be reduced as well. I haven't had time to calculate that number.
Given the reduction, we will now go to the taxpayer. Taxpayer has 10 minutes to make their presentation. We'd ask that they commence with their introduction. You certainly have the option to respond to Appeal's most recent statement.
My response is, that sounds real good. Thank you.
You want to further clarify real good?
Yes, I do. My name's Ted Rumpke, and I represent Ronald J. Bloomquist. Mr. Bloomquist has assessed significant taxes, penalties, and interest in his capacity as being a responsible person of Bloomquist Enterprises, Inc. And Bloomquist Enterprises, Inc. ceased doing business in, I think the date being used here was November 2005, when actually I think there's evidence that it was in October 2005 that they did cease doing business. The business, Bloomquist Enterprises, Inc., was owned and run by a married couple, Ronald J. Bloomquist and Linda Bloomquist. For reasons unknown, the department only seriously considered Mr. Bloomquist as a responsible person. The only reference I could find to Linda Bloomquist was in the June 17, 2011 board hearing summary, which acknowledged that she was listed as the vice president on the seller's permit, but was not listed as an officer with the Secretary of State in the initial filings. Additionally, the department acknowledged that there were that they had spoken to Mrs. Bloomquist, but that she, when being questions, deferred to Mr. Bloomquist for all of the answers, which in my household is a labor-saving device. The summary then concludes, the hearing summary, that the department found that there was no evidence other than the seller's permit application indicating that Mrs. Bloomquist was a responsible person for BEI sales tax compliance, and therefore the department did not issue a determination against her. Now, the problem with that is similar to the other taxpayer that was here, is the Bloomquists are now divorcing. And the fact that if the department had just done a little more research into the public records available to the department, they would have discovered that Mrs. Bloomquist was a responsible person, and that if they had done a little bit more research, she would be jointly liable for this debt. And the problem right now that Mr. Bloomquist is having is that they did have an asset in the marriage, and that asset was sold. And the proceeds of the sale were put in trust. Mrs. Bloomquist says, that's mine. I don't owe anybody. Didn't you see the June 17, 2011 summary? Mr. Bloomquist says, this is our debt. You were there with me the whole time, and all of the proceeds need to go to the state to settle this account with the state. I provided to the board many public records that were available to the department that if they had just looked, they would have seen, beginning with October 2003 Statement of Information, where she says she's secretary and CFO. In February 2005, she says she's vice president, secretary, and treasury in a Statement of Information filed with the Secretary of State. In the 1999 Statement of Domestic Stock Corporation, she's listed as the director. In the 2001 surety bond of motor vehicle verifier, she signs as principal. In lots of filings with the Department of Consumer Affairs, Bureau of Automotive Repair, she's listed herself, and she signed all of these documents by her. She is signed as president, vice president, secretary, treasurer. In the application for temporary branch location, she signs as dealer. From May 27, 2005 through March 2006, which is the period of time partially that we're dealing with here, she signed the vehicle dealer permits as licensee. And likewise, I mean, that goes back to 2002, where she's signing as the licensee for the business. So I think if the department would have just looked, they would have found that the chief financial officer, president, vice president, secretary, treasurer, principal, dealer is Linda Bloomquist. I don't think that they would have made that footnote that says that she is not the responsible person, because she was just as responsible as Mr. Bloomquist. And I'm not saying that Mr. Bloomquist is an innocent party. I am saying that they let her go, and it's a real problem for him right now. And because of the fact that this is not his sole liability, which is what the department has put on him, excuse me, he's asking for a equitable reduction in the amount that is being assessed against him to reflect the fact that the other responsible person is walking away.
Thank you. I only hesitate because it's an interesting argument.
Interesting twist.
Thank you. Members, let's go to the department. The department has 10 minutes to make their statement. We would ask that they commence with their introduction. For the record, I would also ask that they address the concurrent liability position leading to equitable estoppel, equitable relief. Okay. Oh, only if you wish. You do what you want to do. I just think there's a lot of wisdom in doing that.
Mr. Chairman and members of the board, I'm Erin Dendorfer from the board's legal department, along with Lawrence Mendel and Kevin Hanks representing staff. We concur with the recommendation of the Appeals Division. Petitioner is liable under Section 6829 for the liabilities of Bloomquist Enterprises, Inc., which was doing business as Bank Auto Resales. Under Section 6829, there are 4 elements that the department must establish for personal liability to attach.
My apologies, but the appellant has submitted that he is a responsible person. He's not arguing that.
Okay. Well, as for taxpayers' argument today that another party should have been billed for responsible person liability, the department did investigate the taxpayer's wife and concluded that she was not a responsible person because she was not in communication with the board regarding sales and use tax matters, which is an element that's required for personal liability to attach under Section 6829. There's also evidence in the file that on the bankruptcy documentation, Ms. Bloomquist was terminated from the corporation in July of 2005, and the liabilities that issue here today are only the second quarter of 2005 and the third quarter of 2005. So she would not have been a responsible person at the time that the liabilities became due. Accordingly, we request that the administrative protest and claim for refund be denied.
On rebuttal, please.
In the section, I did submit some documents that show, actually, that Linda Bloomquist actually was not terminated. I have not seen these bankruptcy documents, but she is still writing checks, bank auto resales checks, through August, certainly through August of 2005. And there are several of those checks that have been submitted. I do not believe that she was. In fact, I think she participated. In fact, there's a letter I also submitted a letter that she wrote to the Bureau of Automotive Repair in December 11 of 2005, where she says, please be advised that Bloomquist Enterprises, Inc. has ceased business. The new owners are BK Auto. I request a prorated refund of my fee, and they will pay the balance of new fee costs. The transition occurred October 20, 2005. So she was, and that's presumably that's also a public record.
Yes.
Does that conclude your
Yes, sir.
testimony? Thank you. Discussion members, Member Wall.
Yeah, so I'm confused because I do see checks being signed in August of 2005.
Right.
So,
Yeah, I was able to review those checks also. One of the elements under Section 6829 liability is that the party must be responsible for the financial affairs of the corporation, including sales and use tax matters. And they have to have knowledge of the sales and use tax liability. And we just didn't have that evidence in this case. I mean, she was involved in the corporation, yes, but we didn't have evidence that showed she would be personally liable for those liabilities. And on the other hand, the taxpayer in this case signed the sales and use tax returns. So there was knowledge of the liabilities.
and did he sign all the
also-
checks also,
Um,
paying the sales and use tax?
Well, the reason we're here today is because the sales tax was not paid. The sales tax reimbursement was not turned over to the state.
But how about
Well, you're-
how about past history? Because it looks like she signs all the checks.
Ms. Ma, you're correct. It does appear as though she had signatory authority to sign the checks, and we don't dispute that was the case in this matter. Given the copies of the checks that we've looked at today, we agree that she participated in some manner in the business, but unfortunately, we didn't have the information that indicated that she was knowledgeable about the sales and use tax liability. The communication that the department had with the petitioner was actually with Mr. Bloomquist. When an installment payment agreement was discussed, it was Mr. Bloomquist that we dealt with. He signed the sales and use tax returns as well, so we just didn't see that Mrs. Bloomquist had the knowledge of the amounts that are in question today. One last matter, it appears too, there would be a statute of limitations issue for us. There's a 3-year statute period that applies, and so the statute actually ran for issuing another determination against another party in January of 2009.
May I
Members,
comment on
just, Member Wall?
I don't know. I mean, I have a little bit of an issue when husband and wife are doing business together. The wife clearly signs checks and documents. And then you're saying because the husband signed the actual tax return, he's the only one that's liable.
I don't believe that's what we're saying here. We're just saying that under Section 6829, there's a requirement that the party has to be aware of the sales and use tax matters and be involved with the board regarding sales and use tax matters specifically. And we just didn't have that evidence for the taxpayer's wife in this case.
So maybe I can ask the representative, what did the husband and wife do? Do you know them?
The husband actually is my brother.
Okay, so you know them pretty well.
Yes, I do know them very well.
Okay, so how do they operate their business?
They actually, it was pretty much, I also work with my wife, and it was pretty much the same way. My brother basically worked for his wife. I mean, my brother was the expert in selling the cars. She ran the office, is what she did. He ran the sales force. And that's how they operated the business. She was well aware of everything going on financially because she was primarily in charge of the finances of the company. The fact that she did not want to deal with the liability, I mean, I don't know who initiated the call that they referred to in that June 2011 footnote, but it wouldn't surprise me if she was calling them up to find out how much they owed, and because she had limited funds available. But it was her that was deciding which creditor to pay, and it wasn't Mr. Bloomquist.
Did they have a bookkeeper?
No, they did not at that time, because of financially the business was failing in 2005. Otherwise, but because in all the prior years they operated, the sales and use tax was paid. But it was 2005 that things kind of fell apart. And on the statute of limitations issue, I just want to add this real quick. That is maybe one of the problems with why the department did not pursue Mrs. Bloomquist is because they didn't even file anything against Mr. Bloomquist until October 2008, I believe, like 3 months before the statute was going to run.
I'm aware of the statute issue, but I'm just trying to get to the bottom of this because, when people operate a business, I kind of like to know who is doing what in the business. So your brother
Was in charge of sales.
Okay,
He had a sales force.
would he have filed the sales tax return knowing how much sales they made and how to fill out the sales tax return?
Yes.
Okay.
He did know how to do that, and Linda knew how to do it too, and what would normally happen is Linda would prepare it and Ron would sign it.
Okay.
Just because I don't need to say that.
Okay.
But that's good instincts.
Okay.
Chairman?
Members, let me go to appeals, to the point in question here, relative to the request of the taxpayers, request for relief, and that they are concurrently liable, and maybe some adjustment or estoppel.
I'm aware of no authority that allows any kind of equitable reduction based on the allegedly responsible person that we didn't get but should have. Further, adding someone else to the liability if there were a second party that should be added doesn't decrease the amount that's at issue. It might make a difference for purposes of collection, but in terms of the legal liability, more than one person can be liable. But so long as all four elements are met as to any one individual, that individual is responsible for that amount regardless of who else might also be responsible.
Okay. Life would have been a lot easier if the department had responded, but. Further question, Mr. Renner?
Yeah, so during this audit, or during this period of time, the tax, it was filed by Mr. Bloomquist. No checks were written during this period of time, which is why there's a liability, correct? How about prior to this time? What was their relationship to the BOE, and who wrote checks to the BOE prior to this?
I don't have that information.
We know that the prior returns were all signed by Mr. Bloomquist.
How about the checks?
I don't know.
Sorry, Mr. Bloomquist entered into an installment payment agreement for the first quarter of 2005 for those liabilities, and he made payments under that.
Did he write the
agreement.
checks?
I'm not sure. I don't.
That's kind of a critical issue for me right now, trying to figure out who actually wrote checks.
Chairman?
Because again, we've had in the history, we clearly have people who've signed returns, but they weren't held accountable, they were responsible. We've had people who'd write checks, they weren't held responsible. It was this broader view in regards to who actually had control. And again, I think, the taxpayer representative went through this long list of the roles that Mrs. Bloomquist had in the corporation, but none of those necessarily indicate then responsible party.
Right.
It's going to come down, so I'm interested to kind of figure out, prior to this time, was she writing checks to the BOE?
I don't have the check answers, but our ACMS notes just consistently indicate that the only one we communicated with was Mr. Bloomquist, and when his wife was on the line, she would just defer all questions to him. So that led us to believe that she was not directly involved in sales and use tax matters.
We do also note that Mr. Bloomquist's electronic signature as president appeared on the bankruptcy court documents, and he was also identified within those documents as the 100% sole shareholder of the corporation. So that was also informative to us as to who the responsible party might be.
There's only one corporation that we're dealing with, and he's listed as 100%?
Yes.
Can you explain how that could take place?
Yes.
Apparently, but you don't want to.
I believe what happened was when they were going to file the bankruptcy, Linda told him she didn't want to be a part of it, and then transferred all of her interest to Ron so that Ron could be the sole shareholder and deal with the bankruptcy by himself.
Okay, thank you.
Member Stower.
Okay. To the department. Mr. Runner asked, did the former spouse also sign checks? For the prior tax due, and you're indicating that you don't know, you don't have that record in front of you right now.
I do have some returns for prior periods that were signed by bookkeepers, but I don't know if they're
checks. Actually, my question is this, I'm just looking at the statute. Does it matter if we're looking at these particular periods? Is it these periods that you would need to see that she had financial responsibility for the sales and use tax? When the sales and use tax became due?
Yeah. We would need.
Yes.
That's accurate.
That's
accurate, yes.
Okay.
We'd
So
be
for
looking
what we
at
have
that time
here,
period.
we know that she did not, well, no one signed, she did not sign the checks because it's a non-remit tax return. But we do know that Mr. Bloomquist communicated with the Board of Equalization regarding the unpaid tax liability and signed the tax returns.
Yes.
Okay. And they have conceded that he is a responsible party.
That's my understanding.
Okay, thank you.
Member Harkey?
Without some clarification, I'm struggling here because I think we're beyond statute of limitations, as was indicated, so this conversation about where she was or wasn't probably doesn't help. I think it's nice to add clarity, but it's not going to bring us to the result that the taxpayer would like to see. So I'm trying to figure out, I have reviewed this file, looked at it at length. I see that the taxpayer in question is now working for someone else. Is that true?
That is correct.
Okay, he doesn't have his own business. The final year, he paid himself for the entire year, is what I'm seeing, is like $92,000. That's not really high flying if you've got a house and a family. I don't think I'd like to try to give some kind of a break here because I hate to pursue him into perpetuity. He doesn't appear to be living high right now. He appears to be making his bills and trying to deal with this. So I guess to the appeals, is there any kind of break, so to speak, that we could allow here? Interest, penalties, anything at all that might, because I think we do have a responsible party. We have the only one we can have at this point, regardless of what happened in the past. He's admitted that he did not remit the taxes, but he did go BK during that time. He did not just wipe out money for himself. It looks like he probably paid his employees, did what he had to do to keep himself out of jail, and in essence did not remit the tax. And nobody really got it. It didn't go anywhere. It just kind of went to shutting down the business and getting rid of it. So is there any kind of allowance? Or other than offers and compromise or something?
That's what I was, that's what I was going to suggest, because under the law, there's not. Even the innocent spouse statutes require that the party that's claiming basically be innocent. Obviously, it's inherent, but did not know or have reason to know the tax liability. You basically can't have a person liable under 6829 qualifies for innocent spouse relief.
Right.
OIC or settlement. I do know under family law, this liability, even though we should be deciding it under sales and use tax law, it's still, I don't know when the separation was, so I don't have that question. I don't mean to cross-examine anybody, but depending on when the parties separated, it could still be a community property asset for the business, community property debt, even for the 6829 liability. So you could still have a joint and several liability for family law purposes, but that doesn't help us resolve the tax question that's in front of us.
Right. I'm questioning whether there's even the ability to pay at this point, my review. So I kind of like to, this has been going on 2005. It seems like a long nightmare. Okay, thank you.
Member Ma.
So I'm having the same struggles. You know, I see signatures from Linda on the DMV vehicle dealer licenses issued May 27, 2005. I see her signature on documents that say she is the vice president, secretary, treasurer. Another one she signed as the owner. Another one she signed as vice president, secretary, treasurer. I mean, I'm having a little problem putting all the debt onto just Mr. Bloomquist. In my opinion, based on the documents and what we understand and her actually signing and giving herself these titles, she was actively involved in this business, and I'm just having a little problem assigning 100% just to him just because the bankruptcy or they got a divorce and, you know.
I understand the question. The problem is that 6829, one of the elements is element 3, the person has to be responsible for sales and use tax compliance. Just being the officer or just writing checks to vendors or making payroll isn't enough to sustain liability against someone. That would be a failure of element 3. And that element has to be satisfied when the tax is due. So for the third quarter, with her being terminated on October 20th of 2005, tax isn't due till the 31st. But what I'm not seeing, and we haven't seen evidence yet, is her responsibility for sales and use tax compliance. She might have been involved financially and otherwise, but that, unless we have evidence that it's sales and use tax compliance, we wouldn't be holding her liable if her appeal were in front of us today. And that's why the department didn't go after them, after her.
And it's beyond the statute.
What's the, does the board have authority to recommend relief to the, if he were to file with the, I don't know what the name of that board is.
Victims' compensation?
Yes.
I looked into that. There isn't really a tort that's committed or a breach of contract that's
Yeah,
committed
I'm
by the state.
Okay.
Let me just ask, again, in a civil capacity, I mean, it seems to me what I've heard was there's an account of money out there.
Yes.
And so there's this account of money to which your client or your brother at that point feels like gee, some of that money needs to go toward settling up this debt.
Correct.
And in your portion, you shouldn't just get your portion of that and walk away from this debt. Is that
Correct.
okay?
That is
So let me ask you.
precisely correct.
So the other issue, I'm just wondering if there's additional civil responsibilities that you guys can have to go down.
Well, and obviously, they haven't had their divorce hearing on property, and he is claiming.
They haven't yet?
No, they have not.
Oh, well.
He is claiming this is a community debt. She's claiming, no, it's not. Didn't you see the June 2011 thing that says this is all you?
So is part of your concern the fact that if we then decide that she is not, which is hard for, again, I'm just saying, then that backs up her story for when she goes into a civil litigation?
Well,
Let him finish. Go ahead.
Because the statute has run on her.
Right.
You know, I think that the position can be taken in the divorce action that, no, that doesn't matter. That, because they couldn't come after you anyway.
Okay.
So, I mean, the uncertainty is what the divorce judge is going to do.
Mm-hmm.
And Ron wants to use that money to go into offer and compromise. And she wants to use that money to, buy another house.
Okay.
Or whatever, to use it as she sees fit.
Member Harkey.
Well, as I've stated, from our perspective, she's out of this. We can't, statutes run, 6829's over, regardless of whether she should have been or should not have been. It's over. And that's what the record shows. So I'm just kind of trying to find some other avenue. I mean, people do things, getting a divorce they probably shouldn't do, and they sign things that they shouldn't. And maybe your brother shouldn't have let her out of the corporation or shouldn't have whatever, but it's done. And I think that the department legitimately pursued the path that they had, and they followed all of our criteria. The problem is now I'm not so sure that there's an ability to pay it anyway, so, thank you.
How much monies are being held?
I believe it is $80,000.
To the department, we're speaking of sales tax, right?
Yes.
Okay. These are taxes that were collected from California taxpayers and not remitted to the board?
That's correct.
Correct.
Do you know what he used the taxes for?
To pay other vendors and creditors. The business was, the business was not being operated in a fiscally responsible manner, obviously.
Did he pay himself as well?
Well, he put a lot of his own money into the business, a lot of his own money, a lot of their money, because it was Linda's money too. They bankrupted themselves in trying to make this business go. And so when it was over, really all they had was that one asset, which they claimed the homestead asset. And so they didn't make anything.
Further discussion, members? Hearing none, is there a motion? Member Mon moves to take the matter in submission, second by Member Harkey. Without objection, members, such will be the order. Thank you very much for appearing before us today. The board will take your matter into consideration later on this evening and send you a written report of our decision.
Thank you very much.
You guys good? Ms. Richmond, our next matter, please.
Our next matter is item G, tax program non-appearance matters, consent. Item G1, legal appeals matters. And we do have a public comment for this item.
Members,
G1.
the comment hasn't taken place yet. Why don't we take a 5-minute recess, members? Members, let us reconvene the meeting of the Board of Equalization. Members, we are now on G1, Legal Appeals Matters. Do you wish to note any non-participation or pull any items? I would note,
Mr. Chairman, we do have a public comment for this item.
okay, members, let us welcome Mr. Shahimi to come forth. Sir, please be advised that we will hear your testimony, but because these are G matters, we cannot comment on those, and then we would ask you to return to your seat. But thank you very much for coming before us today.
Thank you, Mr. Chairman, board members. My name is Azim Shalami. I was here, I believe, sometimes in February with my CPA, and we didn't have the proper documents, or they were not organized, and I think you were all confused. So we weren't prepared when we came in. So the reason I'm here again, I would sincerely request another rehearing so I can present all my documents by a professional. So I don't come with my same CPA anymore. And I've been here since 9:30, and it's like a tax law school. I learned a lot being here. It's very educational, actually. So I enjoyed being here.
Thank you very much, sir. Members, is there a motion relative to item G1 through G22?
Approve staff recommendation.
Member Harkey moves to adopt staff recommendation, second by Member Ma. Without objection, members, such will be the order. Ms. Richmond?
Our next item is G2, franchise and income tax matters. These items may be taken in one vote.
Any non-participation members? Any items be pulled for further review? Members, relative to a motion on item G2, 1 through 17.
So moved.
Member Runner moves to adopt staff recommendation as such, second by Member Ma. Without objection, members, such will be the order. Ms. Richmond?
Our next item is G4, sales and use taxes matters. These items may be taken in one vote.
Members, is there a motion? Member Harkey moves to adopt staff recommendation on item G4, 1 through 11. Second by Member Stowall. Without objection, members, such will be the order. Ms. Richmond?
Our next item is G5, sales and use taxes matters, credits, cancellations, and refunds. These items may be taken in one vote.
1 second, members. Just got to make sure. Members, we're on item G5. Any noted non-participation, any further items be pulled for further consideration? Hearing none, is there a motion on G5, 1 through 17? Moved by Member Runner, second by Member Ma. Without objection, members, such will be the order. Ms. Richmond?
Our next item is G7, special taxes matters, credits, cancellations, and refunds. This is a constitutional matter, therefore the Deputy Controller may not participate in this matter under Government Code Section 7.9.
Noting non-participation by Deputy Controller, members, is there a motion? Moved by Member Harkey to adopt staff recommendation.
I have some comments to make here. This is particularly important to my district, if you would not mind.
Yeah, of course. Let's put it on the discussion, members.
Okay, thank you.
Member Harkey.
This is Green Flash Brewery. It's a small business leader in a budding craft brew industry. The San Diego Beer Belt, so to speak, you have the wine belt, we have the beer belt, has been leading the craft brew revolution and is located in my 4th district. As these craft brew trailblazers have found gold in California, they've also experienced California's complex tax laws. And thanks to my partner, the San Diego Regional Chamber of Commerce, the Green Flash case was brought to my office's attention.
Sorry.
What? What?
Deborah Cook Jackson from the legal department. This is on the non-appearance consent calendar. So when you pull items for separate vote and discussion on, then it moves it over to an adjudicatory matter. So it has to be.
Well, staff, you
noted.
guys just messed me up.
Uh,
Angry flash. Can I
members,
withdraw my?
Members, the matter was not before the board, in that there was not a first or a second. Therefore, no appropriate.
No
I think
comment.
Once we start making comments.
All right.
Well, yeah, you can definitely bring it back next month.
Right.
All right.
Yeah.
Okay.
Yeah, I think we have to go to an.
Noted, noted.
Well, yeah, typically they'll push it over to an H calendar. It was the non-appearance adjudicatory calendar.
All right.
Right.
Okay.
All right. So.
My apologies, Member Harkey.
Well, my apologies very, very much for interfering. We thought we had this right, but sometimes you just need to be quiet, right?
All right. Item G7 will be put over by the board. Ms. Richmond, please, our next item.
Our next item is G10, legal appeals matters for property tax matters. These are constitutional functions, therefore the deputy controller may not participate in these matters under Government Code 7.9.
Noting
Sub-items 2 and 3 have been pulled.
Noting non-participation by the deputy controller, and is there a motion relative to the items that have been pulled?
So moved.
Moved by Member Harkey, second by Member Ma. Without objection, members, such will be the order.
Our next matter is item H, tax program non-appearance matters adjudicatory. H1, legal appeals matters. Would you like to take these up separately or all together?
Members, without hearing objection to take the matters up separately, we'll take them up all together.
Approve staff recommendation.
Member Harkey moves to adopt staff recommendation, no redetermination. Penalties remain. Second by Member Stovall. Without objection, members, such will be the orders.
Our next item is H2, franchise and income tax matters. There's only one item.
Members,
Adopt the summary decision.
Member Stowar moves to adopt summary decision. Second by Member Runner. Without objection, strike that. Second by,
Trying to be consistent now, see, so.
okay, second by myself. Objection noted. Ms. Richmond, please call the roll.
Mr. Horton?
Aye.
Ms. Harkey?
No.
Pardon me?
No.
Oh, sorry. Mr. Runner?
No.
Ms. Ma?
Me? Aye.
Ms. Dowers?
Aye.
Motion carries. Our next item is item I, tax program non-appearance matters. Item I2, offering compromise recommendations. Sub-item 1 has been pulled.
Noting the sub-item 1, 4220 for the People Cooperative Incorporated has been pulled for further review. Is there a motion, members?
So moved.
Member Harkey moves to recommend that we authorize staff to accept all offers with the exception of item 1, but item I2, 2 through 14. Second by Member Ma. Without objection, members, such will be the order.
Our next matter is the administrative session. Item N, consent agenda. We have item N1, retirement resolutions for K. John Emmett, Tees Ming Lei, James M. Najiri, and Neil Shaw. The members of the board wish to extend their sincere and grateful appreciation to the retirees for their dedicated service to the State Board of Equalization and to the state of California. Their congratulations on the retirees' well-earned retirement and best wishes to them and their families for continued success, happiness, and good health in the years to come.
Thank you, Ms. Richmond. Members, with your permission, I'd like to take the liberty of just acknowledging all of these individuals, but in particularly Neil Shaw, who we date back to actually starting together with Board Member Parrish's office. There's stories that I could tell, but time doesn't allow. But
He's back there now.
He's back with Claude talking about it right
he's
now.
currently with Mr. Parrish and doing well. So it's good to see that he's retiring, but yet still continuing to serve the people of the greatest of the state of California in some capacity.
Orange
least
County,
Orange County,
Orange County
Yeah.
Assessor's Office,
Yeah.
working with Claude Parrish, and I think he's enjoying himself, and I know he's enjoying his retirement plus his new career.
For discussion, members? Hearing none, let's go to N2, N3, N4, N5. We'll take them all up together once we've done that.
So moved to approve.
4 and 5.
Member Harkey moves to adopt item N1 through N5, second by Member Ma. Without objection, members, such will be the order.
Our next item is item O, adoption of board committee report and approval of committee actions. O1, customer service and administrative efficiency committee report.
So moved.
Moved by Member Stowell, second by Member Harkey. Without objection, members, such will be the order.
Our next item is item P, other administrative matters. Item P1 is the executive director's report. Item P11, cross-project update and actions.
Thank you very much. Welcome to the board, Mr. Gao.
Good afternoon, Chairman and members. David Gao, Chief Deputy Director, providing you with the cross-project update this month. Staff continues to evaluate review the final proposals that we received back in October from the bidders, and the review is progressing on schedule. This is that touchy time that we have to be careful, the blackout period, to ensure that there's a full, fair, and impartial consideration of all proposals. The project team has made some progress on a number of initiatives that I'd like to highlight here. The IRIS Data Dictionary, which will be used to ensure that the data transfer will go quickly and easily, is underway. Analysis and streamlining of the 2,500 forms within the scope of CROSS. Development of a process to conduct a BOE skills and implementation readiness assessment prior to contract award. And then also working on identification of the BOE employees who will be conducting an assessment of the BOE's readiness for change. In late October, I'd like to highlight that Carlos Ramos, the director of the California Department of Technology, sent Chairman Horton and also copied the board members in a letter which said, "We at the Department of Technology greatly appreciate the collaborative approach you and other members of the Board of Equalization senior management team took to understand and address the risks we raised concerning the need for additional organizational planning for CROSS, and that through our recent work, the BOE is better positioned for success." As far as some of the expenditures on the project at this point, this is through September. In September, the actual expenditures were $739,260, and our year-to-date is $2,260,000. The project to date is $26 million. We will continue to keep the board informed of any significant changes to the procurement, any impacts to schedule, and any possible risks to the implementation. And at this time, that concludes my report.
Thank you. Further discussion, members? Hearing none. Can you elaborate on the blackout period for us, please?
This is the time where we have staff basically sequestered, and they are a team of experts around the department who are evaluating the proposals that we received. So they are, it's coordinated by the Department of General Services procurement officer who oversees their activities, and they are doing this all in a very closed environment.
Thank you. Thank you very much. The board will receive and file. Appreciate your report. Ms. Richmond?
Our next matter is item P3, special taxes and fees deputy director's report. Item P31, the effects of Proposition 10 on cigarette and tobacco products consumption.
Welcome to the board, Mr. Parrott.
Thank you. Good afternoon, Chairman Horton and members of the board. I'm Richard Parrott, Acting Chief of the Special Taxes Policy and Compliance Division. The issue before you today is the effects of Proposition 10 on cigarette and tobacco products consumption, also known as the Prop 10 backfill. Statutory provisions added to the Health and Safety Code by Prop 10 require BOE to determine the effect of Prop 10 on the consumption of cigarettes and tobacco products and directs a transfer of funds to backfill the revenue losses to the Prop 99 and breast cancer funds resulting from the Prop 10 tax increase.
The intent of the backfill is to keep the funding levels of certain Prop 99 and breast cancer programs from declining any more than they would have declined without the Prop 10 tax increase. Based on our economic models, we recommend that the board approve the backfill amount of $16.1 million for the 2014-15 fiscal year. And that concludes my presentation, and I'm happy to answer any questions.
Discussion, members? Hearing none, Member Harkey moves to adopt staff recommendations. The board approves backfill to the amount of $16.1 million for fiscal year 2014-15. Second by Member Runner. Without objection, members, such will be the order. Thank you. My apologies, Mr. Parrott. At some point, it might be healthy to provide the board with some background on how these interactions work. There's lots of discussion out there about the costs and the expenses and so forth, and what seems to be missing, at least I had a conversation with the governor relative to the impact of the underground economy and the oversight and the police and how they interact with each other. And so it might be helpful that we began to have that conversation publicly.
Okay.
All right, thank you. Ms. Richmond.
That concludes our administrative session. Would you like to take those items that were pulled for submission? Or would you like to go into closed session?
Let's go into closed session.
Let's take our items, and then we can.
Okay. It's a pleasure of the board.
People will know.
Okay, members, we will go to the items to be finalized. Ms. Richmond, what's the first item for consideration?
The first item that was taken under submission is B1, Robert H. Lowe and Sheryl L. Berkoff.
Move to grant the appeal.
Member Harkey moves to grant the appeal, second by Member Runner. Discussion, members. Remember, as I shared earlier, I wanted to go back and take a look at this whole notion of the capitalized funds. In the briefing provided by the taxpayer, the lawyer for the taxpayer acknowledged that the non-capitalized interest was actually claimed on the tax return. So if that amount is not deductible, then we would be allowing an amount that is just not deductible that was actually claimed on the return. So I would go to appeals just to give us some oversight as it relates to the law.
Okay, Mr. Chair, we took a look at it and we determined that under Treasury Regulation 1.266-1 B1, the capitalized or construction loan interest may be capitalized and added to basis. But that is an election that must be made in the year in which the interest is paid. So, for instance, if they took the loan out in '98 and they paid the interest on it, they would have to make that election on their '98 return in order to then, upon sale, claim that as an addition to basis. And we don't have, at this point, we don't have their '98 return. We don't know whether they made that election.
So they could have.
So it's basically, to us, it's, theoretically, it could be an addition to basis, but we just don't have enough information.
So,
And I beg your pardon, sir, but with respect to the mortgage interest, that would not be deductible for this type of property. That is only, or not deductible, I beg your pardon, that would not be capitalized and added to basis because this is an improved real property. That is only an addition or a capitalized item for unimproved, unproductive property. That's the only time that's allowed.
See, therein is my concern, members, is that the loan documents seem to indicate that the actual loan amount, the interest on the loan amount is somewhere around $718,000, which leaves about 1.8 million of non-construction loan capitalized interest. If we were to even presume, which the evidence isn't here, that that was accounted for properly and timely, then the $708,000 might very well be subject to being capitalized, but clearly the 1.8 is not. The other concern that I have, aside from all these estimates, which just seems to be everywhere, was that the accountant indicated that the documents that he provided to the department, which included expenses that were not subject to be capitalized, were included in the original tax return as the capitalized amount. That amounts to somewhere around $62,000, but I'm certainly not just on the numbers that we were able to receive the actual documents. The numbers we weren't able to receive the documents, which is about $6 million, and documentation that just was never provided to the board or to the agency, because they were lost by the accountant, lost by the taxpayer, and none of the vendors who they purchased these items from had lost them as well and couldn't provide the actual documentation. But if we were to compute a percentage of error and project that percentage of error over that $6 million, assuming that similar errors was made over those amounts, assuming that those amounts are actually under the Cohan rule are evident as a result of our visual observation as well as the testimony of Mr. Williams and others, that would bring us to I have to do that percentage of error, but that brings us to a calculation which would take the 1.8 non-capitalized interest, which was presumably claimed according to Mr. Marks previously. In fact, he didn't change his testimony until today, and according to the briefs, according to the taxpayer's accountant, and so forth. So therein is my challenge, but and why I would not be supporting that motion. Member Harkey.
Well, I would just like to say, because of the Cohan rule, we're supposed to pick an estimate, and we had a variety of them. They were all over the place. And I think that these taxpayers in particular did an extremely amazing job of gathering together what they had, and they did it over a long period of time. They were put off another 3 months because we reviewed additional documentation. So we had documentation, and more documentation. And the Szabo estimate came back amended. Craig Szabo, he was the initial, and he was the one that did the breakout by basically going through what he had in memory, and then he corrected that. And so what we're back with is really, was there anything better than what the taxpayer had submitted to begin with? And I don't think that there was. I think that, the department made a great case, but they kept coming in at that $4 million mark, which truly wasn't. And so wasn't the amount for that house. And I think that we've had a lot of support for just taking the tax. I mean, if we don't have anything better, just accept the tax return. It's been a long time, a long, hard slug for everybody, and it's not that, but the department would not come off that $4 million number, which to me indicates there was really probably no big effort to try to justify anything more. So.
Just to provide the members with the number, I think first, I'm looking at the taxpayers' records. I'm not looking at the estimate, and the Cohan rule only requires us to look at these estimates and appraisals when the actual documents aren't available. The actual tax returns are available, the actual which indicates the non-capitalized interest. The actual testimony is available from Mr. Marks, who is the attorney for the taxpayer. The actual statement documentation from the taxpayer's accountant is available. So mine is to look at the actual numbers, which takes us down to about $11 million in adjustments, not accounting for the potential error, as also reflected in the documents as far as claiming expenses that should not have been capitalized, that appears to have been capitalized. Mr. Runner.
Yeah, at least I'm trying to remember the testimony that I heard. I think I heard that they weren't sure what they had done with that interest, and I think actually that they made it pretty clear that it would be the assumption at that point that they used the construction interest in terms of helping to establish what was established in the basis. So, again, I think we just had a variety of opinions going on all over the place. And, I think at that point it was up to the FTB to make the argument in regards to what they had found. I don't think they did it well. I think that they had issues when actually it was built, quite frankly, on the testimony of their expert, a lot of it. And when I asked the expert whether or not he could construct that house at that rate, said he couldn't. So it makes it very difficult for me then to find credibility with the FTB. And then I get worried about if they're making the argument, that's the government making the argument, and the taxpayer believes that they have the documents and have made their argument, I have trouble then finding our place to try to, identify and nuance, a host of other opinions in terms of trying to find the right one. So at this point, that's why I'm convinced that it's the path that makes the most sense to me is to go with the taxpayer.
Chairman?
Member Stower.
Okay, couple of things. As far as the tax return number and the number being correct, this is how I'm seeing it. When they filed the tax return in 2006, they had already asserted that the majority of the records were lost. So I've been questioning how did they come up with the initial number of 12.9 million, the number that the first accountant gave to the second accountant. And all that they provided in their exhibits to us is just that number and not the backup. And I have repeatedly asked for the backup to the 12.9, and we have not received it. But yet, that's the number that's, along with the purchase of the land, the number that's on their tax return. When they went through the protests, and Zebo is now representing them on protests, he is the one that indicated that the basis included mortgage interest and capitalized interest and so forth, and it's their own schedule that was part of the Appealings Exhibit 64 that detailed that amount. And the FTB did address it in their exhibits on what it was and why it was not qualified. In their exhibits that they submitted in August, they identified the amounts and said there's no basis in law to include it in the basis. So there along, I know that there's errors in the tax returns, so I cannot say we can accept the tax return as filed. With respect to the Cohen rule and estimates, I do agree that we do need to estimate the basis since we do not have records. But Cohen tells us that you estimate weighing heavily against the taxpayer, not 100% of what was reported on the tax return. And I agree that FTB initially started out with $4 million to produce the property. But they have since said we're willing to look at the comparables that Mr. Williams provided to us and go with that square footage to get to the cost. Now, they were using 438 because they were going back and indexing it to the 1999 cost. And I think the taxpayer made it really clear that they continued to do construction after 1999. So using the 1999 cost may not be accurate, but FTB did agree to $600 per square foot. So I'm thinking either this $600 per square foot or this percentage of error that Mr. Horton is talking about to get to the estimated total basis. In addition, in addition to $600 per square foot, I'm also willing to pick up the governmental fees that Mr. Williams identified in his report. He had $599. So at the bottom, I'm at 10.2. and total basis.
Members, let me just clarify something. From my perspective, relative to our constitutional obligations, as well as our legal obligations as a trier of fact, the facts that are presented to the board are to be taken into consideration. As when facts aren't presented, that the board is, even then, the board can actually take facts that haven't even been presented to us under consideration if we find additional evidence. So I think it's incumbent upon us to do that. Second, I think it's important to note that I'm not really making an estimate. I'm just relying on the actual factual evidence that's been presented by the taxpayer. I'm not relying on the evidence presented by the department. This is evidence that has been presented by the taxpayer in their briefs, as well as the documentation that they've provided. I'm not presuming that it didn't exist. I don't believe I can do that. I believe once the evidence has been presented relative to the capitalization of the loans, relative to the amounts that have been claimed, if there's an error in the actual documentation. The second, on the Cohan rule, I concur that, the Cohan rule says that we have to lean in the department. I'm not necessarily even doing that because I believe that the department has a certain obligation to vet out all of the facts. And so coming to a conclusion that we ultimately came to, some adjustments for various different categories of items. It's just the amount within those adjustments were different, but the fact that they were legally adjustable, coming to that conclusion should have occurred at a more timely fashion earlier, I think, in this process. And so to the actual documentation, the actual evidence that's before us says that the return was wrong. To what degree it was wrong is where we get into the Cohan assessment, but the factual evidence said that they did claim capitalized interest, and at best $718,000, which is their loan documents, which reflect the capital interest, would have been the amount at best, had they properly accounted for, that they would not have been entitled to. Now, whether or not we should give consideration to the time that the taxpayer, time it took us to get here, that's just the process. Sometimes it's longer than not. And this seems to have been a reasonable amount of time in that regard. Anyway, as a motion to Member Ma?
Yes, to appeals. Can you repeat again? So construction period interest would have been deductible in the year the interest was paid if they made the election on the tax return.
If they made the election on the tax return in the year that it was paid, it would have been,
allowable.
It would have either been deductible as, an expense,
Right.
or they could, or
They could have.
they would have capital. I mean, in this case, if they had made the election in the year they paid the interest to capitalize it, then they could have added it to basis, and then when they sold the property, that's considered in the basis.
But we don't know whether they made the election in
98, 99,
98.
when they were paying the interest.
Okay.
We don't know that.
And then tell me about the capitalized mortgage interest.
That would not be, they could not capitalize and add that to basis for this type of property.
So it would have just been disallowed.
Yeah,
Would they have
they-
been able to take it as a deduction?
Oh, yeah, certainly, yeah.
On their tax
Which-
return.
Yeah, which most likely they did. I mean, up to I guess it's the $1 million limit, but yeah.
Mm-hmm. So, I don't know. I mean, I think this document Ms. Dowell produces shows that as part of their work papers, they did add into their basis the construction period interest, which I'm willing to say, we don't have the documents. I'm willing to say that let's give them benefit of the doubt, but clearly the capitalized mortgage interest is not allowable to be added into basis, which is at 1.3.
Correct.
So, I mean, I'm willing to, since this is the taxpayer's own information that they submitted and they added it into basis, I would agree with the chairman that they're not allowed to add it into basis legally. So I would be comfortable deducting the 1.358792 of capitalized mortgage interest out of there.
I thought the capitalized mortgage interest was 718,000.
Lowe.
No, actually, the correct number is, it's about 740, 739,099 for the construction loan interest. And the capitalized mortgage interest is, as Ms. Ma just said, 1,358,792.
So then that gets us to a revised capital gain of what?
Well, less or more, it would be the 1,358,792 added to the gain, right?
And what
Right.
were they reporting? Where's their, does anybody have this for me?
Give me a minute. Can I have that?
I still like my motion.
That's 15% capital gains rate at that year, so.
I'd have to go dig through the, okay, they reported gain of 10,139,773.
And you want to add 1358792?
Correct.
Okay, so
Times 15%, right?
Much, much.
oh, yeah, I'm kind of overcounting. Okay, 11,489.
So
That's basically, okay, let me just explain. That is basically the same exact thing using, I think, Zabo's first, that's, yeah, it is. So I take it that I don't have 3 votes for my motion. I have a motion and a second. So let me do a substitute motion. Okay, I have an alternate motion prepared, just in case. Okay, I'm going to move to find a reasonable adjusted basis estimate under Cohan rule of $11,368,562, which consists of the original purchase price of $2,854,959, plus estimated construction costs of $8,433,506, plus purchase expenses of $3,167, plus refinance fees of $14,420, plus landscaping of $62,510. And I'm going to move to abate the failure to furnish penalty.
I think they removed
I already did that.
Oh, they did. That's right. That's
Ms.
already
Parker,
been
can you
done.
say those numbers to me again, please?
Here you go. I will deliver them.
She basically just took out this amount.
So basically, I
She basically took
mean,
out the
understand,
capital.
no matter what that list is, that it is a net amount of the amount minus, or it's a minus the mortgage interest
Capitalized.
capital. And we don't know at this point whether they took it as a deduction in that year.
We don't know.
We don't know that.
No.
We don't know anything, but we don't have 3 votes.
Yep.
Capital- Wait, but capital mortgage interest is not you can't add
Capitalized, yeah,
You
it
can't add
wouldn't
it to
matter.
basis anyway.
Right,
Oh, no,
whether
but
they
we don't know if
taken
they
it or
took
not.
it as a regular deduction in there, on the other side.
14.1.
Yeah, they might have took it in the wrong place, is what I'm saying, but it doesn't make a difference, that's all.
So that's the work papers that their people,
Lawyer.
whoever
accountant.
provided, so.
Okay, I've made a motion.
Yep.
Do I have a second?
Second.
I'm still studying it. Give me some
Well, it's going to be maybe, what,
It- it-
100 bucks here
Take
then?
out.
Let me,
The 1.3.
let me see if I can codify the motion, and then we'll direct staff to come up with the actual number, with your permission, members.
I didn't catch the land value and the
Is it-
construction costs.
Is it just the number minus the
Here's my motion, and it was all legally done, figured out for me, in case we had to do that.
Okay. Member Harkey's motion is to adjust the adjusted basis under the Cohan rule to be 11,368.562, not, which is maybe $70, $80, $70,000 or so off, just adjusting the interest. So I think we all sort of get there, that number, but, and I think the members have stipulated their position relative to the not allowing the mortgage interest. And so I think it's on record, and we've got a number, and we've got a second, I'm presuming.
A clarification, clarification, the 8,433,506, Ms. Harkey, is that what you're saying as your estimated construction costs?
Right,
And then you have all the other numbers that the parties agreed to?
right. So the total adjusted basis under Cohen of 11,368,562.
Second. No, I withdraw the second. I take that back, I'm sorry.
Okay, I think we have a motion by Member Harkey, second by Member Ma. We have a clarification that my affirmative vote is to adjust the mortgage interest out, the actual documentation of that, and that the other errors, the department, no evidence was even brought before us, that there should be an adjustment there, so therefore I'm prepared to assume in the favor of the taxpayer in that regard. Second is there objection, members, to these motions and no clarifications?
You'll be okay. Trust me, you'll be fine. If you're not, you gotta blame Jane.
Okay, well, that's why we're here. Take your time.
Ms. Harkey, can you give me a little background on how you got to the 8 million?
Sure, I can. I believe it was right here. It is right here, actually.
While you're doing that, can I ask Appeals real quick? Is the number the same as if we just removed the mortgage?
They're close.
Okay.
To reduce the basis?
By the mortgage interest that was deducted?
Right, yeah, sure.
Is that what the number, is that the same number?
It is the same number.
Okay.
You would
Should
add
be.
it back to the.
Isn't that a simpler way to make the motion?
It's not the same number, though.
It's not exactly the same number. This is from my number is from, we had assumed, when we went back and looked at all of this, that given that we couldn't find for the taxpayer, which I think we should have, that probably the best estimate to use was Zabo, because he was doing this pre-audit, going from memory, doing the best that he could to derive information, and that's where you find that there was interest included they shouldn't have. So we've used the funds disbursement initiated, the direct payments by the Lowe's to various vendors, funds paid direct by Lowe's to general contractor Bruce Sweet, second payment directly by Lowe to contractor Bruce Sweet, third payment funds paid directly by Lowe's to contractor Bruce Sweet. So we've got 512,243, 414,029, 117,307. Those are all Bruce Sweet numbers. And then completion costs as of September 30th, 276,299. And that comes to 8,433,506, which is the Zabo report that had the detail.
And I had that number too, written down here in my notes.
See,
that total.
we agree.
On the number.
Yeah, well, it's okay. That's
again,
probably
I'm-
all,
I'm
that's
not
probably
sure
all we have to agree on is the number.
Okay.
Because Zabo was the one that had the, well, it is, that's how we're getting there, by all of the information that they've got, that Zabo had, that he reported to them. So this all came from the same report. And that's the number that they have, and there's a reason for it, because it was what was disclosed.
Okay. Oh, you want to see it?
Just
Okay.
real quick.
Yeah.
Yeah, of course.
Here.
Of course. Take your time.
Oh, this is the same. I had that one already. It's that one.
That's
Fund
what he had
disbursements.
reported.
Direct payments by Lowe, so 3.8 fund pays directly to Lowe's.
Members, while we're looking at it, let me just clarify from my perspective. The evidence is clear to me that there were additional errors made in the tax return, that the accountant made a number of different errors in interpreting the law, the $62,000 in reporting repairs that should have been claimed, which is not atypical. I mean, it's not untypical that you get expenses claimed as capitalized deductions. And so if I was to, but there was no evidence necessarily presented that that document wasn't an argument. I think there was evidence, but an argument that those expenses were actually claimed on the return. But if they were, I would probably be closer to that error, those sequence of errors would amount to somewhere around $900,000 in additional amounts that would be deducted. But that's where I'm at, but this is not one of those situations where, this is a situation where it requires 3 votes to get things done. So I am comfortable with the adjustment downward, or upward, if you will, to 11.368562, because my number, after adjusting for the non-qualified interest, would have came up to 11.428. So, and there's a second by member Runner for various reasons as well. And further discussion, members.
There is a first and a second, and I don't agree with the number because the 3.8 fundable numbers, direct payments by the Lowes, some of those direct payments were based on the declarations that the various vendors submitted, that the Franchise Tax Board did look at and determined that some of them were duplicate. They did allow a large percentage of it, but they did not allow all. But that's just one girl's opinion.
That's a
Here's the challenge.
Right opinion.
Here's the
members,
challenge.
Which every member is entitled to. Mr. Runner?
Yeah, I mean, I get, the numbers are about the same. I struggle with how we're getting to the number. I have much easier time, quite frankly, and again, looking at the idea of using the taxpayer number minus the adjustment on the interest, on the mortgage interest issue. That to me is a very clear path in terms of how we get to the number we're going to. And so
So that gets us to what adjusted basis?
I think we had that number. What was the adjusted basis if we go ahead and use the,
I want to be specific so we don't get a surprise.
Oh, I'm sorry.
the adjusted basis if we just go ahead and adjust it and take out the mortgage interest?
Which adjusted basis number, though?
Using the taxpayers' numbers,
Okay,
removing just that portion of it.
okay.
What is the number of their basis?
We're actually adding back to the claim basis, so it's an addition, not a
Well, we're going to subtract, they're going to have a greater liability than what they believe.
I mean,
than what they-
their number is bounced around. I mean,
Their tax return.
on their
Start with the
return,
tax
what they
return.
reported, okay.
I'm sorry.
Well, that's Mr. Runner, then we'll go to Ms. Stower.
I will, I don't know off
While
the top
you-
of my head, I'm sorry.
Okay.
While you looking at it, Ms. Stower?
Okay, it's an estimate. Estimates are estimates.
Mm-hmm.
I can live with Ms. Harkey's number that she gave before I made my big speech, which gives a total adjusted basis of $11,368,202. And that was her second motion, I believe.
Mhm.
What?
11,368,562.
Okay, so we got a motion to adjust the basis 11,368,562, second by member
Runner?
Harkey, actually. Second by member,
Who's making the motion?
member Harkey made the motion, member Runner is second the motion. Without objection, none noted. Such will be the order.
Such is the order. You guys want this?
Please.
You guys all clear on the section 40 piece that you get it right?
Too many numbers. Okay, thank you.
Okay, Ms. Richmond, our next matter.
Our next matter is B2, Maria Phillips and Michael Del Campo.
Oh, dear. Oh, dear, dear, dear. That's the troublesome one. Where's my sheets?
I'm sorry, which one was that one? I'm sorry.
B2.
B2, thank you.
B2.
This is the innocent spouse matter.
Members, this is the one where the husband testified that his wife was liable? Okay.
Right.
Does anyone want to make a motion?
I move to sustain the franchise tax board.
Second.
Member Stowe, I move to sustain the franchise tax board, second by member Ma. Without objection, members, such will be the order. Ms. Richmond?
Our next item is B5A, William R. Dobkin and Donya Dobkin, and B5B, Deborah M. Dobkin.
I'll move to sustain the FTB.
Second.
Member Harkey moves to sustain the...
That's as
well,
adjusted, right?
As adjusted.
Okay.
As adjusted.
Member Harkey moves to modify the FTB's assessment based on a cost basis to 3,706.
Whatever,
plus some other
whatever you
numbers.
accepted some things
Okay,
by
as accepted.
schedule
Second by
and on
member
the land.
Ma. Without objection, members, such will be the order.
Our last item is C1, Ronald J. Bloomquist.
I will move to send this to offers and compromise.
Well, yeah, we actually...
Do we have to sustain the
Member
department?
Harkey moves to
now?
deny the
Right.
petition, second by member Runner, and recommends that we move this to offer and compromise. Objection, members, hearing none, such will be the motion.
For clarification, that's with the revised adjustment, obviously, that
With revised adjustment, yes, I'm sorry. Thank you. Yeah, revised adjustment, sustain the department and move to OIC. Okay. Is that it?
For the day, anyway.
Our next item is closed session.
Could our team and taxpayers just indulge us for a minute, if you will? We certainly would appreciate it.
Everything off here?
Those, I don't think anyone has flights or anything like that. Say it again.
Mike's, yeah, I'm not sure what the...
Members have returned from closed session. Ms. Richmond?
The members met in closed session and discussed settlements and personnel matters. And that concludes our business for today.
The Board of Equalization hereby recess till tomorrow at 9:30.
All right.
All right.
Sir.
Bye.